Hello, good morning. You've tuned into CNBC TV 18. I'm Vinny Motiwala. With me is my colleague Rachna, and you're watching Power Breakfast. Hi, Rachna. Good morning.
Good morning to you as well. Vinny, let's start the day with the headlines then.
Absolutely. Let's get started with the top headlines for today. And obviously, the first one is going to be on the West Asia front. Tensions between the US and Iran escalate as the US accuses Iran of firing multiple ballistic missiles at its forces in West Asia in an attempted surprise attack and says all projectiles were intercepted. Iran warns it will take any action, including resuming war, to keep control of the Strait of Hormuz.
Stocks on Wall Street closed mixed ahead of quarterly reports from Apple and other tech companies this week. Meanwhile, markets in Asia also opened mixed. The GIFT Nifty is indicating a higher start for the Dalal Street.
Brent crude prices surged more than 4% towards $88 per barrel as renewed hostilities in West Asia reignite geopolitical tensions after several days of relative calm. Gold prices trade around the $4,020 an ounce mark as oil prices rebound.
India's industrial output accelerates 7.3% in June. This is the highest rate of growth in 6 months, aided by robust expansion in manufacturing, electricity and gas supply.
And in key earnings, L&T reports a mixed quarter with a 14% rise in net profit. EBITDA misses estimates, but order inflow delivers a positive surprise. Management holds on to the FY27 guidance. And today, four Nifty companies, Asian Paints, Eicher Motors, Adani Enterprises and Adani Ports report their numbers. Also watch out for earnings from Toubro, Colgate as well as KPIT Tech.
All right, those were the headlines that we're tracking this morning. But first up now, let's take a look at the Asian markets, which is clearly struggling to find its feet this morning after yesterday's chip rout. Taiwan is the clear laggard here. Index is in the red, down over 1%, close to 2% now, extending Tuesday's crash, which was the third largest point fall on record for the index. And there's the Hang Seng, which is the bright spot in the region right now, trading in the green, up over 1.5% almost now. The Kospi is also barely holding in the green, but now it has clearly slipped up almost 4.5%. This is big because SK Hynix, the big boy of the index, rose in early trade despite a Q2 miss, but the miss, clearly the index is not taking it well. The Nikkei is also flat, almost 1.5% in the red, giving up its early rebound that we saw, but not much of a recovery from yesterday's trade, except Hang Seng being the bright spot there. So mixed cues coming in from Asia, similar to the US, where Fed decision would be key tonight. We'll get you more on that later. But for now, what are those global cues indicating for us? For now, GIFT Nifty is indicating a positive start for the day, but let's get you some updates from West Asia then, Vinny.
Absolutely. As of now, positive start. But West Asia update, what we have coming in this morning is where tensions seem to re-escalate. And US Central Command says that Iran's IRGC launched multiple ballistic missiles in an attempted surprise attack on US forces in West Asia. Adds that all the missiles were successfully intercepted. Meanwhile, Saudi Arabia says that its air defense destroyed several drones targeting its oil facilities in Eastern province launched from Iraq by Iran-aligned groups. Now, Iran's deputy foreign minister has warned that Tehran will consider any action to maintain control over the Strait of Hormuz, including resumption of war. Meanwhile, United States President Donald Trump says that he met with Israeli Prime Minister Benjamin Netanyahu and held positive as well as productive talks, according to the White House. Netanyahu said that his meeting with Trump was excellent and one of the best conversations they've had. Additionally, Iranian Foreign Minister says that he was assured by his Ukrainian counterpart that the attack on Iranian ship was unintentional and that Ukraine seeks no escalation.
All right, that's what's coming in from West Asia, but the impact of it all on the commodities sector. Let's get to that and let's get Manisha Gupta for that update. Good morning, Manisha.
Morning, and thank you for that. Well, yes, we have seen the crude oil prices jump up back yet again. Last 3 days was 14% of a decline, but today we are trading 4% on the higher side, and $88 a barrel is back on the screen there. The U.S. CENTCOM saying that there is surprise Iran attacks on your Air Force bases in West Asia. All missiles, of course, have successfully been intercepted is also what they said is one part of it. The other is that the Iran has rejected Oman proposal for a shared 50-50 control of the Strait of Hormuz. The drones fired at Saudi facilities also have led to nearly 400,000 barrels per day of Jazan oil refinery being temporarily shut, are all very supportive factors for the crude oil prices there. But remember, it is a U.S. Fed meeting announcement as well expected tonight. And ahead of that, we've seen some profit-taking come in for precious metal prices. So whether it's gold, silver, platinum, all of that has seen a decline. For that matter, even the base metal prices are slightly weaker. So for copper and zinc, we are trading 0.5 to 1% on the lower side. The strength in U.S. dollar index seems to be weighing across many of these commodities.
Okay, Manisha, thank you so much for that. And that's the update coming in the world of commodities. But how are the overnight cues going to be impacting our Indian market? We have a team of research joining us to set us up for trade, tell you which are the important stocks to watch out for in the trading session as well, and cues in the world of F&O. But first up, let's go across to Hormaz, who is here to tell us the important cues for the market. And Hormaz, good morning. The situation in West Asia continues to be kabhi haan, we're going to attack, kabhi na, we're not going to attack. What is the cue that now we should keep an eye out on?
Good morning, Vinny. I guess we should all start a competition on who has the better one-liner at the start of the show. But yeah, the West Asia situation is not improving by any means. But the oil markets, well, they are reacting to it today after a 3-day sell-off. Brent now back towards the $88 a barrel mark. And the GIF Nifty, which at the initial ticks was up around 200 points, has halved from those levels. Still up 100, but slowly cooling off from those higher levels as well. Today, of course, promises it's the start of the August series, so that's another big thing to watch out for. It's a big earnings day today. Almost 60 companies will be coming out with results, 4 Nifty companies and plenty of broader market names today. And of course, the major decision overnight, the Fed rate decision, will be reacting to that tomorrow morning. The chip sell-off that you're seeing, the sell-off that you're seeing in South Korea, the one sector that's having the last laugh is IT. The Nifty IT is having its best month in the last 6 years, now is up 15% so far for the month, and we'll be watching out for that today as well, because the Infosys ADR overnight was up 5.5%. So keep IT on your radar. The earnings, and considering the fact that IT has now taken a front seat and is ensuring that the Nifty is managing to hold on to lower levels of the range, the Nifty Bank has taken a bit of a back seat, and as a result of which the Nifty Bank is now finding itself in a lower 1000 point range, which is 56,500 to 57,500. And despite the sluggish moves seen on the Nifty Bank yesterday, the Nifty was absolutely flat, and that's because IT managed to offset those losses. For the Nifty, well, it was an 85-point range yesterday. It needs to break out of that today. It'll be interesting to see which way the market goes once on market open, considering the crude oil prices and the slew of results that are lined up for the day. And of course, we need to watch out for the earnings reactions, which have been on the extreme. You saw that yesterday. And of course, a continued rebound in IT names as well. Plenty of results. If I tell you the entire list, it will be like a credit title of a movie, but that's not get there. Plenty of results. I guess that's enough for it for the Nifty. GIF Nifty for now indicating a positive start for at least for now. Be interesting to see whether that sustains or not.
All right, and a positive start to the day is expected, but 60 earnings to track, so quite a long day for you, Hormaz, and for the team. But now let's go over to Ananya, who will list out the stocks to watch out for in today's trade. Good morning, Ananya.
Good morning. So let me first start with L&T. So they delivered a mixed quarter. Revenue and profitability was good, but here EBITDA declined. The key positive was a strong order inflow of 1 lakh crore, while management retained its FY27 guidance. Now coming to Tata Capital, they also delivered a strong quarter with AUM up 22%, disbursements rising 33% and profit growing around 56% here. Now it was supported by improving asset quality also. Now coming to Phoenix Mills, they also reported a healthy quarter with revenue up 13%, EBITDA up 14% and profit rising 23%, led by strong retail consumption growth here. Now, Pradeep Phosphates, they beat estimates across key parameters with revenue up 26% and EBITDA up 24%, while also announcing a 250 crore diversification investment here. Now, coming to Birlasoft, for them, the quarter also remains soft with muted revenue growth and margin pressure expected from wage hike here. Now, among other updates, if you see, Graphite India faces a preliminary 3.68% US countervailing duty, while RVNL secured a 360 crore railway doubling order. So watch out for these stocks today.
Okay, Thank you so much for that, Ananya. But in the final update, let's go across to Sudarshan to understand the cues in the world of F&O. Good morning, Sudarshan.
Good morning, Vinny. So new series, August series will start today, and cues that we are getting are looking largely mixed. And the main reason of mixed cues is the crude price. Now, overnight, we have seen a sharp surge in the crude. Now, Brent is back over the level of $87 per barrel. So we should put crude on the big picture. Whenever crude goes below $85, we should start expecting some kind of reaction or some kind of headlines from both US and Iran. And that's been happening over the last few weeks, or say last few months. What about levels? The main question is, can Nifty sustain the levels above 24,000 after GIFT Nifty is indicating that we might open with a gain of more than 100 points? That will be tracking very closely. As far as FIs are concerned, yesterday in the index futures, they have sold, but in the stock futures, they have bought, so it was kind of largely offset. Talk about the options data, and the longs exposure remains around 9%, short exposure remains around 91%. In the options data, very narrow range for Nifty from 23,800 to 24,100. So on the put side, 24,000 and 23,800 were the most active ones, and on the call side, 24,000 and 24,100 have seen maximum change in the open interest. So support 23,860, and resistance remain first resistance 24,100. Second resistance comes around 24,300. Some of the stocks that I'll keep an eye on. First one is Ambuja Cements. After inline set of earnings, commentary was looking positive. Companies looking for 8% volume growth. L&T core earnings have looked very weak, and stock had seen a major downtick over the last few weeks. And lastly, Chola Investment, if you remember, during the market hours came out with the earnings. Earnings looked in line, but commentary companies maintained the guidance. So look out for this stock too. And some of the cues that might happen in August series and we might have to track. First one, FOMC outcome will be coming out today. RBI policy, if there is any update on the monsoon, and also one headline, West Asia tensions.
All right, those are the cues for August series. Thank you so much, Sudarshan, for that update. But now let's slip into a break. Up next, we get you all the cues from Wall Street on the other side. Welcome back. You're watching Power Breakfast on CNBC TV 18. Let's focus on the U.S. market. Wall Street ended mixed on Tuesday. The Dow Jones surged more than 500 points, while the S&P 500 ended slightly higher. The Nasdaq, however, closed marginally lower. CNBC's Kate Rooney gets us a wrap of all the action on Wall Street.
U.S. markets were mixed across the major indices in Tuesday trading amid a slate of positive corporate earnings and another chip sell-off. The Dow gained 537 points, the S&P 500 was up 16, and the tech-heavy Nasdaq fell 55. Johnson & Johnson has offered $5.5 billion to settle tens of thousands of lawsuits claiming its baby powder and other talc products caused ovarian cancer. The settlement would cover 76,000 claims. The company denies its talc products caused cancer, but stopped selling its talc-based baby powder in 2020. And FIFA is exploring a plan to raise more than $4 billion by selling a stake in a new commercial venture. It would be valued at about $20 billion and include the group's broadcast rights and sponsorships, as well as ticketing business. FIFA said it is working on that plan with bankers at JP Morgan. Investors are said to include Josh Kushner, brother of President Trump's son-in-law, Jared. UEFA, Europe's governing body, sharply criticized the move, saying the sport is not FIFA's to sell and is reportedly considering boycotting FIFA events. That's what's happening here in the U.S. Back to you in Mumbai.
Thank you so much for that. But, the all-important Fed decision is due tonight as well, and the central bank is widely expected to hold the interest rate steady. Let's get in Steve Leesman to tell us the key findings on CNBC's latest Fed survey.
Yeah, change is coming. Respondents to the CNBC Fed survey see no change in rates, however, this meeting, but they're divided on the outlook for hikes in the next year. And they are expecting big changes to how the Fed operates under new Fed Chairman Kevin Warsh, which come, by the way, with a measure of concern from our respondents. Just 39% of the 29 respondents expect Warsh to hold a press conference after every meeting. That's down from 59% of the June survey. 18% think it's going to happen only when the Fed issues the forecast or the SEP, and 19% say rarely, while 25% they just don't know. 59%, meanwhile, believe the dot plot or estimates about the future course of rates from individual Fed officials, that's going to be eliminated. Another 30% think they will be modified. A big issue here has been Warsh's refusal, not just to provide forward guidance, but even his reaction function, or how the Fed will forecast rates. Forecast rates will be set under different economic circumstances. 70% say the Fed should be doing this, that is, providing their reaction function. More than half, meanwhile, say not doing this will lead to less effective monetary policy, and 70% say it will lead to more market volatility. Guy Labat, chief fixed income strategist at Janney Montgomery Scott, says the uncertainty generated by Warsh's early pronouncements are forcing firms exposed to overnight interest rate swings to hedge against those swings, which will incur a cost in the long run. We might soon that volatility. We might see that volatility as soon as tomorrow. Fed futures markets place a 28% probability right now on a rate hike at tomorrow's meeting. That's a big number for a meeting where most expect no change, followed by a 76% chance of hike by September. Some significant adjustments are going to be needed depending upon what Warsh says, Carl, or what he doesn't say.
All right. Thank you so much, Steve, for that update. But now it's time to slip into a break again. We get you more news and updates on the other side.
Welcome back to Power Breakfast on CNBC TV 18. On to some macro news updates now. India's industrial activity accelerated 7.3% in the month of June, hitting a 6-month high. The expansion was driven largely by strong growth in manufacturing, electricity and gas supply. Now, manufacturing, the largest component of the index, that grew 7.8%, while electricity and gas supply, that surged more than 10% as well, signaling a broad-based strength that came in the economy. At least some positive indication, Rachna, as of now coming in from that IIP data.
That's right. Let's go across to Japan now from an update about the earthquake. The death toll has climbed to at least 13, with rescuers still digging through a collapsed shopping mall in Kumamoto in search of survivors. The Aeon Mall in Kashima town caved in after a suspected gas explosion, and dozens of employees remain unaccounted for. The disaster follows a magnitude 7.1 earthquake that struck Japan's Kyushu Island on Tuesday, which briefly triggered a tsunami advisory before it was lifted within 2 hours. The quake also derailed a train, damaged the historic Kumamoto Castle, and forced Kyushu's bullet train network to suspend services.
Okay, that is some somber news coming in from Japan, but that's all the time we have on this edition of Power Breakfast. Nifty implied open still indicating a positive start for our market. So thank you so much for tuning in. Up next, your Bazaar Morning Call.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We're coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant with me, my colleagues Nigel and Rima. Guys, good morning.
Hi, morning.
Hi, good morning. So, start of a new series, at least on the Nifty front. And yesterday, markets moved in all of an 80-point range.
Yeah.
And things were fine. It's just that there is, again, overnight been a little bit of a Middle East flare-up and a crude rise from lower levels.
Well, that's right. But if things don't escalate from here, there's a bit of a positive bias, I guess, getting into this August series. So let's hope that Mr. Trump doesn't do anything and that fighting stops. But otherwise, I think a bit of a positive bias is what I'm working with.
I think last evening, oil had fallen quite sharply, but this morning it's up a little bit. But that's essentially the waxing and waning with regards to oil. So 82.5 was the low, by the way, yesterday. And, this morning we were back up to about 87.5 if you want to be precise. And the reason is that news coming in that, Iran apparently, and this is, of course, the U.S. saying, we've not heard it from the Iranian side, but the U.S. saying that Iran has fired multiple ballistic missiles at its forces in the Middle East. Apparently, the targeting bases in Jordan. But the U.S. Central Command, CENTCOM, essentially saying that all these missiles were intercepted, no damage has been done, etc., etc. Now, and this is the latest, which has caused the spike in oil prices. But before that, last night, Trump essentially, said that, well, we are talking with Iran, the talks are going on, but once again threatened to destroy, bridges, power plants, etc. if no deal is made. This was said in an interview. Iran, though, is saying that we're not talking to the Americans, but they went on to say that intermediaries may convey messages from the American side to us. I mean, it's more of the same. Till something really moves, we're in this kind of sort of dark zone with where there's sometimes peace, sometimes war, and we don't really know which side of the bed you're going to wake up on. In terms of this entire equation. Now, Trump also met Israeli Prime Minister Benjamin Netanyahu at the White House. So always, closely watched and a fair bit of commentary on social media, etc. around this. Now, U.S. equities closed mixed, right? I mean, NASDAQ was down just about 0.25%. So that's not a large cut. But you look at the semiconductor part of the market, right? I mean, it was down, 2.5% on Monday. It was down 4.5% last night. So that's those are the chip makers, the best performing names, and that index down 4.5 again. And of course, I mean, it tracked what happened with Asia earlier. So if you look at Asia yesterday, Kospi was down 9%, Taiwan was down 7%, Samsung was down 13%, etc., etc., etc. SK Hynix and many others sold off quite hard. So this is the other part, and if you ask people to put a finger on exactly what is causing this sell-off in the semiconductor chip names. It's a bunch of things. It's not one. It's this entire circular financing. Everybody basically being the customer as well as the funder of businesses, and it's like almost in a circular way, which is why it's called that circular financing angle. Then of course it's valuations, it's the run up, it's the positioning, and all of those things. But I think we are seeing a bit of a sell-off. Microsoft Meta will report numbers after market hours today. That is later today, and of course. We'll have more large cap earnings out of the US, tech earnings later this week. In contrast, and this is a repeat of what I put out yesterday as well, in contrast to the absolute momentum, momentum sort of move higher and then the momentum sell off in the semiconductor part of the market, you're seeing the heavily shorted software space rallying, coming up. So that's essentially what happened. Accenture, 6.6, 6.8%. Cognizant was up 7%. The point is, the question remains whether this is people moving in, long onlys moving in, taking a view, or this is, once again, like we are seeing positioning coming off in momentum AI tech names. Is this the same thing in reverse here in software names? And I think we don't have the answer yet. So EPAM was up about 6.6. Globant was up about 7.5%. And as I said yesterday, many investors in India in IT services, those who track it, those who perhaps are want to buy it or whatever. I mean, they're looking at what's happening and what these companies in the US will do to take cues because they will feel it better. They're closer. So I think it's interesting. But as I said, I'm not sure whether this is real money moving in or this is covering and positioning getting taken off, shaken out on the other side of the AI momentum trade. Now, I'll just leave you with one other important cue which we'll react to tomorrow morning, which is the Fed decision. So maybe a 20-30% chance of a hike. The September meeting by consensus perhaps is more tricky. So this time, no hike. There are those who say, well, perhaps there is a chance. We'll see. Now, I'll just leave you with the levels which don't change much. 24,230 is the Nifty resistance, which is the point in the falling trend line. 24,500 is the bigger level which the Nifty's got to take out before we can become more constructive. Supports come in at 23,830 and then 23,600 on the downside. I mean, like when oil prices hit about $82.5 GIFT Nifty at that point was up about 200, 250 points. With oil coming up, I think GIFT Nifty is also moderated gains. That's the indicative open about 100-odd points higher to start with. Nigel is walked across to the wall with F&O cues and positioning. Nigel, take it away.
Well, we start a new series. The August series is what kickstarts today. But the power of short covering has been on display. Remember, the IT index has rallied close to around 15% in the July series, and that's after 5 sluggish series. And majority of this rally has been led by short covering. As you can see on your screen, Bill, there have been massive rallies on stocks. We should get that up for you on the screen. Massive rallies on stocks with, in fact, the open interest sharply lower as well. So just take a look at the returns. The IT stocks have rallied anything between 10 to around 25%. And the open interest is down by around 20 to around 30%. So the power of short covering has been on display, particularly on these IT-related stocks. Well, getting to the flows then. Yesterday, we did see that the FIs and the DIs, both of them on the same page. The flows turned positive. You will say, well, it's an expiry day-related phenomena. Well, that partly could be the case. But if you look at the NSDL data for the month of, for the past month, the FI flows actually have turned positive, which is heartening to see. After many, many months, we did see negative flows. And now the FI flows, they're more or less flattish with a mild positive bias. Well, I'll tell you what, you'll take it with both hands because they were selling lock, stock and barrel. Getting into the August series, then, the rollovers in percentage terms, well, they are in line. You'll say, what's changed so much, in comparison to the previous series? Even on the Nifty, even on market-wide rollover positions. But if you look at it more closely, if you pull up the Nifty open interest, you'll highlight that, in fact, a lot of short positions actually didn't get rolled over into the August series. And that's important to note because the total open interest actually at the start of the series is sharply lower. And that perfectly fits in with what the FI positioning is. On index futures itself, you look at it, well, the positioning is holding at around 90-91% or thereabouts. But just take a look at it. The net short positions are 20% lower at the start of the August series if you compare it to the July series. And similar is the case with the client positioning as well. In percentage terms, the clients, well, they continue to remain net long. But if you look at it, in absolute terms, well, it's sharply lower in terms of number of contracts. So the clients remain net long, FIs remain net short. That's a combination you like. In absolute contracts, though, it's sharply low in comparison to the previous series. And history suggests that August has traditionally been a moderately constructive series. The Nifty as well as the Nifty Bank, 60 to around 50% of the times, over the last 10 years, they have ended in the green. And that's been the average returns over the last 10 years or so. So the range comes up for you on the screen. The reference point on the downside is around the 23,600 mark, which is the recent low. While on the upside, this 24,500 mark will be the resistance mark. But going by the cues that we have, and hopefully there's no flare-up on the geopolitical issues, the bulls will believe they have the upper hand at the start of this particular series. So let's see whether or not we can go ahead and test the higher end of this range.
Indeed, and there will be a lot of action on individual stocks. 4 Nifty companies report numbers: Asian Paints, Eicher Motors, Adani Ports, Adani Enterprises, and even outside of that, Bajaj Housing Finance, Dabur, Colgate, Prestige Estates. So these are all important mid-cap companies. Just quick check on Asia before we get things going. Kospi is sliding once again, sharp correction, 5% down in the Korean markets. This is over and above the 10% fall that we had yesterday. The high on Kospi was 9385 that it hit in mid of June, and now the level on Kospi is sub 5,700. We're staring at a near 40% fall from the peak levels. The rest of the markets too are under pressure. I think the only one bucking the trend is perhaps Hang Seng, and that's higher in trade. Well, you've got 1.5% up on Hang Seng, and the GIFT Nifty too is suggesting a positive start. We have Cameron Brand, Director Research at EPFR Global, now joining in. Thank you very much for joining in. The ticker, the price tells us that the AI trade is cooling a bit. But in terms of flows, have we seen outflows from these AI hot markets like Kospi, Taiwan? What has happened in terms of flows from the time that Kospi, say, peaked in the middle of June? And where is money rotating now?
Well, we're still seeing a pattern where, frankly, the sell-offs are being treated more as entry points than as exit cues. So we've seen flows certainly to dedicated Korea funds moderate, but not turn negative. What we did see over the last couple of weeks is a search for value within the emerging markets universe. And that actually took investors towards India. We saw the sort of first foreign inflows for some time. Investors also gave Latin America another look last week. Of the Asian markets, Korea is perhaps the most vulnerable because a lot of the recent surge increasingly was driven by borrowed money. So investors are definitely more cautious there.
India dedicated funds. Cameron, what are the inflows that we're seeing?
For India?
Yes, India dedicated funds.
In general. So for India, it was a small inflow, but it was an inflow. It was under 100 million last week. But that was the first in a while and the biggest, I think, since mid-March. So it was definitely a positive development. And those inflows seem to be persisting this week. I'll obviously know more towards the end of the week.
Cameron, hi, morning. What's the number for Korea overall now? We were going with that, even as Korea was up I don't know how much it is up now. Must be still at least 60% for the year after all the sell-off. But, there was a number doing the rounds. Foreigners have sold some $75 billion and still the market's up 60, 70. And it was being explained as a technical sell-off because people had hit single stock limits and all that, all that kind of thing. What's the number now?
Well, in terms of weekly flows, they've sort of dropped from a fairly reliable 3 to 4 billion a week down to sort of 500 million, a billion. They're still pretty positive. Domestic support is holding up certainly through the fund lens. And as you say, there's a good deal of sort of technical correction here. There's still plenty of believers in the AI story, but as you mentioned, there was a bit too much leverage, both for regulatory and general sentiment comfort.
Got that. So we have seen the intensity of inflows sharply come down for markets like Kospi. $3 to $4 billion earlier weekly, and now we're talking about $500 million. Any other interesting data point that you could share with us about how capital is moving, smart investors are thinking?
What's catching my eye is how some of the earlier issues that were concerning markets have sort of dropped off the radar. We're seeing minimal to negative flows into the previously high-flying defense and aerospace funds. Very little talk and pretty neutral flows for private credit funds. So I'm certainly feeling that while AI and events in the Gulf, understandably are dominating the narrative, some of these issues that were on the agenda before things blew up in late February may not stay in the background much longer.
All right. Hi, Cameron. Good to see you, Ben. Let's talk about the perceived safest investment, which is gold, and the perceived riskier one, which is Bitcoin. What are the flows which are telling you on both those two assets? Both of them are going south.
Well, the price is going south. We're starting to see flows come back to dedicated gold funds, to physical gold funds. And there was a little bit of a recovery in cryptocurrency as well. as you know, there's multiple drivers for gold. One of the ones that gold shares with crypto is as an alternative to fiat currencies that investors may feel are being abused. And inflation that remains in the wings as an agenda. We've seen, I think we're getting on for sort of over 20 straight weeks of flows into inflation-protected bond funds. Obviously, that narrative could change very much at the end of this week when the Fed meets. But there is a sense that the fight against inflation has not been won. And based on how central banks did or didn't address it in the post-COVID era, investors are wary.
Oh, well, Cameron, we'll leave it there. Thank you very much for joining us. Good speaking with you, and it's a pleasure. Let me just quickly run you through the interactions which are lined up here on the program. So we'll have the management of Capri Global to talk about the June quarter numbers. That's at 8:35. 9 o'clock, we'll have Renu Baid of IIFL Institutional Equities to focus on L&T's first quarter numbers. 9:20, Kenneth and Rade of Old Bridge Asset Management is a market master of the day. 9:30, the management of TTK Prestige. On first quarter numbers, we'll have City Union Bank chatting with us at 9:40. 9:50, we speak with the manager of Pine Labs. Again, Q1 numbers which came through in the second half yesterday. And Lata speaks with Motilal Oswal's Nitin Agarwal on the first quarter banking earnings and more. That's the lineup.
Time to take a short break, but we've got a lot of stock-specific action they're going to be tracking for you in our special Top 10 segment. For the time being, I'll run you through the list. L&T, Tata Capital, Ambuja Cements, Paradeep Phosphates, AGI Greenpack, all of them will be reacting to positive news flow. Add to the list, Phoenix Mills. Well, on the flip side, you have Suzlon and Graphite India will be reacting to negative news flow. And a mixed reaction on Birlasoft as well as Crude Sensitives. Take that break, come back. We're going to get into further detail on all of these names. Welcome back. Hope you're having a good morning. As promised, let's get straight to CNBC TVTN's top stocks that we're tracking for you. And let's start off with Vivek, who's tracking the big boy, L&T. Vivek, morning.
Well, good morning. Larsen and Toubro, going into this particular quarter, there was quite a bit of trepidation, especially given the fact that there was so much disruption, especially in terms of supply chain due to the, war that we're seeing as far as West Asia is concerned. But despite that, L&T, while execution has been quite muted, a clear positive surprise has been the very strong order inflow. Now, talking about the numbers themselves, the EBITDA missed estimates, but the order inflow delivered a positive surprise, almost a 20,000 crore beat as far as order inflow was concerned. More importantly, the management held on the FY27 guidance. Now, talking about the numbers themselves, revenues higher by 6.7% at 67,942, slightly above our poll. EBITDA was down 3% on a year-on-year basis, closer to the 6,120 crore mark, which was a bit of a miss as far as our own poll was concerned. Margins down 90 basis points on a year-on-year basis, a 60 basis points mixed to our estimate, and profitability higher than our estimate, aided by other income that was actually aided by significant treasury operations. Now, talking about the order inflows, the group order inflows stood at 1.08 lakh crore, a clear positive surprise, up 14% on a year-on-year basis. When you're talking just about the core order inflows, it stood at 87,200 crore. Again, very, very robust. The consolidated order book right now stands at close to 7.8 lakh crore. Again, very steady. In terms of what the management told the media last evening in the conference call, they maintain their FY27 guidance of 10 to 12% top line as well as order inflow growth, and they also maintain the core EBITDA margin guidance of 8.3%. They expect execution to be back-ended as far as FY27 is concerned.
Thank you very much for that. Sorry. I'm also looking at Birlasoft today, and it's a softish quarter. The company's revenues went up on a quarter-on-quarter basis, so that is a positive. But on a year-on-year basis, revenues are down 3%, and it's been under pressure for the last couple of quarters. Margins for the company declined this quarter at 16.2%, but in the prior 2 quarters, there were some one-offs which boosted their margins. So in a way, margins have now normalized in Q1, but Q2 will have a wage headwind. So that the company said in the conference call yesterday that it could impact margins by 170 to 200 basis points next quarter because the wages are effective 1st of July. Net, the company is looking at margins of about 15% plus, so lower than where currently the margins are. The deal wins declined by 20% on a quarter-on-quarter basis, but what the company said in the conference call is that competition is very high in the new renewable deals, in the deals being contested. When it's a renewable case, they're sort of protected, but they are seeing enormous amount of pricing pressure. So I guess this is something we've heard even from the other companies that, bids are now being competitively fought. So I would go, it's a mixed picture. Numbers are soft, but generally IT is going to do well today.
Okay, all right, Rima. Thanks a lot for that. After the big correction that you've seen, Birlasoft, a stock that is half from the top. Probably, in fact, most of the bad news is in the price and could look up. Moving across to Ananya. She's here to tell us about Tata Capital. Morning, Ananya.
Good morning. So it was a good quarter for them, well-balanced quarter, AUM up 22% and disbursements rising impressive 33%, showing a good, healthy business momentum here. Now, if you look at the profitability, it remained robust with net profit up 56%, while asset quality continued to improve as gross NPAs declined to 1.9% and credit costs remain at just 1% here. Now, housing finance was a standout performer with AUM growing 24% and profit increasing 29%, supported by best-in-class asset quality. So one of the key positives. Management remained confident of sustaining this momentum, now guiding for 23 to 25% AUM growth this year, now around 10 basis points of margin expansion, stable credit cost, all in all a very strong quarter for Tata Capital.
Got it. All right. Thanks a lot for that, Ananya. Well, Ambuja Cements, yes, the stock ended in the red, but I think the stock could see some green and maybe look up from here on because the company really has pivoted from the last quarter itself. They're focusing now on value rather than volume, which was the strategy earlier. Now, in terms of the con call, well, they're reasonably optimistic about the part ahead. They're talking about 8% volume growth. Remember, the first quarter, there was a degrowth. They're talking about higher focus on trade sales as well as premiumization. And trade sales, at least in the month of July, were up by close to 8%. That's heartening to see because the past quarter didn't grow much. Cost per ton, that's come down a little bit if you look at it from quarter 4 to around quarter 1 of this year. They're saying by the end of this year, it gets a little bit lower. And by FY28, it could come down to around 4,000 rupees. So in a matter of 2 years, they're talking about 500 rupees on a per ton basis, higher focus on renewable energy as well as waste heat recovery as well. That's going to help them. Green power, basically. Capacity expansion, they slowed that down. They're at around 109. They're headed to around 130 million tons odd. Remember, earlier they were talking about 150 million tons, and most of this is going to be organic. Capex guidance of around 6,500 crores, and most brokerages, post the recent correction, well, they've trimmed down their estimates for the coming year, but they maintain their buy rating, and some of those brokerages should come up in the screen. So going with a tinge of green on Ambuja Cements. Well, let's hop across to Vinny. Switzerland was the other stock that got clobbered in trade yesterday. She's in with a quick analysis. Vinny?
Hi, so yesterday, obviously, the numbers came in, weak set of numbers, but con call highlights came in post-market hours. What they highlighted in the con call that the management said 10 to 20% of the deliveries were delayed this quarter, that is Q1, mainly due to the Middle East geopolitical disruptions. They're expecting recovery to start coming in the next few quarters. The management said that, and they've guided for a stronger H2 versus H1. So the split that they've given is 35 to 40% would be in H1 and 60 to 65% would be in H2. So H2 clearly will be doing most of the covering up. The average selling price has increased to 5.6 crores per megawatt. 5.6 crores was per megawatt in Q1 FY26. That's moved up to 6.3 megawatt per megawatt in terms of our overall project mix. So that is something that is a positive. But overall, margin compression, that's a bit of a concern. EPC side has seen an increase, and that increasing means that has lower margins. So that is something of an impact that would come in. Now, full year guidance, the management said that EBITDA margins for full year could be in the range of 17-18% is what they've said. FY26 was at around 18% for the company. What brokerages are saying, Nuvama is retaining their hold, but they've cut the target price to 51 rupees. Previously, it was 56 rupees. They've cut the EPS for FY27, FY28 as well to 13% and 10% due to the weak margins as well as rise in depreciation is what they're factoring in. JM Financials maintaining the buy rating, target price at 62 rupees. Those are the con call highlights. We've seen the sharp fall coming in yesterday. Today also maybe we could see a bit of a red, or the recovery is something that we'll keep an eye out on now.
Thank you very much for that. Ria is now joining in with some more stocks which are in the news today. Ria.
Well, yes, let's first take a look at Paradeep Phosphates on the back of its Q1 results. The results have been better than estimates on all fronts, but the volume has been muted. The revenue has seen an increase of nearly 26% versus estimates of just 9% growth. EBITDA also has seen an increase of 24% versus the estimates of a 23% decline. And sales volumes, on the other hand, have grown by just 4% on a year-on-year basis compared to a 7% volume growth estimate. And apart from this, the company has also approved an investment proposal of nearly 250 crores to set up an aluminum fluoride plant to enter and diversify into the related industrial chemical space. Apart from this, Phoenix Mills has also reported its Q1 numbers with the revenue and EBITDA seeing an increase of nearly 13 to 14%. Net profit also growing by nearly 23% compared to the previous year. The retail consumption has also seen an increase of nearly 32%. And going forward, the company has targeted for the retail portfolio to reach over 18 million square feet of gross leasable area by 2030. AGI Greenpack will also be in focus on the back of its Q1 numbers. The revenue has seen a growth of nearly 14% to 785 crores. Net profit also up by around 12% to nearly 99 crores in this quarter. Margins holding steady at 22% at the EBITDA level. And going forward, the company expects the margin performance to strengthen in the coming quarters as they see some easing in the input cost volatility that they have been facing over the past few months. And lastly, Graphite India will also be in focus as the US has imposed a countervailing duty of 3.68% on a preliminary basis on large dia electrode exports. And right now, nearly 34% of the company's revenue comes from exports, but the country-wise exposure has not been disclosed. So apart from this, and the company has also said that the financial impact is not discernible at this juncture. But sentimentally, it is a negative for Graphite India.
All right. Thanks very much for that, Ria. So keep an eye out on those names as we start this morning. But Manisha is here with the spotlight back on oil, which looked very well, very good last night at 82.5, but it's jumped up a little bit. Manisha, morning.
Morning, and thank you for that, Prashant. Well, last 3 days, we've seen crude oil prices decline by 14%. But in the Asian markets right now, we are trading 4.5% on the higher side. So $88 a barrel is back Well, there are four things to watch out for. One, the U.S. CENTCOM report, which says that there have been surprise Iran attacks on the U.S. Air Force bases in West Asia. So with this, the truce clearly has collapsed. The second is the Strait of Hormuz control, where Iran has rejected Oman proposal for a shared 50-50 control. The third thing is about the drones fired at Saudi oil facilities, which has shut 400,000 barrels per day of Jazan oil refinery. And the fourth point really is the U.S. Senate advancing Russia sanctions bill, which will be imposed on primary and secondary facilities in Russia. The bill will enable imposition of tariffs reaching 100% on countries which are still buying Russian energy exports. Within this, you have 5 countries which have been labeled within that bill, which is India, China, Slovakia, Hungary, and Azerbaijan. This is something that the street will watch out for. As of now, it's a procedural Senate vote. It has to go to the House. It has to be passed from there as well. But this clearly seems like a direct threat, of course, on consuming countries, especially that are buying in from Russia.
All right, Manisha, thanks a lot for that. Well, here's a quick recap of all the stocks we just covered for you, the ones with positive news flow: L&T, Tata Capital, Ambuja Cements, Paradeep Phosphates, AGI Greenpack, as well as Phoenix Mills. While the ones with negative news flow include Suzlon, as well as Graphite India, and mixed reactions on Birlasoft and Crude Sensitives as well. Well, we'll take a short break. Up next, we'll get chatting with Bino of Elara Securities. We'll also invite the management of Capri Global to discuss the past quarter's numbers. Stay with us. Welcome back. Well, we're starting a new series today. That's the August series. And the start of the last series was actually tech that bounced back. However, in yesterday's trade, if you look at the sector that lost the most was the FMCG index. So let's start the conversation with Bino, the head of research at Elara Securities, who joins us on the show. Hi, Bino. Thanks a lot for joining in. Bino, what do you make of the fall that we saw in, the traditional heavyweights, the best in pedigree, the stocks you wanted to hide in, something like an HUL? The stock yesterday was down close to around 6%. Do you think the selling on the downside was a little bit exaggerated? Yes, there was a volume miss, but the numbers didn't look that bad, right? Particularly after the kind of underperformance you've seen. Your take.
Good morning. So the numbers were not as bad compared to what expectations were. In fact, there were some signs of pickup, not just in HUL numbers, even in other FMCG numbers. But at the same time, the kind of expected pickup that market was building in over the last few days did not come through. Again, like I have highlighted earlier as well, HUL, the FMCG market per se has moved on from the way it was maybe 10 years back. And HUL possibly has a lot to catch up towards that. They are making some moves towards that. But at the same time, the new competition from e-commerce players, quick commerce players, marketing through social media, all these have bitten into the traditional mode that HUL as a large player with a strong distribution network had. HUL has some catch-up to do in that regards. Till then, I expect it to be a muted stock.
Sorry. Bino, Manipal Health Enterprises, the hospital play, have you analyzed the numbers? The asking market capitalization is 77,000 crore rupees. It's grown very aggressively. It's largest private sector hospital by way of beds, but it's made a lot of acquisitions. What is your take at a price of 590 at the upper end? And how would the valuations compare with the other listed plays like Apollo and Max?
So Manipal is definitely one of the strong brand names in the India healthcare sector. The sector is doing well, continuing to grow. We are seeing a lot of capacity addition, but at the same time, demand is also strong to absorb it. As of now, there is no big issues seen in the sector. At the valuation at which the IPO is coming, it seemed to be decent, broadly in line with valuations of the other peers trading in the market. So to that extent, I would be moderately positive on the issue.
It's a full OFS, right, Rima? I think there's a
combination. So there is a fresh issue of 8,000 crore rupees and an offer for sale of about 1275 crore. So offer for sale is smaller.
It's a smaller one.
It's a smaller, but 8,000 crore is the overall fresh issue.
Got it. Well,
which the company is going to largely use to pare down the NCDs they had raised to fund the recent Sayadri acquisition last year.
Okay, got it. Well, big sort of hospital chain. I think Karnataka would be and Bangalore would be the big profit center for Manipal, but I think they are now, of course, expanding elsewhere as well. Bino, just a quick word on Avenue Supermarts, DMart. Again, I mean, I think the stock sold off. Lots of discussion around the QCOM strategy and et cetera, et cetera. What's the sense?
We continue to be moderately positive on DMart despite the sell-off and slightly lower than expected results. Of course, store addition has become a very important driver of growth, given that like-to-like store growth has come off in the major cities, thanks mainly to the Q-commerce competition. DMart in itself has tried to do something on the online retail front, home delivery front, which has not really taken off. But at the same time, we do see room for growth in all modes of retail, including the traditional retail, especially in the tier 2 cities, tier 3 cities. Room for home delivery on a time frame, Q-commerce delivery, all these will grow. So to that extent, we still believe DMart is a decent stock to own at these levels.
I see. Got that. Bino, stay with us, right? We're going to get to the first management on the program now. Capri Global is the company that I'm talking about. They've delivered a very strong quarter, first quarter, healthy growth, improved margins, robust profitability. We have Mr. Rajesh Sharma with us, Managing Director at the company with us. Mr. Sharma, good morning. Great to have you with us on the program. Prashant this side. 62% AUM growth, profits have doubled, but those are great numbers. But if you look at stage 2 assets, that has gone up to about 1,200 odd crores compared to about 800 crores last time. Right? That is about almost 50% growth on a quarter-on-quarter basis, while stage 2 provision coverage has fallen from about 12% to 9.4%. So, Gilbert, you want to sort of tell us what happened there? How much of this increase will get fixed, and what's the risk? How much of this is at risk to falling into stage 3, sir?
Good morning and thank you. So I believe that always first quarter we always see little jump on delinquencies because last quarter a lot of contest, a lot of work happens on the delinquency in the business side. Having said that, gold loan prices have also been stable. So the delinquency in the gold loan in the stage 1 and 2 increases. But the moment gold loan account slippage in the stage 3, before that, the collections are really increased and auction notices are issued and the accounts are rolled back. So I don't see that the stage 2 will majorly impact the stage 3 and there'll be any spike in a major way in the NPA.
Okay. So bulk of this increase in stage 2 on a quarter-on-quarter is from the gold loan segment? Is that what you're saying?
Yes.
Fair enough. And typically gold loans, there are actual realized credit losses are negligible so far. We've not seen that with other players as well.
We have seen the gold loan prices as compared to last quarter have fallen 4%. Correct. Not in the stable. So when the gold prices have going down and stable in both the situation, your default ratio improved. When the gold loan prices were on the increase, the defaults were very low because the cases were getting balance transferred or they're being topped up. So that scenario is now changed. But gold loan portfolio delinquency remain in our control. You can always auction the gold.
I just had on gold loans, just one more, because it's the dominant driver. You're especially focused on it. I think about 50% of the book is gold loans now, almost 50% now. While it's growing rapidly, is it, if you look at the number of customers, I don't think that is keeping pace. That is down a little bit, right? So is it the same customers increasing, borrowing more? Give us a sense of that, Mr. Sharma.
Customers have increased to about 7,40,000, 48,000. It's increased by 5-6%. So I believe that, and they're unique customer. I'm not talking about the live account. Live account, some customer may have more than one. The live account is about 11 lakhs, but the unique customers are 7,48,000. So same customer keep borrowing, but there is a increment in the customer acquisition, and growth is coming not only from the existing customer, but also the addition of the new customer. And this special program we run for the acquisition of the new customer as well.
All right. Hi, Mr. Sharma. Good morning. Good to see you. What is the LTV on your gold portfolio right now?
Gold portfolio LTV is about 71%.
Okay, all right, 71%. So you're in an okay zone till now. Got it. Because the worry is if gold falls a little bit more, say another 10-15%, then you could be in a bit of a flux, but you seem to have some kind of cushion on that one. Got that. The other big trigger that the street looks forward to on Capri Global is, since you have a high proportion of your book that skewed towards gold, is what is the AUM on your gold portfolio per branch? At one point of time, I think you were at around 10-12 crores or thereabouts. And the leader, that is Muthoot, I think is at more than 30 crores. And you were talking about narrowing this gap. So what is it right now and where is it headed?
So we closed the AUM about 19,000 crore plus and the branches are 1,000. So we can easily say our per branch AUM is about 19 crore.
Okay. All right, 19 crore. And you think that it goes up from here on? What are the number of branches you're looking at? I think when you joined us last time around, you were talking about 850 going to 1,000. Now you're saying you're at 1,000. So number of branches and AUM, gold AUM per branch.
So now this year we have planned to add another 400 branches in the gold loan side, and these branches should be operational by end of third quarter. So I think by this year end will be about 1400 branches minimum, and those branches once come. So of course the new branches will not have the same AUM. So we have to say that the old branches AUM will still be more than 22 crore by the end of the year. But the old loan branches will be, since we are starting, the AUM will be less than 5 crore per branch.
Right. Okay, let's talk about profitability, Mr. Sharma. Net interest margins at almost 10%, right? 9.7%. Could you give us a sense of where this is? So yields went up, cost of funds were lower the quarter. What's the sustainable net interest margin as the mix finally stabilizes? By the way, has the mix at 50% gold loans, is this where you're going to be? And what's the sustainable net interest margin you're looking at?
I think this is sustainable net interest margin. This is something we see this we will be able to maintain. I don't see that we'll be able to make it improve, but if we are able to sustain this will be a good amount of profitability with the ROA in the range about 4.5% and ROA in the range about 20-21%. And I see gold loan portfolio should remain in the range about 55% or so.
Got that. Would you need, we have some slightly longer term targets as well, right? Short term target, I think 65,000 crores AUM by FY28. That's the aim, but, 125,000 crores by FY31. Would you need to raise external capital? Yeah.
With the mix of co-lending, direct assignment, and the potential reaching of Tier 2 capital, I think we are still good to go for about a year or so. And we'll see only in the first quarter, depending on the growth plan and all, what is the timing we need to see about capital raise and how much we should reach.
This is Q1 of 28, you will see, you will review.
Yes.
Okay, got that. Mr. Sharma, we'll leave it there. Thank you very much for joining us. We wish you all the best of luck. Appreciate your time here on CNBC.
Thank you.
Okay, well, I think that is the management of Capri with some perspective. Bino, I think you're still with us. Bino, I don't know if you heard that conversation. Any thoughts on, I don't know if you track Capri, but, NBFCs as a space is starting to do well.
In India, NBFC is a sector that is sort of a proxy for consumer demand, discretionary consumer demand. So two things that will drive NBFC space will be consumer demand and on the other side, cost of capital. We are living in an environment where there is a lot of volatility. The Middle East war, still we don't have clarity which way it is going. We don't have clarity on oil and inflation, which can have its impact on interest rates and cost of capital. So this kind of creates an environment where it becomes a little difficult to take calls on NBFC as a space. But assuming the war in the Middle East doesn't flare up, oil remains well within $85 range where it is today, and interest rates remain benign, we expect good momentum in the NBFC profit side, because all this will lead to consumer demand, discretionary consumer demand picking up, and at the same time, cost of capital remains low, which can be a great environment for NBFCs. So as of today, we are positive NBFCs, but of course the caveat is oil shooting up again and interest rates going up.
Okay, got it. Bino, we request you to stay with us for a little bit longer. We'll take a short break. We come back, we'll continue our chat with Bino. We'll also get in our technical experts. Stay tuned.
Welcome back. I think we're going to talk about the big movers from yesterday and what happened with some of these names and whether it was backed by volumes, delivery stats. Hormuz is here with that as always. Hormuz, good morning.
Morning, Prashant. And of course, can't not talk about the three big FMCG names that sold off very sharply yesterday. 60,000 crore worth of market cap combined lost between the three of them, HUL, Varun Beverages and Avenue Supermarts. Beg your pardon. And of course, there was the biggest single day fall for both HUL and Varun Beverages since March of 2020. And for Avenue Supermarts, of course, it was another fall in the month of July that the stock has seen. Even on the options side as well, the 2100 put on HUL, the premiums went up close to 350%. The 400 put for Varun Beverages, the premiums went up 250%. DMart's 3800 put option as well, the premiums went up close to 150%. So options activity was also on the higher side. Look at the volumes as well. HUL had close to 1 crore shares that were traded yesterday. The 20-day average is only 17 lakh shares. And same for Varun Beverages as well. Close to 5 crore shares were traded yesterday. The 20-day average is only 55 lakh. And for DMart as well, close to 9 lakh shares were traded, which is about 2.5 times its 20-day average. Take a look at the delivery front as well. For HUL, the delivery volumes were 5x their 20-day average. For Varun Beverages too, more than 6x their 20-day average. 2 crore shares were marked for delivery on Varun Beverages, the 20-day average being only 31 lakh shares. And for DMart as well, close to 10 lakh shares marked for delivery compared to the 20-day average of 3.5. And one other stock that was a sharp earnings reaction on the downside was Suzlon. And with the biggest single day fall for the stock since May of 2022 was down 10% after its results. In fact, the stock is down in 5 out of the last 6 trading sessions. The premiums on the 50 rupee put option almost tripled in value yesterday. The volumes were the highest in almost a month. Over 22.5 lakh shares were traded. The 20-day average is close to 22 crore shares, beg your pardon. And 6 crore shares is the 20-day average. Close to a third of those were marked for delivery. So 8 crore shares for delivery, the 20-day average of 2.5 crore shares. And as a result of yesterday's fall, the stock has turned negative on a year-to-date basis, and the recent highs that it made back in 24, which was around 84-85 rupees, the stock has almost halved from those levels.
Okay, all right. Thanks a lot for that, Hormuz. Well, Bino is still with us. Bino, I wanted your view on some of these other companies, some of the big boys, HDFC Bank, Infosys. They have not done much in a while from now, and that's a large weight on the index itself. So it's imperative that at least they stop falling. Are you all constructive on any of these names, Reliance Industries, HDFC Bank or Infosys?
Sure. Let me take this one by one. Let me start with banks. Banks as a sector is one of our top sectors. We believe there is a genuine secular growth in the economy. Valuations are not very demanding. So banks as a sector is one of our top overweight sectors. But within that, HDFC Bank may be a laggard compared to others. It is yet to come out of many of the problems related to the integration it had with HDFC Limited. Deposit growth has yet to pick up in a major way, yet to sufficiently pick up. Some procedural issues are still going on. So relatively in the banking space, we would prefer ICICI or HDFC in the private space, and maybe some mid-cap banks like Federal Bank, KVB. And also on the PSU side, the PSU banks still continue to grow very well, including SBI, PNB, etc. So on the PSU side and on the private side, ICICI, and mid-cap banks like KVB, Federal would be our picks over HDFC at this level. Let me come to IT. Infosys, we have seen a recent recovery in the stock, in the entire sector for that matter. At one point, the stock, the entire IT sector, Infosys including, was pricing in a very bad scenario where possibly we were looking at the stock stock building in sales declines, profit declines, etc., which was a dire state to build in, which is unlikely to come through. From that level, however, the stock is currently already gone up around 20% or so. So here again, the volatility related to the global view on how the AI will impact the sector will remain. But while the volatility remains, the valuations continue to be attractive. So I do not expect the IT sector, especially Infosys, to break the laws which we saw in a couple of months, roughly a month back. But from the current levels, there could be some correction. But I would look at them as accumulation opportunities as valuations are good. Even if I assume a bad scenario where growth doesn't come back for next 1.5 to 2 years, still there is value at the current valuations. So positive in general on IT, Infosys. Reliance is a bit more complicated. We have multiple businesses in there. The telecom as an industry, we are very positive. But at the same time, once Jio IPO happens, a lot of the good part of Reliance goes out. There could be a holding company discount that comes in. How the Jio IPO impacts the retail revenue part of the consolidated Reliance industry is a question. So there are quite a few uncertainties to make a clear view on Reliance at this point in time.
Got that. We take a quick commercial break here. We're going to come right back. We'll talk more stocks, sectors, themes. Renu Baid of IIFL Institutional Equities will also be with us. And of course, L&T's first quarter numbers and a bunch of other things that Renu tracks, and which is quite a bit. We'll, of course, also get you trading ideas. Stay tuned.
Welcome back. This is Open Exchange, and we are coming to you live from the CNBC TV 18 Motilal Oswal studio. Well, it's time to welcome our technical guests on the show, Sudarshan Sukhani as well as Mitesh Thakkar. Good morning, gentlemen. Good to see you all in. Sudarshan, you go first. There is this optimism that probably we're headed to the upper end of the range. Would you be in that camp, or do you think we're still going to remain range-bound? Probably there is that chance that we test the recent lows as well. What's your take, Sudarshan? How do you trade today, and for the series, the outlook?
Yeah, good morning. Well, yesterday I was a little optimistic because we had bounced to 23,800, come back and recovered from there. And my suggestion was to go long with a stop at 23,800. That view continues. It's not really optimism. It's just that the pessimism is less than the optimism. So we are optimistic. So let's put it this way, because we are still in a range. So if you have long positions, move your stops to 23,900 and stay there. If you want to take a position today, the early morning surge is often a gap up because of the series change. The new series is starting today. So wait patiently for a dip towards 24,050. Go long there. If you get that dip, your stop is 23,900. Our initial anticipation would be 24,300, which is the top of the range. If we can reach there, that would still give us a good trade.
Okay, got it. What about you, Mitesh? Are you as optimistic?
I think, good morning. One, today what will happen is that with the gap up, we will clear the 10-20 day average, and therefore, I think the optimism should be there that the recent swing high of 24,350, 24,400 zone, I think should be revisited. So in that sense, yes, that the markets might actually head towards the upper end of the range. The key here would be also to watch the Bank Nifty. I think the Bank Nifty, like the Nifty, is also slightly below the 10, 20, 30-day average. And once we see the Bank Nifty stabilize above 57,250, 300, I think that should add more strength to the Nifty. And broadly, I think the Bank Nifty could then also start heading towards 58,250, 58,400, which is the upper end of the range.
Got it. Let's get stock specific then, gentlemen. Mitesh, what are the trades you have for us?
I have all long side calls, buy calls. The first one is Mankind Pharma, a good breakout from the earlier swing highs and a sideways consolidation. This is a buy with a stop below 25.70 for a target of 27.25. Then a buy on Infosys with a stop at 1,092. Look for targets of 11.35. A buy on CAMS with a stop at 784. Here I would suggest short-term target of 8.35, and DLF is another stock which appears to have completed a pullback. That's a buy with a stop at 649 for a target of 690.
Got it. Sudarshan, let's get your picks then.
Well, I have mainly buys. I have one sell, but let's see the buys. Ashok Leyland is a buy with a stop under 155. Coforge, which has been an outperformer, is a buying opportunity again. Stop under 1650. Steel Authority sale is a buy with a stop under 160. I have one short sell, which is Suzlon, stop above 50. And but primarily, this is a more cheerful market. So stay with the longs.
Yeah, it's a more cheerful market, so stay long. Well, we'll chat again soon, Sudarshan and Mitesh. Thanks very much for that. Renu Baid is with us from IIFL Institutional Equities. Renu, good morning. Great to have you with us here as always. Thanks for joining us. Let's start with L&T. What did you make of the numbers? Order inflow, trickle. Some large, some small, but I mean, it's a steady stream. But numbers first, Renu.
Well, I would say our Larsen numbers broadly were unexciting. They were expected to be soft this quarter because of the West Asia issue. And to that extent, we saw numbers missing our estimates by about 4%. The core revenues declining, the growth was just about 2%, EBITDA declined by 2%. And overall, at least I would say on the EBITDA front, there were no negative shocks. It was just a 20 bips decline in core margins to 7%. And more surprisingly, hydrocarbon, which was perceived to be a segment where there would be more headwinds, was broadly flat in terms of EBITDA margins at 7.5%. And it was the infra margins which was weak, coming in again, pockets of weakness on domestic execution and international execution for the first time, declining in 3 years from double-digit growth to just about 2% decline this quarter. So that is where the pockets of weakness was there. And I think within segments, it was the solar business where they have quite a few projects in Middle East. And that segment has seen both a drop in terms of international revenues as well as margin pressures. But I think on P&L, broadly, numbers were unexciting. Inflows have remained strong. Company has been guiding that it would be a year of second half growth story. Second quarter, we'll see sequential improvement, but it will be a monsoon quarter. So the growth expectations will be all back-ended on the P&L side, both execution as well as margins for the current financial year.
All right, so you believe that optimism that they're talking about, that will play out, right, Renu? You're in line with what the management has guided. Are you a little bit lower?
Well, we have been slightly softer than management guidance, but we think it should play out because today the backlog that they're sitting with is significantly strong. And even last quarter, we had seen, despite being the peak quarter in terms of disruptions in supply chain in the region, Middle East region there, their execution was not materially impacted, primarily because some of the large sites in Qatar, etc., are all in design engineering phase, where actual shipment fabrication scope is limited. So to that extent, they are hopeful that in next 2 or 3 quarters, as the situation eases out in the region, they will be able to tide it through. And by the time the revenue billing comes in terms of supplies, they should be broadly on track to deliver the kind of growth that the order book is expecting to project there.
I've got that. Renu, let's talk about others as well, right? CG Power perhaps is the one which reported before L&T on your coverage universe. Large name, mixed bag. Again, I mean, what's the view here, post numbers?
Well, I think CG had pretty well held their power systems business. Margins for second consecutive quarter were 23%. And while I think the industrial segment is showing signs of bottoming out, we will see some improvement coming in 2Q as the cost headwinds slightly taper down. But for them, I would say the elements to cheer is on the industrial segment. After multiple quarters, you've seen 28% growth in inflows. And this is primarily led by the LT Motors portfolio, where company has significant cost leadership, plus the pricing is better off. And also the miss on the margins for the quarter was largely on account of a 20 crore one-off rail provision which they had, and the higher under recovery of cost coming in from semicon. But the core business numbers to that extent were fairly healthy. So I think CG, we continue to like the name. It's our preferred pick in the sector. And we think the power segment should be able to shield near-term headwinds, cost pressures, which are there from both semicon as well as for the industrial segment for them. So to that extent, we are relatively positive on the company. We expect them to grow at 25-26% earnings CAGR, comfortable in the next 2 years.
And you're keeping the faith on BHEL as well, Renu, right? I think stocks is about 400, your price target is about 500.
Yeah, I think BHEL has been executing well. They are today sitting on a very strong backlog. So for them, it is the entire story of how they ramp up on the execution, which is playing out well. At the same time, how can they improve the gross margins, which compared to last cyclical averages is still 10 percentage point lower. So sitting at 31-32% gross margin, there is enough headroom for them to expand margins. And more importantly, as the completion of the old legacy projects comes quarter on quarter, we will see the provisions right back happening. So that will release significant working capital as well as improve the operating profitability of the company. So I think from a cash profit and core business profitability, BHEL is very well placed. The order backlog is strong, where investors would be closely glued to check is incremental order inflows. Where do they come from and to what extent they're able to sustain the inflow growth momentum? That would be critical in our view to drive the next leg of re-rating for the stock.
Renu, just a couple of more names. You have coverage on, you initiated coverage rather on ACUS, right? So stocks come off. I mean, it went one way and then it's come off. Again, the consumer business, there's the aerospace business. Are valuations a issue here? What's the sense?
Well, it's a combination of both valuations, which had seen a significant run-up over the last quarter, and also in line with some of the other industrial names where there were pockets of concern that if there's a war impact, could shipments get impacted? There is a similar concern coming up in ACUS, but we really haven't seen the stock materially correcting from the 220 levels where it is today. And this is one name where we think the business is on a very strong footing fundamentally in the aerospace business. It can grow at 30-35% CAGR with 20% kind of net margins. The consumer portfolio driven by the ATP business, which is electronics, is on a multi-year growth with the largest customer, the American company with whom they are working with on the EMS portfolio. So fundamentally, the business is on a very strong footing. There are very high entry barriers. And for this kind of business and more, I think investors need to be slightly more patient. The numbers don't come every quarter, and I think the stock performance has done relatively better off. So to that extent, this is one name where you're positive. We still think it can comfortably give another 40% plus upside from the current levels. But we'll have to see how the ramp up happens over the next 2-3 quarters, and the consumer business inches towards break even by the end of the year.
Renu, you have coverage on MTAR Tech?
Yes.
That is, that's our own SpaceX. is went up like a rocket. It's coming back to earth. But, you know, from 87, almost 9,000 rupees, it closed at about 5,700 yesterday. I was looking at expectations, right? I mean, 100 crores, 200 crores, 400 crores, 800 crores. I mean, I think FY29 numbers are some 800 crores. But I think it's getting sold off because of this entire AI sell-off that we're seeing globally. But are these, if this entire thing, and we don't know, right? I mean, anything can happen. Could orders come under risk, especially from Bloom, etc.?
Well, if you look at the order book, typically the order book that they have from Bloom is short cycle business executable within the next 1 year. So the optimism comes from the large framework agreement which Bloom has signed up, and the expectation that from 1.5 2 gigawatt they can scale up to close to 3.5 4 gigawatt in the next 2 years in terms of their annual offtake. And MTAR, by virtue of having almost 65-70% wallet share in the hotbox business module with Bloom, they will also see a similar multiplier effect in terms of their ramp up. So I think in terms of order backlog mix and the exposure that they have to Bloom, we don't see any risk there. Today, as we speak, they should be having close to 3,000 crores, almost 4,000 crores of order book from Bloom Energy alone. The closing order book at the end of 1Q should be 5,000 crores plus. So MTAR has very strong visibility for next 2 years from Bloom, and at least none of the orders which are there in the backlog have the risk of getting delayed or not coming through. So I think that risk is not there. But for many investors who look at direct correl between Bloom stock prices and MTAR, will have tend to draw a similar kind of correction as Bloom also has corrected sharply over the last month and a half. So fundamentally, we think MTAR's visibility is very strong. And there is a next leg of growth coming in from the nuclear part of the business also. Where they do critical component supplies, they are well placed on refurbishment orders, which should come in the second quarter.
Got it, Renu. You know, and that's a valid point you made. I was looking at Bloom. That's corrected 40% in the last 1 month or so, and we've seen a correction here in MTAR Tech. But just overnight, Bloom Energy reported their numbers. They went ahead, they hiked guidance, and in post-market hours, that stock is up close to around 12%. So MTAR would be a stock to focus on. They have increased their revenue, their EPS estimates as well. Bloom, that normally has a bit of a rub-off on MTAR Tech. For starters, is starting off with a cut of around 3.5% or thereabouts.
Absolutely. And great chat, Renu. Thank you very much for joining us. And, you know, we went rapid fire, but very useful. Touched upon a range of stocks there. Thank you.
Thank you.
Okay, all right. Well, we've got 4 minutes to go for market open. And let's just get the trades out of the way with Sudarshan. Sudarshan, what do you have?
It's Coforge. Buy Coforge with a stop under 1650.
Okay, that's the stock of the day. Mitesh, what about you?
Yeah, I'll go with a buy on Mankind Pharma.
Okay, buy on Mankind Pharma. Let's talk about Cholamandalam Finance. And numbers came through yesterday. I think stock sold off. Ananya is here with the spotlight on this one. Ananya, take it away.
Well, yes, the numbers were good. PAT rising 46% year-on-year basis, AUM growing around 23%, while margins remain largely stable. But if you see, although the stock reacted negatively initially on the concerns over the sequential rise in the stage 3 assets, the management commentary was the real highlight here. Now, here management reiterated its 20 to 23% growth guidance, expressed confidence in sustaining AUM growth and the upper end of that range. And expects both the margins and credit costs to improve over the rest of FY27 year. Now, for the sequential uptick in the stage 3, it clarified that the rise in the stage 3 assets was purely seasonal, with no signs of incremental stress across any major portfolio, while the 2 billion rupees management overlay remains fully intact. Now, the aggressive expansion in the high return gold loan business and continued branch addition also reinforced the long-term growth story here. Now, if you look at the brokerages largely came away encouraged after the management call, with HSBC, JP Morgan and CLSA remain positive and expecting earnings upgrade, while Macquarie acknowledged that the strong operational performance but stayed cautious on valuations. And if you look at the valuations, it's pretty expensive, currently trading at 5 times price to book. So overall, a good set of numbers, but expectations are high for Cholamandalam.
Got it. Ananya, thank you very, very much. For that, stocks up about 3% right now. Just a quick recap of the stocks that we've covered since this morning. L&T, we discussed with Renu just now. Tata Capital, Ambuja Cements, they're all up on your screen. We've got Paradeep Phosphate was up 3% coming into the numbers. Numbers are strong, 4% back at about 144, 145. AGI Greenpack, Phoenix Mills on your screen. There is Suzlon, should come up, and flattish. Graphite India is down about 0.5%. Birlasoft is up about 1 1/3. And oil sensitives, oil sold off hard and then is up a little bit to about 87. Maybe just look at the IT pack as well, right? And that's the rub-off from what happened last night with Accenture, Cognizant, and the others. Maybe Infi and TCS and Coforge and those. So 4%, by the way, on Infi. TCS is up about 1 1/3%, and Coforge, etc. So IT index is up about 2 1/4% once again. So that's essentially the part of the market which is seeing short covering, some buying, basically gathering attention after what's been a pretty tough year all through. Many of these stocks, by the way, as far as IT services go, are coming back into the green on a year-to-date basis. For the first time, they're coming back into the green. But they're up from being down 10, 15, 20%. Well, I think we've got the first rate starting to come up. It's a good start. It's up 0.8%. 24,190 is where the Nifty is right now. The Nifty Bank is up 0.45%, 56,990. You've got the small cap index up 1/3, and I think you've got the mid cap index, which is also up about 0.5% or so. So this is, a pretty decent start all told. And just straight off, we should look at the Nifty IT. I think it's up 2, as the pre-open was indicating, 2.5 now. So and maybe just a bunch of these IT stocks at the bottom, like we're putting up the banking gainers. We'll do that for IT as well. TCS is up 2, Infi is up 4, and I'm sure HCL Tech and Tech Mahindra and Wipro and the others, of course, all will be up on your screen. The Nifty heat map should come up. It'll be IT, of course, on the winning side, but what else? There is, I can spot Lever there, which sold off hard. L&T, of course, is coming up with gains. Bajaj Finance has been doing well for the last few sessions. So yeah, that's the winners list. About 36, 37 names are in the green, and the rest are lower. Power Grid is down. Indigo is, is lower by a little bit. Coal India, Maruti are some of the others which are coming up. So 185 points on the Nifty, 24,170 on the index. Nigel.
Well, the stock that Ananya spoke about, Chola Investments, that one is flying away in today's trading session. It's up 3.5%. It ended at the day's low yesterday. Today, that stock has bounced back, so it's up 3.5%. Tata Capital, another stock that's done well, that as well is up close to 3%. The big boys are leading. L&T is, one of the top gainers on the Nifty. Mixed quarter, but the path ahead seems to be what the street is latching onto. So that's why that stock is higher. And also, you have Infosys from the tech pack. That's the big boy in there. That's leading the way. Varun Beverages, yesterday the stock sold off. Many believe that maybe, in fact, the reaction on the downside was a little bit exaggerated. For the starters, the stock opens up in the green with a gain of around 1.5% or thereabouts. HUL, similar is the case. That one as well ended at the low point of the day. But today, that one as well is pulling back in trade. Paradeep Phosphates, 3.5% higher. Big volumes out there, stock flying away as we speak. So, pretty good move on that particular name. On the flip side, HFCL is a stock that's a little bit lower. That's down close to around 3.5% or thereabouts. So some kind of selling is what we're seeing on that name. City Union Bank as well is down 2.5%. Another big mover in trade yesterday. And MTAR Tech has started off with a cut of close to around 3.5%. It's pulled back a little bit from the lows. It's still down 2.5%. Remember, overnight, Bloom Energy went ahead and they've increased their guidance. And that's why Bloom Energy, which sometimes has a bit of a rub-off effect, that one, in fact, ended higher in post-market with a gain of close to around 10%. A stock that's corrected close to 40%. For the time being, we have, MTAR Tech that's still under pressure, 2.5% lower. Keep an eye out on KPIT. I think we should get that stock up for you on the screen. There are close to 40 lakh shares on the BSE that have traded, changed hands. So 40 lakh shares, that's a large trade that we're seeing just in the first few minutes of trade. So interesting to see the parties we get out from there. But that looks like a sizable move on that particular name as well. Now at the high point of the day, but a large trade has taken place.
Okay, all right. Nigel, thanks for that. Well, let's broader markets and what's happening with KPIT.
Results today as well for KPIT.
Results today, yeah. I saw this True Alt at the bottom of the screen, or was I imagining it? There was a stock which came up, and we'll put that on back on. Kenneth Andrade is with us. He's founder and CIO at Old Bridge Asset Management. Kenneth, good morning. Good to have you with us here. Thanks very much for being part of the program today.
Morning. Good morning.
So yeah, I mean, it depends on how you're positioned and where you're at, because what's done well continues to do very, very well. And what's not done well perhaps is starting to do well. But it's a market, it's a very inclusive market, Kenneth, right? Very, very, I wouldn't say forgiving, because bad results are getting punished, but the market is willing to bet on turnarounds, things going from bad to maybe a little better. So it's that kind of market. What have you been up to, Kenneth?
Well, not too much. We got a portfolio which is pretty much static over the last couple of quarters. I think fundamentally there are some omissions that we have in our portfolio. One is obviously technology. Second is in finance we're not equal weight, or in the lending businesses we're not equal weight with the market. We're significantly lower than where we are. We like a little bit of manufacturing, some part of the older economy that is out there, commodities. Those kind of businesses that are predominantly across our portfolios. There's a little bit of discretionary consumption also out there, mostly automotive, automotive distribution, and some one alcohol business, which is also, I mean, that entire space is doing extremely well.
Manufacturing, automotive, is it? I mean, you want to talk names because this is published portfolio, right, Kenneth?
Yes, so we are across the board in all our portfolios. I think we've got Maruti, Tata Motors, and Mahindra's. The latter two are reasonably low, but these are all in the passenger vehicle segment. A couple of automotive ancillary businesses, Ramakrishna Forging, Balkrishna Industries, that are there. So that spans. I mean, we don't run too many companies. I think we have 40 unique stocks out there. And of those 40 unique stocks, these are about 6 companies that are predominantly across portfolios. Of course, to complete that entire complete the entire chain, we've got a couple of lenders which are exclusively on the automotive space, which are the NBFCs.
So Maruti, Tata Motors, Mahindra, OEMs, Ramakrishna Forgings, Balkrishna Industries.
Yeah. So if I step back a bit on and take the names out of this entire conversation, it's probably one of the industries that is going to see a profitability of the business increase probably significantly or move faster than the overall marketplace itself. You've got utilizations, right? You've got demand coming in reasonably strong. You've got financing, which is also available, and that part of the market's doing well. And to top it all, some of these companies are seeing reasonable amount of traction in the international market. That includes the two-wheelers, which we don't have at this point in time. So things are working pretty much well for them. They're cash generating. Most of them are positive, except for one of the companies, which is Tata Motors. He's struggling with his international business, but they tick most of the boxes in terms of where the business is currently aligned with probably the broader part of the market.
Yeah. I got that. So that is one part which you like. The other one, right? Alcoholic beverages that you said. Which is the one? Radico.
Yeah.
I see. And I mean, all the business, we had Radico earlier, we had Tilaknagar yesterday. I mean, that space seems to be doing very well. At some point, I guess the big boy United Spirits will also catch up.
From a company's perspective, I mean, from a stock perspective, I think that entire space is on a roll. Each individual business, I mean, it's a category that's doing well. I don't think it's got to do with any particular business out there. Of course, there are some companies out there that are taking a dominant part of the market share.
Yeah. Which was the financial services name you said? I mean, in the auto space?
We got a little of, I mean, Shriram is a dominant part of the portfolio. It's been there for a while. And M&M Financial is there also in one of our portfolios, which is a reasonably smaller part of it.
Okay. Right. You said you got 40 names, right? These are well-owned, kind of understood businesses in that sense, I dare say. But any really unique names, which, these are the ones which are sort of, across your portfolios, right? But anything we don't talk about very often as unique opportunities, Kenneth?
No, nothing very specific. See, it's not really a market where there's too much of discovery happening. They're not, and if there is a discovery, the valuations are not really in line with where we feel we need to be. So from a market standpoint, it's very fairly priced. I don't think it's a market that's going to award you for too much of adventure. Okay, and if it's not going to award you for too much of adventure, there's no point in taking some off the cuff bets. If companies are small and they are and they are struggling, there's probably a reason why why it is the way it is. So I think from a standpoint of where we are and how we need to approach this entire market is be a little bit mainstream. And try and pick well-established businesses, because a lot of market share is now migrating towards these companies. I mean, whether you go into the aviation space, whether you go to the automotive space, whether you go into the distribution space, or even in the FMCG broader market, I think the bigger guys are getting reasonable amount of market share, and I think that's where. And that's where you need to necessarily be aligned. I'm not too sure if this is a market, or I think the way we approach it is this is a market where I don't think adventure is going to pay off. Being adventurous is going to pay off in the near term or even in the medium term.
Hi, Kenneth. Good to see you again. So we spoke about Daru. Let's talk a little bit about Dava. In the pharma space, I think you're positive on Oro Pharma, if I'm not mistaken. They did that inorganic growth. The street had a mixed reaction out there, but the stock has done quite well, post that news getting digested. And I think on the healthcare and services business as well, MediAssist is something that you all have been fairly optimistic on. You can correct me on that.
So pharma as a value chain has been with us, as a portfolio holding has been with us now for over the last 3 years, ever since we started off the asset management business, and sometime before that also when we ran the managed account business out there. Our focus is essentially on companies and businesses who have invested reasonably well over the course of the last 5 years. So now when you have your investment behind us, so if you look at our entire portfolios, a significant part of our portfolio is manufacturer led. It's got a global footprint and not just a domestic footprint, and most of this is addressing what we think is coming up in terms of a patent peak. Now that's a sizable opportunity which is out there, and that's also feeding into some of the R&D businesses that are there in the domestic environment. So all put together, I think it's another space. So automotive is one. Second is what we believe is pharmaceuticals. The profitability of that industry probably or most likely by 27, 28, 29 should be significantly higher than what the broader market profitability growth will be. Okay, on the last one that you actually mentioned, it's a small holding. We're just getting to know the business a lot better. But it's a dominant position, 60% market share. But it's in a very niche space. So it's linked to it's linked to the health insurance market.
Yeah.
The larger that market gets, I think with a dominant position, he does have an incremental amount of pricing power.
Yeah. No, I mean, I think they bought Paramount, right, which was pretty dominant down south, which is also a TPA. And as you say, they're dominant. But I've looked at this a few weeks back and was just wondering, why is this not gone anywhere? It's kind of been absolutely ignored, right? I'm not sure if there's a specific reason.
It's not really, there's no specific reason for this business to be where it is. But like any company or any business that is out there, the minute you get into an investment cycle, I think your near-term capital efficiency actually falls off. So if you look at this one name, it's gone into a near-term investment cycle. It's been building up market share. It's going through acquisitions. And in a phase like this, your capital employed grows faster than your profitability. So your near-term ROEs and ROCs or your financial metrics don't look the best. So I think it's just about investing and being patient about it. So if you build a portfolio of companies, stocks, and industries, these are cycles that you go through, and at points in time you've got to be reasonably patient in some of these names.
All right, Kenneth, I think Kaveri Seeds, that's the other stock, right? That you'll have liked for a while. Off late it's been a little off color. You'll continue to maintain that positive stance, and what are the triggers for the company going from here on?
It's largely got to do with an industry. It's got very little to do with. It's largely got to do with the industry. The company's got the portfolio right. Just the marketplace is not expanding. Also, from a regulatory standpoint, there is a cap on a couple of its products in terms of pricing. So all put together, it's a market which hasn't grown in the last 10 years. If I put the numbers together, from a volume metric, it's not a market that has grown significantly. I think the broad GDP growth rate is significantly higher than this one small category that is out there, and I think that's the problem with this business. So if I had to approach it a little differently, it offers a lot of value, but there's very low sign of this industry breaking out significantly in terms of size and in terms of size. I think that's where that's where this industry is actually that's where it's stuck.
Okay, all right. Kenneth, we'll leave it there. Thank you very much for joining us. It's a pleasure and always good catching up. Appreciate your time. I just want to quickly make a mention, 200 points, by the way, 24,186. And it is the Nifty IT Services Index, which is continuing to do very well. It's looking much better overall as well. It's about 2:1, the opposite of the declines to advances ratio. Advances to decline about 2, actually much more than 2:1 at this point in time. But well, we have Nigel, the management of TTK Prestige waiting by.
Well, that's right. TTK Prestige delivered a solid set of numbers in Q1. It was one of the stocks of yesterday. The revenue growth more than 30%, driven by robust domestic sales. Growth was more or less broad-based across categories, led by induction cooktops for the industry as well as for the company as well. However, higher commodity prices across the raw materials, that's what could be on margins in the path ahead as well. To help us out with what's the outlook, we're joined by Mr. Venkatesh, the MD and CEO of TTK Prestige. Hi, sir. Good morning. Thanks a lot for joining in. Well, what a solid start to the year. Street would like to understand, how are the trends shaping up? Was it a flash in the pan, that is Q1, the kind of growth that you saw close to around 30%? Or have you seen that momentum sustain in this quarter as well? For the year, what kind of growth are you looking at?
Morning. Always a pleasure to be on this show. Yeah, it's been a good quarter. I think the quarter has been sort of capped on top of a good quarter that we had in Q4 as well. The market momentum has definitely been positive, driven by some of the global uncertainties which made people move on certain. Initially, it was certain panic buying that happened, but I think over a period of time, we're seeing this sustained purchase patterns, mostly across appliances and across some of the cookware categories as well. So it's a trigger that is sort of auguring well for the industry and definitely auguring well for Prestige as well. We do believe that such magnitude of growth may not be sustainable, but I think there is a very positive wind in terms of the growth for the year, and that's something that I would look forward to.
Okay, all right. So for the year, what would you like to guide then? If this sort of momentum...
I wouldn't want to sort of put a guidance on the picture at this point of time, but it would be definitely positive in my view.
Should at least a broad range, sir. If not 30% plus, do you think 20 to 30% is doable? Since you're off the mark in style, Q2 towards the end of the quarter, you'll have demand coming in because of the festive season, and you have part of it that will come in Q3 as well. Given those sort of trends, do you think a broad range of around 25 to 30%, 20 to 30% should be doable?
No, I would say that it would be closer towards 15 to 20%. The industry should see 15 to 20% sort of growth happening.
Okay, and are you growing faster than the industry?
Our endeavor is that of the last few quarters, we've seen our market shares go up. A lot of our initiatives over the last 2 years in terms of internal transformation, go-to-market initiatives, premiumization agenda, they've helped us. And we do believe that we are growing faster than the market. And that's something that we would continue to keep in our focus.
Okay, I just want to talk about one segment, which is the cookware segment. the GST rate rationalization, how has it helped you all? The hope was that from the unorganized, we'll see a lot of move to organized. What is your analysis of the same? Have you seen something on ground?
Yeah, so cookware is seeing two good trends, and this seems to be continuing for the future as well. One trend, like you said, is unbranded to branded. That's happening at the lower end of the price point segments. And that's a large segment as far as the Indian market is concerned. The second, as we've always maintained, we're also seeing a lot of upgrades that are happening to the top end. So the market in cookware today is seeing both. There's an unbranded to branded, and there's also an equally good quantum of growth happening because of value upgrades that are happening. People are now upgrading and sort of quickly changing their portfolio. The replacement cycles are increasing faster for cookware, and that's helping. So I would say both the ends of the spectrum, the top end as well as the bottom end, both ends of the spectrum are growing faster for cookware today.
Mr. Vijayaraghavan, good morning. And Nigel said, ask you, is it a flash in the pan? I thought it was pretty. Obviously, you're saying it's not. So this is just a quick word on, so 15-20% growth. Closer to 20 or closer to 15, Mr. Vijayaraghavan? Would you want to
I wouldn't
nudge us one way or the other?
I wouldn't want to put a number to it today. I think the industry trends look like as if demand continues to be at the rate at which it is today, it should stabilize at that. As far as we are concerned, we would love to grow much faster, and that's an endeavor as we've entered into the last few years. I wouldn't want to put a number to it at this point of time.
Margins closer to 9 or closer to 10?
Sorry?
EBITDA margins closer to 9%, sir, or closer to 10%?
So we would sustain these EBITDA margins because we continue to have some investments, both soft as well as in terms of some of the infrastructure-related investments that we have. We would continue to have this range, but over a period of time, these investments should bear fruit for us. We would sustain this level of EBITDA and probably take it forward.
Got it. How's the market shaping? I mean, you were still, of course, organizing the unorganized market. That is still a big shift which is underway. But there are, at the top end, right, is there a fair bit of innovation happening? I was talking to this company which has received funding. I mean, they make basically cast iron cookware, right, at the very premium end. Lots of these kind of companies I was not aware of, I was made aware of all of this recently. I mean, is that where you're going as well? Is that the top end, absolute top end?
Our absolute endeavor is to make sure that Prestige is a brand which operates at the top end of the market and has a significant premium over the average of the market that continues to get premiumized. Like I said, opportunities in cookers, cookware, appliances are coming in across the value segment, and a lot of the urban markets are upgrading today. That premiumization, I think, is the focus, the prime focus for us, for Prestige as a brand. While we continue to drive the lower end of the market with our distribution initiatives, increasing our reach in the Tier 2, Tier 3 towns, our primary focus is on premiumization of our portfolio. And that's what is actually the anchor of our growth right now.
Okay, all right. What about the international operations? Smaller part of business, but exports got impacted and UK subsidiary as well was under some pressure. What's the outlook on that front?
Yes, exports has been under pressure, and that's primarily because of the logistics supply chain related interruptions that continue to happen intermittently. So we do believe that as some of this stabilizes, the export should pick up. We have orders, we have demand, but we're not able to fulfill the demand. And that's something that I think would hopefully get sorted out in H2.
Okay, all right. There was this destocking cycle that took place post-COVID. Has bulk of that already taken place now? And now are we getting into a better zone for the industry as well as for the company?
There is a little bit of destocking that would happen. The quantum of growth that we are seeing today, like I said before, that's not a very high sustainable growth. There would be a little bit of moderation that would happen. A little bit of destocking should happen in specific channels as well. But our internal MIS and the way we looked at our market, I think that phase is already in track, and that should sort of get moderated over Q2.
Okay, all right. Just to get further clarity with regard to that move from unorganized to organized, if you could help us out with what is the broad number? What was it, say, a few years ago? Where is it? And you expect the trend to continue for the industry on the whole?
So that market, I would say, is equally growing faster today. If it was growing at the band of 6 to 7% earlier, today I think that market probably is growing at around 12 to 15%. So that's a sort of a jump that's happening in the bottom end as well. driven by increased penetration, like I said, of products into Tier 2, Tier 3, driven by some of the e-commerce opening up of the Tier 2, Tier 3 towns, and of course the structural changes that are happening that are making brands more viable and brands more attractive today.
Okay, Mr. Vijayaraghavan, thank you very much for joining us. Look forward to our next conversation. Stocks, by the way, recovered. It was down 4%. It's come up from the lows. I mean, it's done phenomenally well. Was about 450 rupees not very long back, and has come up very nicely to about the 700 rupee levels. Started 4% lower, is back in the green at this point in time after the commentary. Well, Tata Motors passenger vehicle business in focus, and I think other auto companies as well. EVs, so this is coming in from the Haryana government. Rebate of 20% on CNG vehicles will continue. That is one. But for EVs, there is, I think, something motor vehicles tax for four-wheelers up to 6 lakhs to be cut to 4% from 5% if registered in the name of a woman. Approves 100% exemption from motor vehicle tax on new registration of pure electric vehicles. 100% exemption from vehicle tax on road tax, basically, on registration of new electric vehicles. So that is what is coming through at this point in time. There is other detail as well. We'll have stood up with a proper perspective on this in terms of exactly who is affected and what is being done at this point. I just want to quickly play out one important sound bites as well. This is a developing story, but I think it's important. U.S. Senator from Connecticut has said that the key Russian sanctions bill will see India and China explicitly targeted by up to 100% tariffs. He added that the two countries are fueling Russia's war machine against Ukraine. So, as I said, this is a developing story. We don't know whether this is essentially going to, whether they're going to go ahead and, target India or China in this particular case. But this is what he said. So take a listen.
It authorizes tariffs up to 100%. The 5 largest purchasers of Russian oil and gas. It's carefully crafted to make sure we are not hitting our allies and that we are hitting China and India. Let's be really blunt. China and India are the main culprits here. They purchase the vast majority of oil and gas. They are fueling Russia's war machine, and they are doing us no favors anywhere else in the world. And you can see the effect of tariffs by the recent history here.
We've seen this story before. This was, it was 100% tariffs earlier, and then that basically was, that went away. The 100% tariffs were, the penal tariffs, so to speak, were taken off. And then there were earlier this year, the deal was being negotiated. The rate, which was, I think, was 18%. Then, the U.S. Supreme Court took away the AIPA tariffs, that they were invalid. And of course, now we are back to where we are at. So this is a new development in that sense. I mean, I would have thought that this is now behind, but this is perhaps something to watch out for. A developing story, we don't know, but just wanted to make you aware of what's happening. We'll take a break. We're back. More companies on the other side. City Union Bank after their quarter on the other side.
Welcome back. Well, just a couple of stocks to highlight. KPIT, that stock saw very, very large volumes, as I pointed out earlier, just in the first few minutes of trade. And that one, in fact, is moving with a decent amount of volume as well. So we'll keep an eye out on that. 40 lakh shares got traded earlier. We have the numbers later today. Let's see how much of the bad news is in the price. So that's one stock. The other one is TIL Limited. It's a smaller company, 2,000 crore market capitalization, but there was a very large trade that took place in the first few minutes of trade itself. So TIL, there was a trade that took place at 215 rupees odd. Interesting to see who were the parties out there, but the stock has recovered considerably from the lows of the day. So maybe we'll wait for details on that trade as well. But let's focus on the banking space. City Union Bank reported a strong set of numbers in Q1. Healthy profitability, improved asset quality as well. Management has also said they're very confident on the asset quality going ahead, and they're expecting recoveries to outpace slippages in Q2. Well, to discuss this as well as what's the way ahead, Mr. Vijay Anand, the Managing Director and CEO at City Union Bank, joins us on the show. Hi, Mr. Vijay. Good morning. Good to see you in, sir. Thanks a lot for joining in. Well, a good quarter. The street liked it quite a bit. Give us some guidance then. Let's talk about your NIMs, because the cost of funding is a bit of a worry for most financial institutions. Your NIMs declined a wee bit by, I think, close to around 10 basis points or 9 basis points. Could you tell us what is the outlook on NIMs? Can you defend these margins? Because cost of funding is going up.
Good morning. Thanks a lot. I think we had a pretty decent Q1.
Yes.
As you rightly said, we have already confirmed that NIMs might drop by another 0.5 bips for the next quarter. The first quarter, we could get the repricing and we got quite comfortable. Probably Q2, we will have some NIM drop. But for the overall year, we are pretty confident of somewhere between 3.65 to 3.7. That's a number which we are envisaging for the year. Q2 could be a slight drop, but I think we can catch up comfortably in Q3 and Q4. That's the NIM probably we are looking at.
Okay, got it. All right. Also, your gold loan branches, I think that saw a good increase, right? If you could tell us what are the targets you're looking at in terms of contribution from gold loans, and how's the competitive intensity? Because, a lot of financial institutions, a lot of banks as well have turned their attention to this segment. Please go ahead.
So, you're right. We had 800 branches. Today, as we speak, we have 1,000 distribution center. Out of that, predominantly 250 to 300 branches we have in semi-urban and rural. And if you see, the gold loans are being distributed only from our bank branches. So I'll have to split it, gold loans into two, agri and non-agri. Agri, I think we are very, very comfortable. We have the passion to do agri gold loans. Typically, we fund for the farmer who wants for harvesting and taking the finished product to the mandi. We are 100 bips lesser in agri, and non-agri is something which the customers today prefer if they want the immediate funds. So with respect to gold loans, we are currently at 31% of our book is gold loans. We continue to be around the same. 31-32% should be our gold loans mix in our product book. And the competition intensity is there, but we have a separate market. We have the set of customers who walk into the branch, pledges, and we could give the immediate service. I think that focus will continue, and we are pretty confident of this growth in gold loans.
Okay, all right. One positive is that the recoveries, they continue to exceed the slippages, for the 10th straight quarter. Do you see this sort of a trend to continue? And also, if you give us a number on the slippages number, what should it look like for this fiscal year?
It looks like even this quarter, the recovery should surpass the slippages, as I have mentioned yesterday in the commentary. Yeah, this year we are looking at the same rate, 700 to 750 crores. That's a slippage number we are looking for the year. And we are pretty comfortable. Broadly, recovery surpassing slippages should happen in Q2.
Got it. All right. At the book, on the whole, what should it grow like for the year? The credit growth, if you could help us out, and also the deposit growth, if you could help us out with both those two numbers. And on the credit side, give us some clarity. SME, I think, was a little bit slower for you in the first quarter. How do you see that trend shape up from here on, and what will the drivers be?
So, I think the MSME growth, as we said, we are pretty confident of 2-3% more than the system growth. We don't see an issue, and we are pretty positive on MSME space, because when we meet the customers, we had in a textile paradise last week, the customers were pretty confident of the growth, and the recent agreement between India and UK, FTA, is making Europe agreement on FTA is making a big demand for the textile space. I think they are quite confident of the growth as such in MSME space for the year for sure. And with respect to MSME growth, we are 2-3%, and gold loans should be 32% of our book, as I said before. Deposit is something which we always manage with CD. We are quite comfortable with the 85 to 80, though our LCR is 150, which you should be aware. We are pretty comfortable with 85 to 86 as LDR. So we should be comfortable on the deposit growth with 85-86% per se, whatever the asset growth which we are doing.
And what about the CASA? The CASA slipped a little bit more. It's come down to, I think, 26%. What are the trends you're observing on this front, if you could help us out? And also on the cost to income, that I think is around 48%. But you have been guiding that number slips down a little bit. So where does that stabilize at, maybe by the exit of this fiscal year?
So two questions. Okay. CASA is something, if you see, we have started tracking on average CASA. We are really not keen on getting the terminal CASA, where I get the money on the last week of the quarter and move out on the first week of the next month. We are not keen on that. So our branch focus or our KRAs are really more towards average CASA. If you see our average CASA for the last quarter, we have grown by 22%. Average CASA is something which we are really focusing than the CASA for the terminal numbers. I think our focus on average CASA continues to be robust, and we want it to be somewhere between 22 to 25%. That's a number which we are looking at in average CASA growth. Sorry, what was the next question?
Cost to income, sir. You wanted to answer that as well.
Cost to income was pretty good this quarter. We closed at 45.5, but we have already said that we would be in the range of 47 to 48 for the year, because our hikes are normally in the July month, where we will be releasing the hikes. So staff expenses should go up typically from July 31st. Though we have closed the quarter at 45.5, on a year we are looking at 47 to 47, 47, 48. That's the number we are looking at.
Final question, sir. Street actually liked your numbers today. It's come in for some profit taking. That's in terms of a stock price move. But return ratios is what the Street tracks very closely. And I think you were guiding that the ROA perks up a little bit. What is the range? What is the target you're looking at on the ROA front? Because that's how you'll get, the valuation, the multiples as well.
So ROA for the exit ROA for the year, we are looking at somewhere between 1.6 to 1.65. That's the number which we are looking at.
And currently it's around 1.5?
We are at 1.57 when we close this quarter. We should exit at 1.65 for the year. That's it.
Pleasure having you on the show, sir. All the very best. Thanks for giving us those details. We did a quick con call now, a quick revision of all your numbers. We'll hold you to them and we wish you well.
Thank you.
Okay, well, that's the conversation with City Union Bank at this point. Let's move on to another company in the financial services space, but a very different kind of company now. Pine Labs management is with us. Stocks up on your screen, down about 2% or so. Let's understand what happened in the quarter. Samir Kamath, the CFO of the company, he's with us. Samir, good morning. Good to have you with us here. Thanks for joining in. I just want to start by a couple of things, right? Digital infra growth came in at about 15% or so. I think this is lower than what many out there expected you to do, much lower. What happened?
I think, look, we are building this business for the long time, Prashant. I think the business does have certain cyclicalities, but if you look at it from a long-term perspective and look at the key parameters which are driving growth, one is the infra rails on which we actually monetize GTV and grow our business. The infra rails, which is the entire POS devices, actually grown at about 18%. Within those sub-segments, the areas where we are monetizing, basically now that we have laid the rails on the business, we are actually imposing a lot of other ability to monetize that GTV through affordability solutions, through DCC and aggregator solutions, and building a full stack across the merchant ecosystem, right from acquisition to retention. I think those flow-through businesses will come through these rails. I think overall, I would say it's in line with what we've been guiding. I think overall, as a business, we have grown at 20% because the businesses that we are building are across the payment stack, the processing stack, the credit issuance.
Samir, so within the digital infra segment, as you said, there are sub-segments, right? The in-store payments is about 30% of the business, right? I think that's a big one. What was the growth there? What was the growth in this?
See, I think, Prashant, what we've always told the street is the rails of the business have been laid out across the large mid-market and enterprise segment. That business will grow at about 10 to 12%. Okay. What is really driving the growth is what comes on top of those rails. And those businesses have grown at 20% plus. And that's why I was trying to give you that split, that the rails business has been laid out. Now it's about monetizing the rails. So when you look at it on a blended basis, it does look at 15%. But if you sub-segment it and look at it from where the growth comes and what the incremental directional growth for Pine Labs would be, then that would become a little more clearer.
The online payment gateway checkout business, what was the growth there? Because that grew some 50-55% last year.
The online payment business actually does two things: the pure payment gateway business and also affordability, where we almost drive close to about 3,000-4,000 crores of volumes on an overall basis. I think that generated.
So, I think we're losing the link there with Samir.
Yeah.
Yeah, go on, Samir. You're back. Go on.
So the online business has been growing at about 20 to 30%, where we actually look at both affordability and the payment gateway business. As you've seen in our earnings deck as well, we have won a lot of new counters. On the e-commerce side, we're exclusive with a lot of large merchants which are looking at affordability solutions. So that's a big growth driver for us going forward.
Okay. Got that. Now, talk to us a little bit about margins, if you will. Contribution margins are down 100 basis points, right, to about 72% or so. Is this because of any business mix change? Is it that, I mean, one thing I noticed that the distribution business, that's a low margin business, has grown faster. Is that the main reason?
So let me explain that context, Prashant. I think that's largely to do with our prepaid business, where we're almost about 80-90 market share presence in India. And now we are building that to scale in international markets like Southeast Asia, Dubai, Australia markets. Now, if you look at this business, we are providing an integrated solution for acquisition of customers and retaining of customers, which means brands are looking at wallets and gift cards for attracting customers and doing repeat business with them. Now, two things are important in this business: processing of these cards, which is the base level core infra system, and having these cards in the hands of people. Now, we provide an integrated solution, and our go-to market is first to build a large distribution reach so that we become large and relevant in terms of distributing, and then having a larger processing business. In many of the international businesses where we have been saying over the quarters, we want to build our distribution to build relevance, and those businesses come at a low contribution margin, but the flow through to EBITDA is much better, and therefore it's more of the conscious strategic business mix change versus any compression of margin, so to say.
All right. Hi, Samir. Good to have you on the show. You've indicated right in the past you've not shied away from acquisitions, and that continues to be on your radar. In quarter two, should we hear something about it? How large will it be? If you could give us a geography that you're looking at.
Look, I think we have built our businesses organically and inorganically, and I think we are into an ecosystem play. We started off as a payment tech company with point of sale. We've been able to monetize it across GTV, and now we have a full range of solutions across acquisition to kind of engagement, both built organically and inorganically. This year, this quarter, the earlier quarter announcement of Shopfloor, we concluded this quarter. I think we've already seen 400 crores worth of GTV coming through the Shopfloor acquisition, which kind of tucks in well with what we're doing on the online side as we are speaking. Look, we will remain open to opportunities. Nothing on the anvil which I can report to you right now, but what I would say is that there is a lot of growth opportunity in the international market. We are building to scale there. We have done a large partnership with banks, and I think we continue to remain open to growing our business in the direction and trajectory that we've been guiding earlier.
But the rough size of the acquisition?
We don't have anything as of now. I don't. I think
But it will mostly be overseas.
I mean, it's open. I think, as I said in the past as well, our acquisition focus is more driven by either a great product stack, like what we have done with Shopfloor, or a market access, because we are going in international markets. But obviously, we will come to the sheet if there's something. As of now, there's nothing to report.
Right. Samir, you did 113 crores in profits last year. What should we expect this year?
Look, I think, Prashant, last year when we went to the market, there was a clear direction that we will turn PAT positive, and we've been able to deliver PAT positive for each of those 4 quarters that will come out. I think the first quarter of this financial year, we've grown 4x in terms of profit from 5 crores to about 20 crores, driven largely by what we have been saying, that the business mix towards monetizing the GTV and growing international markets is going to drive that growth. I think we continue to remain positive. I think we have given a guidance of revenue growth. I think we will kind of be on that target. 20% comes very close to that. We have seen certain upfronted investments because a lot of work we are doing on AI, which is more towards data, cloud, and network charges. But I think those are costs that will bear fruit in the future. I think we remain extremely confident about the growth prospects of both top line and the bottom line. And I think that trajectory will continue.
Got that. We'll leave it there, Samir. Thank you very much for joining us. Good speaking with you. All the best.
Thank you, Prashant.
Execute. Thank you. Okay, I think we are looking at the market, which is still holding pretty rock solid, right? I mean, we've got 24,200 on the Nifty. We are up 200 points and looking good. 3:1 in terms of advances to declines ratio. Najib.
Yeah, a few stocks actually from the broader markets, some of them big underperformers as well. SH Kelkar, I think it came out with its set of numbers. That one had a lot of promise, and then, all that promise just went away. That stock is now up 15%. I think the numbers came. Big one out there. Jupiter Wagons is another stock that's moved to the high point of the day, so keep an eye out on that one. And Paradeep Phosphates as well. The stock had come out, the numbers had come out overnight, and that one, in fact, as well, is flying away as we speak. Paradeep Phosphates should come up for you on the screen. But Manipal Health Enterprises, they are 9,275 crore IPO opens. The offering comprises of a fresh issue of around 8,000 crores, and the remaining is the offer for sale. Ekta joins us to run us through all of those details. Ekta, a big, large offering from the sector that you track.
Well, yes, 49 hospitals, India's largest private hospital network by licensed bed capacity, and India's second largest, highest revenue amongst private hospital chains. That's Manipal for you. 8,000 crores via an OFS is what they're looking to raise, and the rest would be around via a fresh issue of around 8,000 odd crores, and the OFS would be the remaining around 1,275 odd crores. The price band is 560 to 570, and it opens today up till July 31st. Now, just in terms of the use of the proceeds, the total 8,000 odd crores, there would be a debt payment, a repayment of around 5,500 odd crores. They will be buying remaining stake in one of the acquisitions that they made, which is basically Sahyadri Hospitals, 574 odd crores. So the total debt on books is around 11,185 crores. So they would be pairing off around 47% of that debt. Now, if you look at the revenues, for FY26, they closed at around 10,300 odd crores. They had a profit after tax also, which was quite significant this time round. And the EBITDA margin pre-exceptional was at around 27 odd %. Now, remember that Manipal has been very focused in terms of acquisition. So, for example, they've made around 5 important acquisitions just in the past couple of years. This includes Columbia Asia in FY22, which is quite an important turnaround story, AMRI Hospitals, Medica Synergy, and now Sahyadri Group, which basically improves their presence in the west part of India quite significantly, and that took place in October of 2025 itself. Now, in terms of the occupancy, stands at around 67 odd %, the RPOPs at around, above 60,000 rupees as well. Now, if you look at the valuations, it's very similar on an FY26 trailing PE basis to what the others are at this point in time. So similar valuations in terms of a PE basis. Now, the key important points, they've already raised around 4,167 crores via anchor investors. They will be net debt zero post the IPO fund infusion. They are looking at M&A, especially in the Delhi and North region. They have a Juhu hospital, which they would be launching in around 18 odd months. The Sahyadri margins is something that they look to improve going forward. Price regulation remains a key risk, and importantly, Temasek is here for the long run. They're not looking to exit Manipal anytime soon.
All right. Thanks very much, Ekta, for that. That's the new hospital company coming to the market. Well, let's shift focus to what's happening as far as Sensex derivatives go at this hour. Mangalam is standing by. Mangalam, take it away.
Well, it's Wednesday today, and that means that we're one day ahead of the Sensex expiry, and it's been a strong start to trade today. This Wednesday morning, a near 700-point up move is what we've seen, 750 points on the Sensex. And having done that at open itself, it's crossed past the 20-day moving average On the Sensex, the 200-day moving average stands at around 80,000. Remember, the key drivers today have not been very different from what we've seen earlier. IT pack, that's done well. So the BSE IT index is up over 2.5%. And today we have some support coming into the metals pack as well, which is up around 1.7%. Now that the Sensex has moved towards that 78,000 mark and above the 20-day moving average, the option writers are fairly active. We've seen some put writing at 77,500 and 77,400, telling you that there is strong support that the street is expecting around the 20-day moving average, which is closer to 77,250 thereabouts. So the 77,400 put and the 77,500 put, fairly well written. These are options that expire tomorrow. Also on the way up, however, we are still seeing some writing at 77,800 call and the 78,000 call, telling you as we move towards 77,900 to about 78,100 on the Sensex, there may be some sort of supply that will come by. So, I mean, the range that the street is playing for is 77,250 at the lower level to 77,900 to 78,000 at the upper level.
Okay, all right. Mangalam, thanks very much for that. We'll take a break. Manisha joins in with a focus on what's happening in commodities, coming right up. Okay, welcome back. Markets, of course, are looking good. Equities, that is. What's happening with oil? Manisha standing by with that. Manisha, morning.
Morning, and thank you for that, Prashant. The last 3 days, we did see 14% of a decline in case of crude oil prices, but today in the Asian markets, it's quite a jump. We are trading nearly 4.5% on the higher side for the crude oil prices, and with that, it's back to near that $87, $88 a barrel, 4.5% even now for the Asian market, so it seems to be holding right now. Well, there are 5 or 6 things that the markets have seen overnight, and that clearly seems to be supportive. To begin with, it is a U.S. CENTCOM statement which says that there is a surprise Iran attack on U.S. Air Force bases in West Asia, and that there have been nearly 30 drone attacks therein, and all missiles have been intercepted by US right now. That tells you that even as there were no statements earlier for the last couple of days, but now with this happening and a statement coming in, it clearly seems to be collapsing in sense of true stock there. The second thing is about the Strait of Hormuz. While Iran has rejected Oman's proposal for a shared 50-50% control, what Iran clearly has said is that they are looking at managing its side of the strait completely, and they are demanding complete authority when it comes to the inbound shipping lanes therein. The third thing really has been about Houthis and the Red Sea and the attacks that we've seen on Saudi oil facilities and Saudi tankers within that region as well. So Saudi Aramco has temporarily right now shut 400,000 barrels per day when it comes to its Jazan oil refinery therein. And then it is about Yemen's Houthis on Bab al-Mandeb. They have seen straight fire ballistic missiles at Saudi tanker where they're in. So whether it's on sea or the Saudi oil facilities, both of that seems to be under threat right now. The third thing really has been about, and most important really for India, is that the US Senate right now has advanced Russian sanctions bill. When you look at those numbers, it does seem like a consensus onto that one. What US Senate does say that they would impose primary and secondary sanctions on Russia. What the bill also suggests is that it is going to be sanctions which are targeting Russian political officials, banks, financial institutions, Russian shadow fleet, and the list perhaps just about goes on. The bill would enable imposition of 100% tariffs on countries which are depending on Russian energy exports. So while the number may be large, but the bill actually talks about the 5 top here. And within that, you have India, you have Azerbaijan, China, Slovakia and Hungary. So these are the 5 countries which are buying a lot of Russian crude, and 100% tariff can be imposed on that. Remember, this is procedural voting that we saw yesterday. The bill will go to House, to the US President's table as well, and then has to be signed. But this does seem pretty done deal right now. The fourth thing is about the US inventories, where we have seen constant decline. Remember, the strategic petroleum reserve is the lowest since 1983, and the last week also has seen more than 3 million barrels per day of a decline therein. And finally, there also are reports from OPEC Plus, which suggest that the OPEC Plus allies could freeze the planned production hikes for 3 months starting October. The last 3 months, every month, OPEC has increased 188,000 barrels per day of an increase. But from October onwards, this perhaps would go on a freeze. That tells you that there is no supply situation concern right now. The reason that you haven't seen the crude oil prices go back to 90 or 100, that exactly is the reason.
Manisha, thank you very much for that. That's oil in focus and triggers now and in the future. We'll take a break. Lata will connect with Motilal Oswal's Nitin Agarwal on the first quarter banking earnings and more. Stay tuned, coming up.
Welcome to our earnings analysis. Banking results have been the toast of the Q1 results so far. Here's the summary. Very strong beat over expectations. What I can call outperformers are ICICI Bank, Punjab National Bank, Bank of India, IDFC, Karur Vaishya, AU Small Finance, and even to some extent IndusInd, compared to expectations, outperformer. Then come the mixed performers, or you can say inline performers. Those came from HDFC Bank, Axis Bank, Kotak Bank. But more important were the misses. The misses came from Bank of Baroda, which had a one-off provisioning, and CSB, where the current and savings account has been falling. Of course, even NPAs rose. But how much is all this in the price, and where are the best bargains in the hierarchy of many good performers? I have with me Nitin Agarwal, the banking expert from Motilal Oswal. Good morning, Nitin. Thank you very much indeed for joining us. One of the big reasons why I wanted you on the channel is because I think you track the maximum number of banks. Your entire list has about 20 banks, almost maybe 17, 18 banks. And that gives a very good overview of how we should look at the hierarchy. Now, as I pointed out, because of the very steep fall in bad loan slippages and provisioning, many banks have done excellently well in terms of profits. What is your hierarchy? Is it, ICICI, PNB, BOI? What would you say is your best, say, top 3 bets?
Yeah, good morning, Lata, and thanks for having me. So clearly, our banking sector is kind of making a comeback on the earnings, which were under pressure over the last more than a year. While this quarter, we have seen a decent start, but margins still remain under pressure for some banks, as you indicated. And we believe that going forward, things will kind of stabilize, and over the second half, there is a possibility of some expansion in margins at the sector level. And which is where we think the earnings momentum will pick up. And over the year, we therefore are looking at 18 to 20% earning growth for the private banks. And the large banks certainly has been a lot more under pressure, barring ICICI especially. And we expect some performance to show through, therefore. And wherein, therefore, our top ideas remain ICICI, HDFC, and amongst PSUs, we like SBI.
Like SBI. Okay, but I thought your report on PNB was also very strong, and on BOI, Bank of India. I mean, they are almost an all-round beat, both those stocks. Why are you not ranking them as outperformers? You don't see much of a price.
3 stocks, as you requested. And but yes, certainly PNB numbers also were very good. And in fact, that's a stock that we upgraded last year. And sitting today, I think PNB still has a lot of potential to deliver very steady growth. Bank has a fair amount of liquidity with a controlled CD ratio. Margins, after a series of fall, this quarter they expanded. And bank has indicated for 10 to 20 basis point expansion in margins going further. It has one of the best slippage ratio, which places it well even on the ECL transactioning requirements. So I think PNB overall looks good to deliver comfortably above 1 ROA in the coming years. So, and the valuations overall looks very supportive when you compare it across most of the PSU banks.
Okay, and you wouldn't put BOI in the same basket? Their numbers were also an all-round beat.
BOI, we are not covering actively, so we don't have a formal rating on that.
Fair enough. Oh, yeah, I didn't notice that. Let me come to the big banks again. You know, there's everyone saying that HDFC Bank is also in their top pick. But it's reported the lowest ever margins. I mean, margins obviously are under pressure because they've had to accumulate deposits. Why is everyone persisting? Is it because that every brokerage is saddled with it in in every mutual fund? Whether you're selling direct plans or you are selling, specific sector-specific bank Nifty plans, this heavyweight is there. So is that why people are not willing to call it neutral? Everyone is calling it a buy despite the persistent problems.
Yes, you are right. There have been a series of problems that we have seen with the bank, which has impacted performance. And the merger-related compulsions that the bank has to deal with in the balance sheet construct, basically, which is limiting the growth, is still there. While they are progressing well on that, and we hope that with FCNR deposits also coming to some reprieve, we will see some decline in CD ratio this year, which will bring it more closer to the steady state numbers. And thereafter, one can look at a 14%, 14, 15, that range kind of credit growth in the coming years for the bank. And besides other problems at this quarter, mainly the margins, I think has continued to dent the investor sentiment, which is why the stock continued to underperform. And all of this, in a way, is making, I will say, mid-sized banks looking like they have been performing better. Therein the earnings are looking to normalize, and many of the winners that we have seen in the banking sector in the last 1 year has therefore come in from the mid-sized space.
Okay. Among the mid-sized banks, which would be your best bets?
So we have been very positive on AU Bank over the years, and that has delivered fairly decent returns. We continue to think that it's a strong franchise which will deliver 20% plus compounding over the coming years. And alongside, we like Federal and RBL within that space.
Okay, but I thought IDFC Bank also did very well. It seemed to be a beat. They've done better even on margins. One of the few banks where margins even increased a bit. You still have only a neutral on it.
Yes, IDFC, we have turned more constructive after this quarter because after facing issues in the last 1 year on the MFI and then respect to the deposit account, I think they have now delivered a strong number in the 1Q. Bank has indicated for a lower credit cost guidance, almost a 20 basis point decline they highlighted. And we have upgraded numbers by 20% for 27 and another 10-12% number upgrade for 28 and raised target on the stock. But we have still not changed our investment rating on the stock. But certainly the view on the stock has turned more positive than what it was before.
Nitin, since you reminded me about upgrading, in which bank or banks were the earnings upgrade the maximum?
I think that IDFC certainly is amongst them, wherein we have seen a decent earning upgrade. And it's not only upgrade. I would say some banks are still seeing earnings decline also because margin is still a variable which is not fully in control. And given how the compulsion or challenges have been there on the deposit sourcing, CASA pressures, you still expect margins to behave in a divergent manner. Like some banks have still lowered the margin guidance still in this quarter also.
No, you're absolutely right. The problem of margins is not going away. It is becoming a structural issue. Deposit cost is simply not falling. I take your point. But all of them have done well because provisions have fallen like off a cliff. If you even look at IDFC and all, it's actually the provision fall which has given the net profit leg up. I take your point on that. But within the large banks itself, do you see any of them being able to really surprise? Other than ICICI, Axis, Kotak and all have been mixed performers. Which one do you think may give you a surprise?
Yeah, I think even ICICI surprised us this quarter at that size. And that's what we wrote in our note, that at that size and scale, the kind of growth and profitability that the bank reports is clearly commendable. And even on a core basis, adjusting for the one-off like IT refunds, the bank delivered a beat to our numbers. And that was a big beat which led to a 4-5% earning upgrade. And in terms of earning growth, we are looking at a stronger growth from names like Axis and Kotak. But that also because, in case of Axis, because of the base effect, wherein things are getting normalized, all the technical slippages and therefore the provision-related challenges, the PSL-related provisioning is now largely done. And you will see, therefore, credit cost turning more benign this year. Okay. Likewise, on Kotak, I will say the credit cost has already come down from the highs of 90 plus basis point. It has halved now, and that will go on to support earnings along with the recovery in the unsecured assets. But on to your question on upgrades, I think we have upgraded numbers a fair bit for Federal and IndusInd also, besides IDFC Bank.
Okay. That's the question I forgot. IndusInd, the CEO was on the channel and he was saying that he sees this as an inflection point. That, this year, or rather in FY26 and the first quarter, they are still only 3% higher in terms of advances quarter on quarter. Year on year, advances actually lower for advances growth is lower for IndusInd Bank. But they are promising industry level growth in the current year. That was 18%. You don't think that, do you think they will deliver on that promise, and will that not mean a big jump in price?
I will say that yes, certainly from where they were, like last year was an 8% decline in loan book YOY. This year we have started on a decent note on both advances and deposits. And in our estimates, we are currently factoring around 13 to 14% loan growth. See, 18% growth that we are seeing right now, we expect it to moderate over the second half. So probably for the year, at the system level, we are still looking at growth number to be between 14 and 15. And I think IndusInd will be close by. As of now, we are around 14 for them for the year, but that's still a fairly good pickup versus how things have been in the last 1 year.
Okay. In which stock do you see maximum stock price upside? I mean, see, ICICI is a great performer across all parameters, but it may be in the price. Price-wise, what might surprise you?
I think amongst the mid-sized banks, I will say like we continue to believe that AU is a 20% plus compounder. Our current price target also implies 22-23% upside on AU, and otherwise SBI we are seeing a fairly decent upside. I think the monetization gains and the strength in the core earnings will continue to drive steady returns over the year. Amongst other large names, private banks, ICICI, as you said, there's a name. HDFC Bank, I think it's like there is a value, but of course we need some clarity. And even the management, we are awaiting RBI approval and the board to decide on sending on the name. I think as these clarities come through, FCNR is another monitorable in the near term. The progress on that will kind of be crucial to determine how quickly the re-rating can be for some of the private banks.
Okay, yeah, of course. In terms of the distance from your target price to the current market price, HDFC gap is the highest. But of course, much will depend on how things pan out. Is it fair to say now that until recently, the order used to be first large private banks and then mid-cap private banks and then PSU banks. But the order is now shifted. It is now PSU banks, mid-cap banks and then large banks. Is that a fair statement?
I think, yes, you are right. The valuation band and all the historical, I think, perception and the picture that one has in the mind has changed. And mid-sized banks have made a strong comeback. Large banks, due to one or the other challenges at the bank level, has impacted the overall performance, and which we have seen barring ICICI Bank to some extent with most of the other names.
Okay.
And
go ahead.
Forward, as I think while private banking space as a whole we like more, because that's where earning growth will be like moving towards 18 to 20 run rate. 20 is also because some of the mid-sized names like IDFC, wherein we have upgraded numbers, and the other names which are more prone to unsecured cycle will have a better credit cost that will drive their earnings. Some of them will report a triple-digit earning growth also from the base.
Fair point. Actually, all of us, even in the media, have been stuck to the fact that private sector banks have shown more verve to grow. But in terms of earnings growth, it's the PSUs that have surprised us. And I won't be surprised if they continue to do better, at least for one more year, because they have so much of credit deposit headroom, to escape not having to get high-cost deposits. Anyway, let's wait and see. Thank you very much, Nitin, for taking us with a fine-tooth comb through all the important banks that we need to cover. Thank you for joining us. Wrap up on Bazaar on that note. Chartbusters up next.
L&T gains in trade, profit and order inflow numbers in the first quarter beat expectations. EBITDA misses estimates. The company also maintains its FY27 guidance, reiterating a 10 to 12% revenue growth target, similar 10 to 12% growth in order inflows as well. The stock up 3%.
Shares of Tata Capital gained in early trade. The company delivers a robust showing in terms of the disbursement growth, resilient asset quality and continued improvement in margins. They guide for 23 to 25% asset under management growth in FY27.
Hindustan Unilever shares bounce back from yesterday's sell-off. HSBC upgrades the stock to buy, citing improving performance across key segments like home care and beauty, as well as well-being, along with attractive valuations.
Adani Phosphates delivers a stellar Q1 performance, beating estimates across key parameters, while the DCM Shriram trades with a positive momentum after a mixed quarter impacted by supply chain challenges and cost pressures from West Asia conflict. Hello and welcome to Chartbusters. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel, with me is Mangalam, and as we speak, the market's holding with a gain of around 240 points odd. Mangalam, you're getting the sense that if things don't escalate on the global front, probably we could be on our way to break the upper end of the range, given that the tech index is finding its form. The Nifty Bank has been the favorite as it is, but the breadth of the market is particularly encouraging even this morning.
Across the board, Nigel, even the earnings have not been particularly bad. We've seen some good performances coming in from, corporate India in terms of earnings. So all these factors point northwards. Let's see where we go from here. It's a Wednesday morning, early in the day to talk, and early in the week to talk about alcohol. But one of the stocks that saw big gain yesterday was Radico Khaitan, as it reported a strong set of performance in the first quarter. The profit saw a big jump of nearly 76%. The management also upped their guidance for FY27. So to discuss this and more, we have with us the Managing Director of Radico Khaitan, Mr. Abhishek Khaitan, joining in. Thanks a lot, sir, for joining in. Congratulations on a stellar set. You've increased your guidance. And even before that, every time you've beaten the guidance. Now that you've increased it, how confident are you of exceeding this 25% guidance from 20% growth in P&A? And what does this 25% entail for your luxury portfolio, which has been growing faster than even P&A?
I think this is the best quarter of Radico in terms of volume, EBITDA, PAT, and the EBITDA margins. Our most importantly, our P&A segment has grown by 36%, and we've done about 5.2 million cases. And also our EBITDA is up by 50% to 348 crores. And our PAT is up by 70% to 225 crores. Most importantly is the EBITDA margin, which has increased from 15.6 to 20.7%. And in fact, at the beginning of the year, we had guided that our EBITDA margins should increase by 125 basis points. And in 26, it was 15.8%. So we had guided for about 18%. So now, seeing the momentum in our P&A segment, our luxury portfolio, I think we have upgraded our guidance to 20% EBITDA margin. And we are very confident how the quarter has gone. We are seeing a lot of buoyancy, which is happening in the brands. And especially the most important is what we are seeing is a total structural shift towards the vodka segment. In fact, globally, if you see, 28% of the spirit market is the vodka. Whereas in India, it is only like last year, it was 3.7%, which became 4.5%. And in this quarter, it is 6%. So we are seeing a structural shift towards the white spirits. So I think we are well placed to capture the growth. And we are quite confident of the EBITDA margin at 20. And also we have upgraded our guidance of our P&A growth from 20 to 25% this year.
All right, Abhishek, but are you confident of beating this guidance as well?
I think what we had guided for 3 years, we've done it in this quarter. So I think let's see how the thing is, but we are confident of achieving 20% EBITDA margins.
All right, you are confident of achieving 20% EBITDA margins. But, could you give us also a sense of growth for the company going forward. I just wanted to understand a couple of things from you, Mr. Khaitan, out here. What proportion of your sales, if you could tell us in terms of growth going forward and the kind of plans that you have, what led to this specific growth?
As I said, the white spirit, I'm seeing a structural shift happening. So right now it is 6, but I feel that the way the white spirit globally is that it should grow further into the Indian markets, where we are the market leaders, and surely we are going to capture the growth through more of our innovations and new flavors being added into the market. And plus, even the luxury side, we are seeing a lot of momentum with Virasat Indian Single Malt, our Royal Ranthambore, our Rampur, our Jaisalmer. So overall, I'm finding the luxury side as well as the P&A side, both gaining market share.
Okay, all right. Could you give us a sense of what proportion of your sales come from on-trade and how much of your sales come from off-trade? Also, are there any specific collaborations that you're undertaking with trade to encourage them to push your products rather than that of others?
Yeah, as far as the on-trade goes, on-trade still is very small in context of the Indian market. It is about close to only about 5 to 6% is the total on-trade. And we have really beefed up our team as far as the on-trade goes. We are having a lot of advocacy sessions, and that has been one of the key focus for Radico in the last 2 years, which has started paying benefits to us now. So I think on-trade is one of the channels we have really concentrated on, especially with all our luxury portfolio.
Do you foresee the need for immediate capex given the sort of growth that you're doing and the growth that you're guiding for? In fact, what's the outlook? If you could give us a sense on any sort of need for funds as well, because stock's done extremely well. I understand, you've improved your balance sheet as well. But at some point there has, is there any temptation for the promoters to, cash out some of the money?
No, if you see our debt is just now about 100 crores. So we'll be a debt-free company in the current year. And also we had given our distribution guidance, dividend minimum guidance of 20%. And as far as capex goes, I think we've done enough of capex, and we'll be doing about 150 to 170 crores of the usual maintenance capex every year. So there's no need of funds in the company at all.
All right, there is talk on ground that prohibition in Bihar could be lifted. Have you heard anything to that effect? And if that were to happen, do you see any meaningful upside or benefit for your company?
We've been hearing and hoping for it for a long time. I wish it happens soon, but we've not heard anything on the ground so far. But yes, definitely, if it lifts, because we were a major player in Bihar, and Bihar is one of the largest market earlier before prohibition for the few of our other brands were very popular. And so Bihar was a good, very big market for us.
All right, take that point. Thank you so much for that. We all hope that, there is some growth out there. But for now, you've upgraded your growth guidance and you're confident of achieving that. Past tells you that you've exceeded the guidance that you've given as well. And that's what the stock is pricing in right now as well. Post the numbers yesterday, we saw a big surge in the stock price. And now as well, sitting with a gain of almost 2% after having seen a near 100% gain over the last year or so. What we'll do is take a short break, come back. We have the management of another company, the stock of which is buzzing right now. Tata Capital's Rajiv Sabharwal joins in to talk about their first quarter numbers. Stay with us. Well, the Nifty holding with a gain of almost 250 points. You're seeing a big surge in a couple of these frontline names. Look at Trent. In the last few minutes or so, the stock has seen a bit of a spike. It opened in the red, and from now, that spike, it's moved to the high point of trade. It's noticeable. There you have it. It's a big surge that we're seeing on that counter. Divi's Lab has moved to the high point of trade, and we've seen increased traction on SBI Life as well. That's a stock which has moved again to the higher end of today's trading range so far. So let's get you some ideas for profit from our colleagues at Money Control Pro. Kanchi Shah joins in with a stock that she's been tracking.
TVS Motor continues to be one of our preferred stock ideas in the auto space because it is consistently outperforming the industry. So currently the company delivered another strong quarter with revenue up by 38% and EBITDA margin improving to 12.8% despite higher commodity costs. What's even more encouraging is that the growth was broad-based with motorcycles, scooters and three-wheelers all contributing to stronger performance. Another key positive was exports where volume grew 33%, driven largely by Africa, while Latin America is also emerging as a strong growing market. What gives us confidence is the demand outlook. So management also believes that the industry can sustain double-digit growth in Q2 driven by healthy demand and festive buying. Despite concern around monsoon and rising inflation, expect TVS to continue to outperform the industry. The EV story is also becoming very compelling. The sales surged by 86%. In fact, TVS sold around 6.4 lakh scooters during the quarter, of which almost 1.27 lakhs were electric. So this means that 1 in every 5 scooters sold by the company is now an EV, highlighting rapidly adoption of the EVs. Looking ahead, TVS has enough growth triggers in place, so it plans to expand its two-wheeler capacity to 8.3 million units annually, and it also has new launches planned ahead of the festive season. So we believe that these initiatives, along with continued market share gain across ICE and EVs, should help TVS sustain healthy earnings growth and continue to outperform the industry.
Thanks a lot for that, Kanchi. Well, keep an eye out on the markets. We're going from strength to strength, actually, and things looking quite good even on the frontline index. Besides that, from the broader markets, First Source is a stock that's bucking away. Swiggy, a little bit of a change at the top yesterday. Flip-flop that took place. And the street, I think, likes the new leadership that's come in. Explains why the stock, between yesterday and today, the stock has rallied close to around 10%. So good move out there. Varun Beverages, as Mangalam told us earlier, the numbers were not as bad as what the stock reaction was. And that one as well is pulling back. And I recall when Eternal's numbers came out, it said that probably that was a knee-jerk reaction. And maybe the street will look ahead. From around 275 on the day of the results, the stock is now at around 315 rupees. So big move is what we are seeing on that particular name. Good uptake is what we're seeing. And TIL, another stock that I pointed out earlier today, there was a very large trade that took place in the first couple of minutes of trade. The stock was at around 215 rupees. I think it should come up for you. TIL is now at the day's high. It's recovered close to around 8% from the low point of the day. Big move is what we are seeing. Okay, all right. Let's pull in a few more names then. NMDC as well is seeing a bit of a spike up. And Kalyan Jewellers, what a beautiful looking stock that one has been. Rallied close to around 50%. The shots are getting squeezed out on that particular name. And 625, sky's the limit it seems on that one. Stock has just been moving from strength to strength. Still a distance away from the highs that we saw earlier, but that one comes up for you on the screen.
Indeed, Nigel. And Suzlon Energy is the other one, which is now selling off after its numbers yesterday. It was a big loser in yesterday's session, and now currently at the low point of trade for Suzlon Energy too.
Yeah, absolutely. All right, let's get straight to the next management. Tata Capital reported another strong quarter driven by robust disbursement momentum, healthy AUM growth, as well as improving asset quality and steady margin expansion. Joining us now on the show is Mrs. Rajiv Sabirwal, the MD and CEO of Tata Capital. Hi, sir. Good morning. Thanks a lot for speaking to us here on CNBC TV 18. Well, the street likes what you've delivered. Just highlight to us what kind of growth are you looking at? How do you see your mix, your AUM mix changing from year on, and the broad guidance in the near term? That's for FY27.
So we are, Nigel, a very well-diversified entity present across all products. Retail and SME form the largest chunk of our business. 85.4% of the business is retail and SME, and our guidance is that retail and SME will continue to form 85 to 88% of our total book. We've seen growth happening in all segments, obviously led by housing. Housing is growing at about 24%. We're seeing strong growth happening in the vehicle segment. We're seeing strong growth on the retail, other secured products, as well as unsecured products. SME also continues to do well, and we're seeing corporate demand coming back. So it's been a great quarter. We're seeing good growth happening everywhere, and we're seeing asset quality hold on.
Okay. And what about the vehicle disbursement mix? What could it be?
So in vehicles, for us, we have seen very good growth happening on the two-wheeler side. We've seen good demand originating on the construction equipment side. We are also present in the passenger vehicles where we are seeing robust demand. On the commercial vehicle side, we have been on this agenda of transformation that is continuing to do well. So our numbers on commercial vehicle were slightly moderate in Q1, and we expect them to pick up from Q2 onwards.
All right, we take that point. But, beyond all of this, a strategic initiative that you undertook, which is that of entering the gold loan portfolio, where everyone's been fairly, bullish, obviously looking at the opportunity here, competitive space as well, and the volatility in the gold prices. They're fairly off their highs too. Just wanted to understand the acquisition that you've done of Yog Loans, which has a near 700 crore AUM, 162 branches. What does that do to your overall current gold loan portfolio? And what's your, 3, 5, 6-year target that you have from this portfolio? How big should this be? What's the aspiration?
So we were not present in the gold loan segment. So this is an entry in the gold loan segment. By partnering with and acquiring a company, we have basically hastened the whole process of getting into that business. It's probably saved us a year and a half or so. We were also planning to organically enter this business, which should happen for us in Q3 of this year. We believe it's a large segment. It's a secured segment, which gives good returns. Over the next 3 years, we expect to be having about 500 plus branches and expect to reach a book size of about 4,000 crores plus. So it's a big opportunity. A lot depends on how gold prices move, but our focus will be to use technology more to make the operating processes more smoother for customers so that we can be very quick in disbursals, and that can help us grow our book faster.
And is there any LTV that you're targeting out here? Because that moves the needle quite a bit for this portfolio.
So we've always been very conservative. You've known us. We've been very conscious of the risks which we take. So we will be competitive, but we will be conservative. We will not push the pedal too much or not play on the edge. We will follow all directions and ensure that we remain competitive on turnaround times and better customer service.
Got it. All right. Mr. Sabharwal, let's talk about the ROA then. You're guiding, I think, for an improvement out there. Help us out with what leads to this improvement. How much of it will come in from, say, operating leverage? How much of it will come in from NIMS expansion? Break it up for us.
So if you look at Q4 for this year, and Q4 is usually the best quarter for most of the NBFCs and banks, our ROA was about 2.3, with excluding motor finance was 2.5. Our Q1 has been as good as Q4. It's, after a long time, Q1 has been very good for the industry. And our ROA has been 2.3 overall and 2.5 excluding motor finance. If we look at our guidance, which we have given for FY28, we've given a guidance of having ROA between 2.5 and 2.7. If I have to bridge this gap from about 2.3 to 2.6 to 2.7, then, the way we've looked at it, it will come from two elements largely. One is NIM expansion, and the other is improvement in operating efficiency. Our NIM expansion should give us 2/3 of that gain, and 1/3 should happen from operating efficiency. We expect to maintain credit quality the way it is.
Okay, so you expect to maintain the credit quality the way it is. Just tell me one thing. The corporate lending business, you've said that you will remain opportunistic here. Could you give us a sense on, what's the kind of opportunity that you're targeting here? Is there any specific number that we're looking at? And you've also said that excess originations will be syndicated if required. So what is this excess origination? If you could give us the parameters by which you will look at corporate loans.
So retail and SME form about 85.4% of our book. And our guidance has been that retail and SME will continue to form 85 to 88% of our book. As we have added gold loans and we push our focus more on home loans, we expect the retail proportion to only grow from where it is now. As far as the corporate book is concerned, that will form 12 to 15% of our total book. It is extremely profitable business for us. We work with probably the best names in the country and are opportunistic in that business. We do believe that as our net worth has grown, our ability to originate larger deals has become better. However, we do not keep large exposures on our books. We keep a smaller exposure on our book, and we tend to syndicate out the balance to other banks or NBFCs. And that will continue to be our strategy. So going forward, retail and SME should remain between 85 to 88% of our total book.
Got it. All right. Thanks a lot, Mr. Sabirwal. We appreciate you speaking to us here on CNBC TV 18. Probably sometime during this quarter, we could catch up yet again and you could give us some color. But we have taken your guidance on board. And all the best to you as well as the team.
Thank you so much and have a nice day.
You too, sir. Well, time to slip into a short break. Come back. We continue our focus on markets and stocks that are bobbing around. Stay tuned. Welcome back. You're watching us here on Chartbusters. The market is doing extremely well, but two stocks in particular warrant your attention. The first one, obviously, is HUL, which is seeing a big bounce in today's trading session after a deep gash yesterday. It was down 7% on just a mild miss. And you have Varun Beverages as well, which was up around down about 6% in yesterday's trading session. And brokerages have written on both. You have HUL and Varun Beverages. So HUL, HSBC has actually gone ahead and upgraded the stock after a sharp fall yesterday. They said the internals of the company are looking fairly strong, and the stock overreaction was the stock reaction on the downside was in excess, and as a result of which the valuations are now looking a lot more compelling. On the other hand, we have Varun Beverages, where CLSA has gone ahead and maintained their
high conviction outperform rating. And they say that despite the decline that we saw and the miss on volumes, the management is fairly confident of, barring April, volumes growing in 20s. And as a result of which they believe that this will continue, and competitive intensity also is cooling off in this space. That stock up around 3%. We'll wrap up on this edition of Chartbusters with that, and Trading Hour comes up next. You're watching us here on Trading Hour. We come to you live from the CNBC TV 18 Motilal Oswal studio. I'm Manglam Malu. With me as always, Hormaz Fatakia as well as Ritu Singh, looking fairly good for the start of August series. 250 points on the Nifty bank leading from the front, and we have strong contribution coming in from the IT pack, which continues. Earnings doing well, and across the board, there is a sense of optimism as we kickstart a new series, and the market looking fairly cheerful. Hi, Ritu. Good morning.
Hi, good morning, Manglam, and good morning to you as well, Hormaz. The bank Nifty's come back, above 57,000. The IT pack, like you said, is cheering the street as well. But what's significant is, one of the big heavyweights that's supporting the, frontline index today is HDFC Bank. That stock has been in the red for 7 trading sessions straight. So, you're finally seeing it come back in the green. That's supporting the Nifty as well. Apart from that, what's doing well is a lot of these IT names, Infosys, some of the other telecom names like Bharti, Airtel, even ICICI Bank is contributing. Whereas on the flip side, there are names like M&M, Axis Bank, Power Grid, Indigo, Adani Ports that are doing slightly, not so good. But the market sentiment clearly in the positive. More than 2 stocks are advancing for every 1 stock that is declining. Let's go straight across to Horbaz now to get us the list of the key names to keep our eye out on in today's trading session.
Well, it's been an August start to the August series, if you could call it that. The Nifty comfortably above last week's high, and not just that, it's above the 24,200 mark as well, and it is holding on to those levels. And that recovery that you have seen from the lows of around 23,600 till 24,200, the Nifty owes a profuse amount of thanks, not to the Nifty Bank, but to the Nifty IT. We've seen such days as well today in the Nifty IT index extending its gains, now 3% higher on that index, continuing to build on from where it left off. In fact, July has now turned out to be the best month for the Nifty IT index in the last 6 years. And you look at the IT names as well that have had this big up move this month. Persistent Systems is the top mover, 29% higher this month, the best month since July of 2020. Same for HCL Tech. For LTM, which is up 25%, it's the best month on record for the stock. And for TCS as well, since April of 2018 is when the stock had moved over 20% in a month. And look at some of the other earnings reactions then. Larsen and Toubro, of course, the earnings reaction of the day. Stock holding on to gains of around 3%. Some positive brokerage commentary. 2 of the brokerages even projecting targets in excess of 5,000 rupees. Paradeep Phosphates is the top gainer on the Nifty 500 after its results, and Phoenix Mills, after its results, is down around 5% on the downside in today's session. The big sell-offs yesterday, HUL, Varun Beverages, brokerage commentary veering towards the positive. Varun Beverages still does not have any sell recommendation among the 28 analysts that track it. 3% higher here, almost 4% on HUL as well. So recovering some of the losses that both of them witnessed in yesterday's session. 2 earnings that you'll be watching out for from the broader markets today. MTAR Tech is one of them, specifically so because Bloom Energy, its key client, reported results yesterday which were double of what was expected, and they have raised their guidance as well for the second straight quarter. 5% lower in a lower circuit right now is MTAR Tech. And KPIT Tech, the commentary from the management earlier this month about a profit warning that they had issued, that becomes the key as to what kind of number the company throws up eventually at the end of the quarter. Metal stocks are doing well today among the whole basket of stocks that are surging. SAIL, Jindal Steel, Lloyds Metals, Tata Steel, all of them seeing gains of anywhere between 2.5% to 4.5%. And lastly, stocks at 52-week highs. Look at Century Enka, that was an earnings reaction as well, still holding on to gains of around 6%, was up around 9-10 at one point. Tourism Finance is doing well. Welspun Corp, a stock that has already doubled this year, that too is doing well, 3.5% higher at 52-week highs, Ritu.
Hormaz, thanks very much for running us through that list as always. But let's get into our first management of the show. M&M Financial has reported a steady first quarter, earnings. The asset under management that grew 13% with business assets growing across both wheels and non-wheels. Disbursements dipped sequentially, even though asset quality held up firm despite the seasonal pressure. Joining us now to talk about the first quarter performance and the way ahead is Raul Rebello, the MD and CEO of Mahindra Finance. Raul, welcome, and thanks very much for joining us here on CNBC TV 18. Let's just start with what you're seeing ahead in FY27. It's been a good performance, good start to the year, and you've guided for strong profitability. You're also targeting 17 to 18% AUM growth. Now, given all of this seasonality that we typically see in the wheels business, in the rural sector also now, we'll have to see how demand shapes up, given El Nino and other concerns. Tell us what you're seeing on ground and what are the fastest growing engines that will get you to this kind of an AUM growth?
Thank you, Ritu, and great to be on your show. So you're right that the quarter one has been it's a promising quarter for us, and we gain a lot of courage from the way in which Q1 has panned out. We see a lot of resilient demand in the underlying segments that we participate in, right? The commerce, if you just looked at even the Vahan data for June, the numbers that were posted, passenger vehicle growth at 25% plus, tractor growth 28%, the LCV growth again 20% plus, used vehicle in the high teens. So the underlying commerce still is very constructive, and we gain a lot of confidence from being a very distributed and a meaningful player in the wheels business. You're right, it's too early to call the rest of the year. We have to watch and wait for how the monsoon pans out. There's been some recovery, which gives us confidence that the tractor business still will hold quite well for the first half at least. We've seen a very strong first quarter for the tractor business, but we don't take anything for granted. We can't be complacent for an operator who covers close to 95% of the pin codes in the country. We are monitoring the situation. We'll have to see how the Kharif produce pans out, how price discovery plays out, how mandi arrivals play out. So it's early part of the year, but a good quarter if I would just reflect on coming off from a good quarter in Q4 itself.
It was a good quarter, Rahul, no doubt. But if I were to nitpick, I mean, margins is one place that analysts also have been talking about. It's a 20 basis point sequential dip that you've reported. What's really happening there? And going ahead, will this come down even further? Has it bottomed out? And your cost of funds in the quarter, that also increased to about 5.8%. How do you expect that as well to trend going forward?
The business model can basically operate at a NIMS in the 7% plus. We're targeting an overall ROA of 2.2 to 2.5. With the kind of asset categories that we participate in, just to recollect, we had dropped, in fact, to 6.5 NIMS, and now we are in the 7.3 territory. Sequentially, what happens between Q4 and Q1 is there are some kind of inventory fundings, etc., that we do which are higher, which have a little bit of a NIM compression. And the second reason why you see a small sequential drop is because we thought it responsible to create a liquidity buffer. We generally carry a liquidity buffer, which is at about a 10,000 range. We increased it by 5,000 crores. Just looking at the clouds above us, looking at the uncertainties of the West Asia crisis, etc. So that additional liquidity buffer did create a sequential dip in NIMS. But when I look at the overall NIM territory that we operate in, this model is our business model. Anything above a 7% is decent for us to deliver that ROA of 2.2 to 2.5.
Let me come back to this diversification strategy that Mahindra Finance has been talking about. Wheels, of course, is a large part of the business, and you've been trying to grow the non-wheels part of the business as well. How is that, is that mix changing as per your expectations? What should we expect in the near term, say, end of FY27? What would it look like, wheels versus non-wheels for you?
So this was always a very heavy mobility franchise. All our businesses was largely in the mobility financing. We have called out diversification into two adjacent themes. The one theme, which is contextual to the Bharat opportunity, which is the MSME funding. And the second is funding livelihood assets of the rural semi-urban customers. These are two very adjacent themes for us. We are seeing a very steady progression in our diversification agendas. To recollect, at the end of Q1, the mobility business is now 83%, and the rest of the other asset categories, which is touching about 150,000 crores, the total 150,000 crores, 17% is coming from the non-wheels business. So we plan to be a meaningful player in the wheels business, but these two are the other categories. I don't want to give a specific guidance for end of 27. We have given a F31 guidance wherein we see the wheels franchise still be around 70% of our total AUM, and the other two categories be about 30%. That's the mix aspiration. What gives us confidence is that if you looked at the non-wheels business, it grew at a clip of 79% YOY, while the wheels business continues to grow at a 20% plus. So both these categories are growing in a very sound growth clip for us right now.
Got that. Rahul, in terms of asset quality, it looks stable for you in the quarter. In fact, credit costs and slippages are lower compared to the previous year. But any areas you'd like to, give us an early flag about? I mean, just keeping in mind what's happening, with the continued stress in West Asia, the MSME book, what's happening there. Anything you'd like to call out and what you expect in terms of the full year performance?
So while we've seen a good start to the year as well as Q4 of last fiscal, we don't take anything for granted. I think the situation demands that we monitor the end assets in a very diligent manner. We are a very strong team in terms of our collections. So we look at vulnerable segments. I think every lender has right now created a vulnerability chart of looking at which segments have been impacted more by either fuel price disruptions or the MSMEs, which have been disrupted more because of underlying trade circumstances. So I think the situation warrants that we monitor very carefully. But the macro seems still pretty resilient. We are seeing cash flows not really disrupted. We are seeing the ability for transport operators to pass on their disruptions or their price to the end customers. There would be some market load operators, etc., who are not able to pass this kind of price disruption on. And those segments need to be monitored at a higher level. But overall, if I just look at the way in which our last 7 quarters have panned out, our GS2 plus GS3 has been below that 10% goal that we have set for ourselves. In fact, our GS3 levels have been below 3.5 for quite a while now. So we monitor, but we do see that the underlying customer segments have been resilient till now.
Rahul, finally, let me just ask you, as you continue on this diversification journey, is there any kind of inorganic portfolio acquisition opportunity that's on your radar? And just, let me put this out there. Gold loans seem to be an area where, every other lender wants to get into. Is Mahindra Finance going to evaluate something, something like that as well?
So, Ritu, as I mentioned, we are very focused on the Bharat opportunity. We have been a player for 3 decades, largely in Bharat mobility. We have chosen 2 other categories, which is the micro enterprises in the Bharat category, as well as funding livelihood assets. That's how mortgages, protection, all of that come in. Gold is a very strong adjacent category for the Bharat customer. Right now, we are evaluating if that makes sense, getting into it through a partnership or, at some point of time, if it becomes meaningful enough, we will seriously evaluate it. But we generally look at opportunities which are in these 3 categories. And we have a strong organic business. If there's anything which possibly comes up in the future, which is inorganic in nature, but ties up to these 3 themes, would be fit for evaluation.
So, Rahul, then, like you say, you are looking to enter the gold loan business, still in talks with partners to see how that pans out, but Mahindra Finance will enter this segment as well.
No, I just want to correct myself. I said we will look at any category which ties up into being relevant to the Bharat customer. Today, gold loan is an extremely relevant category. As and when we think it's the right time to look at diversifying into this segment, we will. I just want to make it clear that we're not immediately looking at jumping in like a lot of other lenders have gotten. We are keeping it on our radar. When it makes sense, gold loan, as you know, is a very high operating, the operating costs are pretty high. So we'll have to look at what's the best way of participating for being underlying relevant to the Bharat and rural semi-urban customer.
But you're not ruling it out, but perhaps not immediately, like you said, that many lenders are jumping into this. But Rahul, we'll hope to pick this up again, perhaps when there are some developments on that front. But great having you here on CNBC TV 18. Many thanks for your time.
Thank you, Ritu. Pleasure being on the show.
All right, take a short break on that note. Up next with all the bond market action.
Welcome back. Numbers have started to come at the bottom of your screens. Numbers from Thangamayil Jewelers as well. Net profit up 86%. Get more details on that. Cartrade Tech just came out with numbers a few minutes ago. Revenue growth of 16%. Margins have expanded by over 6 percentage points to 31%. But the stock, after the run-up that it saw, has taken a bit of a nosedive now. 7.5% lower on Cartrade Tech. And that, of course, will be the reaction to watch out for.
Indeed, Cartrade has been a big mover in the past, right? And similar is the case with Thangamayil, currently down about 4%. But if you look at the numbers, you would know that the street was anticipating a good set, especially given the updates that we got from all the other players. And at the same time, we saw, the gold prices rise as well. And Thangamayil is more gold than diamond as against everyone else. So stock, look at this, last 3 months, up 72%. This year itself, up 114%. And if you stretch it back to 12 months, you would see stock has rallied nearly 300%. So after all of this, some bit of profit taking on these numbers is definitely not unwarranted, and which explains why the stock is down 5%, despite the ticker tells you that there's a net profit jump of over 76%. But as promised, let's shift focus to the bond markets. We do have Manisha Gupta joining in. Manisha.
Well, thank you so much for that. When you look at the 10-year bond yields, well, they have opened on a steady note, even despite the overnight spike that we have seen in case of the crude oil prices. Remember, 14% of decline in crude in 3 days, but today has been 4.5% of a jump up. So we've come all the way back from $83 to $87.5 on your screens therein. Markets will now, going forward, focus on the US Fed rate decision. Well, that happens today. And then apart from that, it is going to be the commentary from the Fed Chair Walsh on his guidance or any statement about inflation or the rate hike going forward therein. It also is an ongoing parliamentary monsoon session in India. Any major developments or a cabinet shuffle, which the street has been talking about, would be in focus. And then you have RBI bi-monthly monetary policy review in the next week. That is going to be in focus as well. Let me take you through some numbers. And when you look at the secondary market deals, well, Tuesday was 91 billion. Monday was slightly higher at 98 billion therein. Actively traded papers within the market are clearly about IRFC. You have Bharti Telecom, Port East Investment, NABARD, Lloyds, Metal and Energy, and then you have HDFC Bank. These are the most actively traded papers in the bond market therein. The primary market issuances, well, when you look at Tuesday, that's yesterday, was just about 3.3 billion. But today seems like a very important day. You have 113 or rather 103 billion of issuances being put out today. I'm going to take you through some big names here. For today, when you look at the private bond issuances, you have SBI, which is looking to raise 50 billion, and they're doing this via perpetual subordinated Basel III compliant additional tier 2 bonds here. Muthoot Finance also is in the market and looking for bids to raise 42 billion, and they're doing it via issuances of bonds which are maturing in 2029. Trust Investment is on your screens as well. They are looking to raise 3 billion. They are doing it via 2 bonds, different maturities there. And Kirtana FinServ is in the market for 2 billion as well. You also have Aavas Financiers. They are in the market for 2 billion. And Early Salary Services is in the market looking to raise 1.8 billion. And they're doing it via issuances of bonds which are maturing in 2028. So quite a heavy market today, and some major names looking to raise bids to the tune of more than 100 billion in the day.
Oh, heightened activity in the bond markets then. Manisha, thank you for that update there. Of course, the stock reaction of the morning from numbers that came in yesterday was from L&T. Profits and order inflow numbers beat expectations. EBITDA was a bit of a miss. Vivek is here with the fine print. And of course, what brokerages have to say, most of whom continue to be bullish on the stock. Vivek.
Well, that's right. If you only look at the P&L, it was actually a bit of a miss, especially on the EBITDA front. But the core order inflows is something that surprised the street quite positively, and that has led to a whole host of brokerages saying that they continue to remain quite positive. And in fact, they say a dip is a buying opportunity as far as L&T is concerned. What is Jeffrey saying? They have a buy rating, a target price of 5,000 rupees a share. They're saying ENC execution was weak along expected lines. 14% year-on-year rise in order inflow is tracking L&T's 10 to 12% annual order inflow guidance. They believe the stock could see a leg up to the 4,280 levels if global tension ceases, with earnings visibility adding to further upside. What is CLSA saying? CLSA is saying Q1 was a beat across 3 of the 4 items that the company had guided on. It was a beat on new orders, a beat on recurring E&C margins, which came in stronger than what the street was anticipating. Working capital saw strength, but on the other hand, execution is something that mixed. But remember, the company had said that H1 is expected to be weak as far as execution is concerned. JM Financial says, they remain constructive. They have a buy rating of 4,640 rupees a share. Second half of FY27, they expect double-digit growth as war-related disruptions are expected to subside. They're saying that the core margin at 7.0 was ahead of their own estimate of just around 6.3%. So all in all, brokerages are quite upbeat despite a miss on the P&L. Order inflow guidance and certain metrics being better than what the street was anticipating has led to a bit of a short covering rally in L&T.
Take that point. Thanks a lot for that, Vivek. As we take that short break, just pull up a bunch of stocks. And Swiggy, that's the one that really stands out, up around 7%. Two things have happened. One, there has been a leadership change at Instamart. Secondly, the decline that we saw in the stock price all of last week was on account of fears of MSCI selling once the FDI holding cap has come by. And now the street is, coming ahead of that and looking at perhaps the fundamentals of that business as well. Remember, they had already guided for the quick commerce business breaking even profitably in the end of the first quarter. And right now, as we speak, their numbers are tomorrow. That stock up 7%. We're also seeing increased traction continue in Eternal. So what we'll do is we'll take a short break, come back, discuss the internet stocks on the other side with UBS's Naveen Killa. Well, we've not been short of headlines in the internet space over the last few weeks. Right from, Eternal's first quarter numbers to Blinkit being bigger than everyone else in the listed space, a large IPO which is looming in the quick commerce space, questions around their valuations. At the same time, we have a lot of people looking to enter not just the quick commerce space, but perhaps the food delivery space as well. And amidst all of this, these stocks have been fairly volatile and currently holding well. This month, Eternal is up 20%, and Swiggy, after having seen a decline, is now back up 20% this month so far as well. So, good time to bring in a discussion on this space. Naveen Killa of UBS joins in. He tracks the internet stocks in particular fairly closely. Naveen, a lot of news that have, headlines that have come by over the last 2 weeks or so. We spoke about one on Swiggy's side, the FDI cap coming in, so them perhaps moving to the first-party inventory model. Eternal's become big. Blinkit's bigger than everyone else, continues to profit. And then at the same time, we have one large IPO, which is perhaps likely in the space, valuations around that question. Then you have a lot of other large players as well looking to enter both the quick commerce space and the food delivery space. Amidst all of this, what are you sensing about this sector and the investment case? If one had to make a case on any of these large listed players, is there still room to grow? If yes, then what's your pecking order?
Right. So thank you very much. And look, I think the most important point I would make is related to the points you made earlier about a lot of new players entering the space. Look, at the end of the day, we are talking about a very, very big TAM and a TAM that continues to get redefined on the upside. So, three main assumptions with regards to quick commerce have all changed in the last, I would say, 18 months. The first is that this is predominantly about grocery and FMCG. The second, that this is predominantly about the top 10 to 15 cities. And the third, that this is predominantly a 15-minute delivery from a 3,000-4,000 square feet odd dark store. Now, as each of these assumptions changes, what happens is that the market size or the denominator expands, and expands not by a few percentage points, but by a few multiples. And as we have seen that, not surprisingly, e-commerce platforms, online platforms, traditional retailers all look at this big sizable market and feel a need, or I would almost use the word compulsion, to play a role in the space. And that's essentially what we have seen over the last 12 to 18 months.
Right. What would differentiate the next leg of growth coming in this space? Because obviously, the first leg was discovering the total addressable market, executing, turning profitable. Now people have moved on beyond, just having number of dark stores to assortment, to premiumization, average order values. And then you always have the looming risk of any sort of regulatory challenges coming in with regards to gig workers, etc., right? So what would differentiate the next leg of winners in this space? And for food delivery, what would it take someone to come and disrupt the duopoly of these guys?
Sure. So let me answer the first part of your question. What do you need to succeed in the space? So look, I think capital and balance sheet is a necessary, but not a sufficient condition to succeed. That's the starting point. But you're absolutely correct when you said that the initial part of customer acquisition and customer creation has been done. And the focus will therefore shift more towards customer retention and pleasing the customer and getting the customer to spend more. So we think that there are probably three things that the current and the new platforms need to focus on to continue to remain relevant to the customer. Assortment, absolutely, that's the first and the most important thing. In fact, in one of the quarterly conference calls, I think 1 or 2 quarters ago, Blinkit mentioned that in the NCR region, they now have 80,000 SKUs, which compares to 50-odd thousand in the next few large cities, and 20,000 in the smaller towns. This is important because, as I said, the customer acquisition process is slowing. You do need to get the customer to spend a larger share of their wallet, and that can only be done if you obviously have more assortment. The second thing beyond assortment is value. And when I say value, I don't necessarily mean just price, but a combination of price, timely delivery, and the products that the customer needs. And then obviously the last point I mentioned is capital. So, one of the things that Blinkit mentioned in their recent conference call is that the capex assumption that goes per dark store went from 1 crore rupees just 12, 15 months ago to 2.5 crore rupees. And that's because the dark stores are getting bigger. The supply chains, both in the back and the front end, are getting more complicated. And as that increases, and you add to that your EBITDA burn and working capital requirements, you are talking about a significant upfront capital required to make an impact to the customer.
So Naveen, based on this, do you believe that it is this capital or / cash on the books will eventually determine who wins this race? Because at the end of the day, being a capital heavy business, the more dark stores you need, the more capital you'll require as well, not just for the incumbents, but also for the newer players who are planning to enter into the market. The newer players, of course, have deep pockets, yes, but is that going to be the end game for a lot of these companies to win this highly competitive race?
Absolutely. So look, I mean, I would probably add one more condition to that. So as I mentioned earlier, capital is a necessary, but not a sufficient condition to succeed. So you do need, depending on what your ambitions are, anywhere between 2,000 to 3,000 dark stores. I did mention capex per dark store is 2.5 crore rupees. And then on top of that, in the initial few quarters, you burn EBITDA. There is a working capital investment that you need to make as well. So capital is a necessary condition, but we have seen in other internet businesses in the past that just making massive investments is not often enough. Beyond that, you do need to make sure that your customer retention metrics, giving the right product to the customer, value, as I mentioned earlier, timely delivery, and showing the right assortments. Those are all very important considerations as well. But yes, you're right. Capital is a necessary but not a sufficient factor.
Naveen, pleasure having you as always. Thank you so much for sparing time and joining us with your views on this news-driven quick commerce and internet space. Take a short break. Back with the management of Suzlon on the other side to discuss the road ahead for the company. Stay tuned.
Welcome back. You're watching us here on Trading Hour. A stock that fell big in yesterday's trading session was under pressure, almost 7%, was Suzlon. And this morning as well, opened fairly lower, down about 4% once again. And the contraction is due to a combination of factors. The first quarter margins came off because of West Asia disruptions, the company investing in the future as well. And what's the way forward for them? We do have Ajay Kapoor, who's the CEO of Suzlon Group, joining us here in the studio itself. Thanks a lot, Mr. Kapoor, for joining in the studio.
Thank you. And, thanks for having me on the show.
Yes, the street seems to have read something in your numbers that is spooking them. Is it the West Asia crisis where, there was disruption by about 10 to 20%, even though you've maintained your guidance? And the margins from over 18%, it's down to around 15%. What explains that, and what's the path going forward?
Sure. So let me first take you through what's happened for Suzlon in quarter one. First of all, I think it's been one of the biggest quarters in terms of June series quarter one, highest volumes, driven by our deliveries of RR of close to 500, resulting into a revenue uptick of 23%. On top of it, our execution on ground, which we have been working and been talking about it for a while, we saw almost 269 megawatts getting commissioned. This, I think, is almost 2.3 times what it was last year, same time. And interestingly, we also have additional, ready commissioning on ground availability, which I believe will pan out in quarter three, quarter four, and quarter two onwards. Generally for us, H2 is better than H1. It typically pans out like that. But what I'm excited is also the way the market and our new products are getting received in the market is we have done 1 gigawatt sales. Our Suzlon 2.0 strategy is panning out absolutely as we had planned. In fact, 60% of our new 1 gigawatt orders are coming from the DevCo-led strategy and coming from our marquee customers, CNI customers, repeat orders. We have invested for Suzlon 2.0 and some of those costs are there in this quarter. These are investments in new products, in the R&D, in opening of international markets, marketing, and customer outreach. So I think those are the investments we are making, and also some money also invested in DevCo, because this is where you buy land in advance, you get your permits. So all this is panning out, and I believe it's going to be a good play because of this strategy as we are planning.
So do these investments continue as the year goes by, and with these 15.5% margins, do they get back to maybe 17.5%, 18%, since you have mentioned 17 to 18% as the lower end of the band? Do they get back to that in the second half, or do we see that recovery starting in this quarter itself?
So see, when you also look at one more aspect I'd like to mention is the company has multiple businesses. And to look at a margin on a quarter vis-a-vis, because this is a B2B business, we are into projects. Within that, we have service arm, we have a domestic wind turbine business. Within that, you have projects. So you need to really look at holistically. We believe for the year as a whole, Suzlon should be amongst the best margin delivery companies in the sector. We'll continue to maintain that leadership. And I think as we pan out, these investments are going to help us in the next 2 to 3 years. The payback is pretty soon. We are also investing in new factories. We recently set up a new blade plant in MP, in Rajasthan. And I think these are all going to help us with the new turbines of 5X and the new product portfolio that we announced.
But do these investments continue as we go along, or does that number taper down?
Just to add to that, when you say that margins will remain best in the sector, we take that point, no problems about that. But last 5 quarters, I'm looking at your margins, down 19%, 17%, 18%, and 16%. Over the last couple of years, on an annual basis, they've stayed between 17 to 18%. So do you think you will get back to that, or maybe 15, 16% is the new normal, at least again, till such time you're investing?
So giving a guidance is something I would stay away from, but I'll tell you that what does the company deliver? Company delivers on new customers. Company delivers on opening up the new adjacencies, which we spoke in Suzlon 2.0. One of the things we spoke about it was we are going to increase our service portfolio, the asset management portfolio. So just if you look at around 16 plus gigawatts of assets that we manage, if we just went 25 kilometers around it, there is another 10 gigawatt of solar assets which are being managed by somebody else. We are getting an outreach program. Our leadership team is working in that. As we acquire those customers, This business gave 43% margin in the last quarter, by the way. So our aim is to look at holistically and grow each of our businesses rather than pinpointing as to what the margin would be. I'd stay away from it, but I'll say that 27 will be stronger than 26, and Suzlon will continue to invest in the future.
Lovely. That's, good enough that the streets heard that from you. The S175, how do you expect that to, add to your overall book? Because right now it's about 2% of your order book.
So it was only launched 2 months back, and also, in fact, in Goa by the Honorable Minister. We already got the first order, and we are very happy. There's a lot of discussions going around the same product. We believe in the next couple of years, this itself will swell into a sizable portion of Suzlon's portfolio. Simultaneously, S163, which is 6.3, we are working for the international market. The seeding work is already going on. Some of the investments also in this quarter are for developing the products for the future.
You begin conversation with international customers to onboard them and so on. What's the progress there?
So we've been participating in all the international conferences. Our teams are already in place. We are also investing in headcount there. But then this takes almost 18 to 20 months of seeding, because international market, as you know, is you need to get their grid studies, you need to get their local turbine certificates, and that's what team is working on. But parallelly, we have got very good interest in repowering of their 2 megawatt series turbines to improve them. And also a very good order for our blue sky platform, of which 5 megawatt and 6.3 is one of them.
All right, take that point. Will you up your 700 crore capex, or is that enough for now?
I think we're very much happy with that and progressing as per track.
All right, may the power be with you. That's what we'll say for now, irrespective of, the mild slip that we saw in the first quarter. So that's the management of Suzlon. What we'll do is take a short break, come back, get your sentiment check on the consumption space, where a lot of these stocks have been at near 5 to some, even a decadal low. We'll talk about that. Welcome back. You're watching us here on Trading Hour. A bunch of stocks on our radar right now. Colgate is the one which has reported its numbers. Net profit at 343 crores. The CNBC TV18 poll was that of 345 crores. So pretty much in line with expectations on that number. But we'll try and get by some more details as well. Revenue at 1603 crores, which is a little better than street expectations of 1577 crores. Remember, the street was working with a number of about 10% in terms of growth. The company has reported around 11.5%, 12%, which is actually a multi-quarter high when you look at overall growth. It was obviously supposed to be led by underlying volume growth of about 5 to 6%. And I guess there would be some sort of premiumization and price mix, which would take the remainder of the revenue higher as well. EBITDA, net profit, absolutely in line. Look at the EBITDA, 482 crores. The street's expectations were that of 482 crores as well. Net profit at a poll of 345 crores. The company has reported about 343 crores. And you have the revenue, which is a slight beat on expectations. So all in all, this goes out as an in-line good set of numbers coming in from Colgate, with the revenue growth being at a multi-quarter high. So that's a positive, and which explains why the stock, after having underperformed, has bounced back a little bit, up around 1% as we speak. The other things that we'll be tracking very closely shortly will obviously be the management commentary. The management has said the toothpaste portfolio has seen high single-digit volume growth. Now, this is a positive because the street was working with mid-single-digit volume growth, with the rest coming in from premiumization and price. But if there is a revenue beat and a large part of that is coming from volume growth, that is a positive. And that explains, again, the intraday of the chart of the stock comes up for you. After a brief dip, it's seen a bigger gap up, right? It's seen a bigger gash on the way up now. The management commentary around high single-digit volume growth is something that the street likes. All right, with that, we'll get some more details on Colgate. As of now, the stock up 2%. Let's shift focus to the insurance sector. We'll go to Ritu for what she's got. Ritu.
Well, Manglam, we'll actually go across to Yash. We understand he's picked up from sources that the insurance regulator is going to soon crack down on dark patterns that are being used by insurers. So let's bring in Yash for that. Yash, we'd heard some warning signs from RBI as well, talking about this in its report. What's the insurance regulator saying now?
Well, that's exactly, what we heard from the Reserve Bank of India when it comes to its take on dark patterns. Now, what we've been given to understand is that the insurance regulator, IRDAI, may soon ask insurance companies, insurance distributors and all entities in the ecosystem to not seek any personal details from potential policyholders. Now, as we are given to understand from our sources in the regulatory body, the personal details may include contact number, email ID of policyholders, before the policy is even bought from the portal. What we've been given to understand is that IRDAI believes that seeking personal details before providing policy information is a very evident example of dark pattern. Also, what we've been given to understand is that a consultation paper on dark patterns, what all constitutes dark patterns, the definition of it, and everything that needs to be eliminated from the sector is expected from the regulator very soon. At this point of time, the regulator is, in consultation, trying to understand the definition of dark pattern, identifying patterns which constitute dark pattern, before it comes out with that consultation paper and puts these conditions and examples in that paper. Also, the regulator, as per my conversation, is very clear that even if a particular portal is taking the personal details of the policyholder, which is contact number and email ID, then there should be an explicit and a very clear tab which also gives the potential policyholder an option to opt out from any sort of callback from that insurance company, distributor or any entity, so that there is no callback which he receives, which he is not asked for. As far as this particular element of dark pattern is concerned, which is taking personal details of potential policyholders, distributors like CoverFox, Insurance Dekho and Policy Bazaar get a significant portion of their revenue from call center assistance, and all these three companies, which are insurance distributors, seek personal details of policyholders or potential policyholders on the first page itself before proceeding further.
Yes, thank you for putting that story together for us. Take a short break. On the other side, Ritu gets you a big leadership trend that is emerging in India's private banking space. On the other side, stay tuned. Welcome back. Now, a big leadership trend is emerging in India's private banking space. The Reserve Bank of India is clearing CEO appointments much faster than before, with the recent approvals coming in weeks instead of months. Now, the shift gains importance as HDFC Bank heads towards a crucial CEO succession decision with the current CEO's term ending in the month of October. Ritu is joining in with more insights on that. Ritu.
Well, an interesting trend that can matter for every large private bank. You have a new Jefferies study which finds that RBI appears to be taking much lesser time to approve CEO appointments than it had done in the past. Now, it's looked at 9 private sector banks in the last 7 years and found that the average gap between a bank's board naming the CEO and the RBI approval coming in has been about 163 days or a little over 5 months. But in the most recent approvals, you can see those have come much quicker. Just look at the examples. At IndusInd Bank, RBI approved Rajiv Anand's appointment 35 days. That's a record time. In Federal Bank, KVS Manian got the green light from RBI in 40 days. And at Kotak Mahindra Bank, Ashok Vaswani's appointment took about 3 months or 90 days. Compare that with the historical average of more than 5 months, and the trend is pretty hard to miss. Now, the study also shows another interesting pattern. Boards don't usually wait until the last minute. On average, in fact, they tend to announce their choice about 238 days, or that's nearly 8 months before the new CEO takes charge. And in most cases, RBI has gone ahead and approved the same tenure that boards have asked for, which is typically 3 years. Of course, there have been exceptions like Sumant Katpalia at IndusInd or Shyam Srinivasan at Federal Bank getting only 1 year. But that now finally brings us to HDFC Bank. Now, Sashidhar Jagdishan's current term ends on the 26th of October this year. The bank has already got RBI's approval for the chairman, Rajiv Kumar, to take charge. But unlike previous CEO appointments, the board of HDFC Bank is yet to announce its recommendation. Now, if you look at HDFC Bank's own track record, it suggests that the board, again, doesn't usually leave these decisions to the very end. When Sashidhar Jagdishan was first appointed CEO in 2020, the board announced his choice 191 days, that's about 6 months, before he actually took charge. When his second term was approved in 2023, the board had moved even earlier, 236 days or nearly 8 months in advance before the new term was to begin. This time, of course, his term will end in about 3 months from now, towards the end of October. Board is yet to announce the CEO recommendations, so it's a much tighter timeline for HDFC than what the bank has followed in the past. But even with the board taking its own time, assuming that RBI moves at the pace that it has recently, the good news is a nod can still come through in as little as a month, which will be well within, the window that ends in the, on the 26th of October.
Take that point. Thanks a lot for that. Ritu, that's new appointments coming in extremely fast, but as we speak, even numbers flowing in thick and fast. Net profit coming in at 15 crores versus 3.5 crores for Devyani International. Good surge in their revenue as well as EBITDA. The stock up around 4.5%. With that, we wrap up on this edition of Trading Hour. From Ritu, me, Hormaz, thank you so much for watching.
Stocks gain despite a fresh round of strikes in the Gulf as the street looks beyond the daily seesaw and puts the lens on earnings. IT, FMCG metals gain while realty drags. Gulf tensions hit L&T's execution in Q1, hurting profitability, but order inflows stay strong. The engineering behemoth maintains its FY27 guidance, and analysts see growth coming back once Middle East tensions subside.
Tata Capital posts a strong growth quarter with improving interest margins. The lender sees growth picking up further in CV, corporate and gold loans, with a further expansion in margins to meet its return on asset target of 2.5 to 2.7% for FY27.
India's largest private hospital network, Manipal Health, launches its rupees 9,275 crore IPO, of which the rupees 8,000 fresh issue will help it par debt and become net debt zero. A marquee list of anchor investors buying. Oil reverses overnight losses after Iran strikes a US base in West Asia. The US Senate taking a first step by passing the Russian sanctions bill can also spell 100% tariffs for big Russian oil importers like India and China.
Hello and welcome to Halftime Report live from the CNBC TV 18 Motilal Oswal studio. I'm Ekta Batra and with me is Sonal Putra and Vinny Motiwala. Well, it is turning out to be a session where we have the Nifty, which is trading above 24,200. So we seem to be in fine fettle at this point in time, despite all of the news which is taking place globally with regards to Russia and its sanctions and the volatility that we've seen in Brent crude prices. So as of now, we seem to be in steady state. What stands out is the advance decline ratio, which is positive and has been from the get-go, so around 2,500 stocks advancing to around 1,500 stocks declining. Also, just want to point out the India VIX, which is basically the volatility index, which is still up around 28% on a year-to-date basis, but has declined around 13% this week and 10% this month. So that gives you an indication in terms of how the market is probably approaching, or investors are approaching the market at this point in time, given all of the volatility and news headlines taking place globally. Hi, girls.
Hi. Hey, girls. Good afternoon. It's the fresh news series. August has started in terms of F&O numbers and has started with a bang. And if we talk about the IT index, that's the one which is taking everyone's breath away. It's up 9% in last 3 days, third consecutive day of gains on this one, followed by realty, which is up around 4.5%. We do have pharma index, which is up around 3% in the last 3 days itself. So there are a couple of spaces which are seeing a lot of traction. Mid caps are buzzing, and we do have a lot of earnings which are trickling in. That is where the markets are focusing on right now, ignoring what's happening globally, but earnings are taking center stage. So we are somewhere in the middle of earnings season, and there's a lot more to go, but mid caps and small caps that continue to take the center stage, with the small cap index at the day's high, Winnie, up around 1%. Absolutely. And on that note, let's just look at the advance decline ratio, right? Because clearly in the favor of advances versus decline, given that the broader end of the market is doing well, like Sonal mentioned as well. And IT obviously continues to trend upward. This week, interestingly, Sonal mentioned 9% gain this month. Also, so far, we've seen 18% gain coming in. So good traction coming in for the IT names, and those are among the top gainers in the trading session. But what's on the show for you all today? Let's talk about that. Market is seeing a sharp uptick. Some of the top stocks that are buzzing around in the trade, we have Adani Ports SEZ, SHKLKR, as well as Birlasoft, Car Trade Tech, which are moving in the trading session. So we'll talk about all of that. Then we'll have the India's largest private hospital network, Manipal Health, that has launched its rupees 9,275 crore IPO. So we'll be unpacking the issue more in terms of the commentary that's come in. What are we watching out for as well? In earnings, we'll speak with the management of Navneet Education, who reported a weak set of numbers in June quarter. What is the outlook for the company going forward? That will be key to note. And in our Crypto Corner segment, Manisha will focus on the latest trends in the world of cryptocurrencies. Stay tuned in for that. But first up, and let's start the first segment for today with Vivek, who is here to take us through the stocks that are moving around in the trading session. Vivek, afternoon.
Well, thank you so much for that. The screen numbers, and most of the color that you're seeing on screen is largely green. in terms of individual stocks and sectors, what is it that we're tracking? Have a look at Larsen and Toubro. Clear beat, coming in as far as the order inflow was concerned, and that is something that the street has latched on to almost 2.5% higher in the session today. The entire IT pack, like you mentioned, especially the mid-cap IT side of the things, doing very well in the session, picking on or moving on from the strong set of results that Coforge delivered yesterday. Look at names like Firstsource, LTM, all of these stocks moving significantly higher. One stock from the metal pack that clearly stands out is SAIL, one of the top mid-cap gainers in the session today, up almost 4% on good volumes as well. The entire pharma pack as well, taking some amount of positive rub-off seen globally where pharma stocks saw rallies. So look at names like Cipla, Divi's, Aurobindo. Most of these names amongst the top gainers today, even a name like Granules doing quite well. Paradeep Phosphate, again, moving higher on strong volumes, good set of numbers. On the other hand, quite a few stocks that are seeing significant selling pressure. Bosch has been very volatile in the session, but again, on high volumes, this particular stock saw a sharp sell-off because rebounding significantly. City Union Bank, one of the top gainers yesterday, but today the management has alluded to some NIM pressure. That's something that the street hasn't liked, down over 5%. Suzlon, yesterday was the top laggard, almost 8% lower, follow-on selling scene. Street not convinced as far as execution is concerned in H2. And lastly, Pine Labs, again, one of the stocks that was extremely active in the session today. Margin pressure is something that the street hasn't liked, over 3.5% lower for Pine Labs today.
Okay, all right, Vivek. Thanks very much for that. But let's get going on our movers and shakers segment on Halftime Report. And let's get talking about a whole host of stocks that we are tracking. First up, Sonal, you're looking at SH Kelkar. Tell us more.
Yes, good set of numbers, and after a while there's a recovery which is back on the company's books. So overall revenues up 14%. This is a flavors and fragrance company, and across the board, if you look at specialty chemicals, the segment has done well, and SH Kelkar is not far behind. Their EBITDA is up 21% on a YY basis. Margins have expanded around 80 basis points, and profits are up 77% to come at 45 crore rupees. Both their segments have done well, but it is the flavors segment which has done even better, though we do have more revenues coming in from the fragrance segment, where revenues are up 9%. Flavors has seen a revenue growth of around 63% on a YY basis. Most of their geographies have done well, but surprisingly, Europe has been one of the strong contenders, where growth is up 24%. India has seen growth of around 4.8%, and rest of the world has seen growth of 44%. However, their global ingredients business continues to be under pressure. It did see a revenue decline of 45% to come at 8 crore rupees, and the company does not have positive outlook as well. They say the near-term visibility remains very limited in the global ingredients business, with customer ordering patterns likely to remain very sensitive to geopolitical developments, and that's why they are not very bullish on this one. But the stock is up 12.5% in a market which is already doing so well, so the shareholders are rewarding the good performance that the company has reported this time.
That's all about it. Such Kelkar that's buzzing away in trade, 12% gains as of now. But let's move on to another stock that's also holding on to very strong gains in the trading session. That's Paradeep Phosphates. Ria is here to take us through the details for this one. Ria?
Well, yes, Paradeep Phosphates seeing a very strong gain in today's trading session on the back of its Q1 numbers. Now, results have been better than estimates on all fronts in terms of the revenue, EBITDA, the margins, even the net profit. But the volumes for the company have been muted this time around. First, let's look at the financials. The revenue has gone up by nearly 26% versus estimates of just a 9% increase. EBITDA also seeing an increase of 24% versus an estimate of a 23% decline. So that has also outperformed. And margins have also held steady for the company. The sales volumes, on the other hand, have grown by just 4% this time around versus estimates of a 7% volume growth. So that is something that is weighing on the company. And apart from this, the company has also approved an investment proposal of nearly 250 crores for setting up an aluminum fluoride plant with a capacity of 15,000 metric tons per annum, which will enable them to enter and diversify into the related industrial chemical space as well. So good set of numbers for Paradeep Phosphates.
Okay, all right. Thank you so much for joining us with that analysis. But let's go across to Ananya. She's joining us with all the update that she has on car trade tech. The company just reported numbers a while back, and there was a sharp fall, Ananya.
Well, yes, Cartrade, they delivered, if you look at the number, they delivered a healthy quarter. The growth continues here with revenue up 16% year on year, while EBITDA jumped here 45%, helping margins expand above the 30% mark to 31.3% here. Now, growth was broad-based across business, with the consumer group reporting 18% revenue growth, the remarketing business growing 13%, and OLX India emerging as a standout performer with 29% revenue growth and a sharp 76% jump in EBITDA. Now, operationally, the company continued to strengthen its platform with around 80 million monthly active users and 95% organic traffic, while remaining debt-free with a cash balance of over 1,300 crore. Now, despite these strong numbers, the stock is under pressure today because it has already rallied ahead of results. So this decline is majorly due to profit booking rather than any weakness in the quarter.
Okay, all right, Ananya. Thanks very much for bringing us that update. So that's on Cartrade, market cap of over 13,000 crores for that particular company, and 52-week high stands at around 3,291 odd rupees. Well, those are all of the movers and shakers on halftime report this morning. We'll do one thing. We'll take a short break, but up next we'll focus on Manipal, that 9,275 crore IPO. I'll be decoding the key notables about the issue and bring you some management commentary as well.
Welcome back. You're still tuned into Halftime Report. The market continues its up move, but there's a lot of action which is happening in the primary space as well. Manipal Health Enterprises, 9,275 crore rupee IPO has opened. The offering comprises of a fresh issue and there's an offer for sale as well. Ekta, tell us more. What is the breakup? There was a conversation you had with the management as well.
Well, yes, I've had many conversations with the management over the years. Interestingly, Manipal Hospitals is the same hospital which was where Ranjan Pai, who was heading the company at one point in time, and now he's a significant shareholder, at one point in time even bid for Fortis, which was then eventually acquired by Eicher. So there's a huge story which goes back for Manipal. Remember that they've made a huge number of acquisitions. Eventually, Ranjan Pai sold his stake to Temasek, which is now the primary shareholder in the company. So finally, hitting the markets, it is a pan-India multi-speciality hospital chain. So that means that they have hospitals all across India and they offer everything in terms of medical services. So they have around 49 hospitals, they have around 13,000 licensed beds, and it is India's largest private hospital network by licensed bed capacity and India's second highest revenue amongst private hospital chains as well. So the offer details, 9,275 odd crores, fresh issue 8,000 crores, offer for sale is 1,275 odd crores, price band 560 to 590, and the offer will close on 31st of July. So we do have the likes of Temasek as well as Ranjan Pai's stake, which will reduce post the fresh issue and OFS, so and TPG as well. Now, in terms of utilization, the objects of the issue, 8,000 odd crores, debt repayment is majority of what they'll be using the funds for, so 5,500 odd crores, and total debt as of now is around 11,100 crores. So post this IPO, it will reduce by around 47-48 odd %. In terms of financials, revenue, FY26 was around 10,000 odd crores, so the revenue growth was quite strong at around 25.4%. Profit after tax around 916 odd crores, margins at around 27.05%. Remember that a large part of this growth is also led by the acquisition spree that the company's been on. So for example, Columbia Asia in FY22, AMRI, which was in September 2023, Medica Synergy, and then Sayadri Group, which was one of the big bang acquisitions that they made. It itself was a PE-backed hospital chain, which really helped them improve their presence in the western part of the country. So in terms of occupancy, FY26 around 64 odd %, and average revenue per occupied bed at around 68,900 odd rupees. Valuations, it's a little bit on the higher end if you compare it to Apollo and Fortis on an FY26 PE basis. It is close to where Max is at around 74 times. So that would be, valuations are a bit punchy according to most of the analysts that I've spoken to. Now, key points to note, they've already raised around 4,167 odd crores from 133 anchor investors. They will be net debt zero post the IPO. They are looking at M&A, especially strengthening their position in the Delhi and northern regions of the country. They will be looking at the Mumbai market as well. They made an acquisition of a Juhu hospital, so that should come on stream probably in the next 1 to 2 years. Sayadri, they are looking to improve the margins from 18% to 23 odd %. Price regulation continues to be a risk. Temasek has no plans to exit at this point in time. But we did speak to the management. We did catch up with them. So listen into what they had to say about the IPO.
Going forward, we have about 3,000 beds coming on stream through greenfields and brownfield expansions. Acquisitions would be opportunistic. We really can't predict if anything becomes available. There are geographies that are of interest to us. We would be alive to anything that will come up there. But I think over the next 3 years, the primary focus would be the beds underway to get commissioned and to also ensure that Sayadri, which we acquired about 9 months ago, fully realizes its potential.
Okay, that's all about Manipal Hospitals and the word coming in from the management as well. But on that note, we're going to sip into a very short break. After the break, we'll have Rajesh Balve of Axis Securities. He'll join us to talk to us about his trading strategies. Stay tuned in. Welcome back to a halftime report on CNBC TV 18. As of now, the Nifty is holding on to 24,222.30 levels, almost near the day's highest point. So 1% uptick for the Nifty 50. In the last 30 odd minutes, what's moved in from the broader end of the market? Keynes Technology, that's seen a sharp spike up as well. 2% uptick just in the last 30 odd minutes. Bandhan Bank, among other names, as well as Devyani Internationals, they reported their numbers as well. So yes, we've seen a bit of an uptick in these three names. So keep an eye out on that. All of them are trading around the day's highest point. But what's interesting on the macro front is India's June industrial output data that came in at a near two-year high of 7.3%, boosted by sharp rise in power, capital goods, as well as the manufacturing side. Lata is here to take us through all those details. Lata, over to you.
I'm increasingly getting convinced that India's outperformance compared to other markets is because the market is taking note of the lead indicators, and the latest indicator is the IIP number for June at 7.3%. It's a 23-month high. The last time we had a stronger number was July of 2024 when it was 7.8. And the IIP, the industrial output, is higher at 7.3 on a broad swathe of industries, not just one or two sectors. Electricity, gas, that is the utility segment, is up 10.6%. That's a huge number. You can argue that it was a low base because last year, same time, we didn't have the El Nino effect, and that's why electricity is higher. But for something like capital goods, 14.2%, it comes on a fairly high base itself in the June of the previous year. Intermediate goods up again almost 10%, 9.3. Infrastructure up 7.5. Consumer durables up 7.7. Consumer non-durables 4.9. Not very good, but better than several previous months. So now I'm convinced that the June IIP number could give us a 7% plus overall GDP as well, because, the other numbers like credit offtake, etc., also have been very strong, not only for June, but for previous months as well. In fact, let me give you the April-June IIP, which gives a sense that many sectors have been strong in the previous 2-3 months as well. Power and gas, like I told you, for the 3 months is 8.6% higher. Manufacturing is up 6.3 for April, May, June. Capital goods, a huge 14%. That's very ferocious. Capital goods. And like I told you, capital goods comes on a high base. It's not a low base effect at all. Intermediate goods, 8.5%. Many of the chemicals, etc., come over there. Infrastructure, 6.8, and consumer durables, 7.2 for 3 months. The overall at 5.8 looks low because, consumer non-durables has not done very well. But that may well be a measurement issue, Consumer non-durables are toothpaste and biscuits and things like that, which we are probably buying from newer categories, newer sources, which are not getting into the formal sector. My sense is that, this along with a very high credit offtake number of 18% loan growth, very high auto sales numbers that we have seen in April, May, June, we are heading for a Q1 at least, which is going to look 7% plus.
Okay. All right, Lata. Broad-based growth coming in and positive news coming in when we talk about the IIP. We'll take that with both hands. Thanks very much for joining in and giving us that data breakdown. But let's get talking about the markets now. We do have Rajesh Palvia, who's the VP Technical and Derivative Research Analyst at Axis Securities, joining in now. Rajesh, thanks very much for taking the time out. Well, Lata was talking about how the IIP data was extremely robust this time. But and the market seemed to be quite unfettered with all of the global headlines as well. How would you take all of this news technically, and what would your strategy be?
Yeah, hi, good afternoon. So it's the first day of August series, and looking at the rollover data, Nifty rollover was slightly lower compared to last 3 months, 6-month average, and we have seen a shedding of around 50 lakh shares for Nifty rollover. But broader market has shown, market-wide rollover has shown, confidence, and we have seen broader market rollover is quite on the positive side. Looking at the recovery on the very first day of August series, and now Nifty comfortably trading about to 24,200. So I think the call writers have shifted their position at a strike of 24,400 and 24,300 strike. So looking at the this shifting of call writing position, we believe that there is furthermore room for upside to continue for this pullback, as base is now shifted at 24,000, 24,100 strike. So I think till we are holding about 24,100, possible extension of this pullback we may see towards 24,350 to 400 kind of zone. So one can remain long side of trade with stop loss of 24,100. Some of the pockets where we are seeing, continuity of uptrend, like space like pharma, automobile, real estate, these all space are, continuously showing a buying interest, and we believe that, here further more momentum is likely to be there. So one can focus on these 3-4 pockets for near-term trading perspective. And IT is also showing very strong buying action since last couple of trading sessions. So short covering has already played out in IT stocks also. So traders can focus on this sector for near-term perspective. Moving to the stocks, the stocks where we are focusing is on the pharma side, and first stock which comes in mind is Aurobindo Pharma. After a brief correction, stock took support from its a 50-day moving average and very strong pullback from lower level. And looking at the open interest, we do see that a long built-up is there. Aurobindo Pharma can extend its momentum further higher. Possible target towards 1640 to 1660. On the downside, 1550 needs to keep as a stop loss. Another stock where we are focusing at this juncture is REC Limited. Stock managed to give breakout of its previous swing high, and looking at the breakout on daily chart, we believe that if it continues to hold about 370 mark, the possible upside towards 390, 395 we may see in the near term perspective. So one can look to buy this stock also with stop loss of 368.
That point. Thank you so much, Rajesh, for joining us today. So those are some technical bets for you. But with that, we'll do one thing. We'll slip into a short break now. When we come back, we'll get Manisha Gupta on the other side with me, Peter Maguire of Trading.com. We'll discuss crude oil prices. Stay tuned for that.
Welcome back, and joining us on the show now is Peter McQuire. He's CEO at trading.com. Peter, hi, thank you so much for joining in. And 4 to 5% of a move in crude oil prices per day seems to be becoming a norm right now. We've seen 14% decline in last 3 days and a 4.5% of a jump up right now. Many things happening, but I first want to talk about the Senate bill about Russian oil and gas and the sanctions on various entities. How have you read that?
Well, good afternoon, Manisha. Yeah, there is a lot to get through as far as Senate, what's happening as, and the proposition of it all, how that's going to impact naturally Russia and other markets, I would say. So these are all very interesting times. The state of, as far as the volatility through the whole oil complex is creating much angst, I think. And this is just just another part of the whole puzzle. So I'm going to see how it falls over the next couple of days, and let's see a response. And there are many different components that need to be considered, I think, in the whole agreement and the whole argument.
How are you also looking at the Strait of Hormuz? Because Oman did come out with a plan which was on the Malacca model, but clearly Iran has rejected that.
Exactly. Well, I think there's just so much tension between Iran and Oman. How's it going to flow as far as oil, ships coming in, who controls that, ships going out, the Malacca model, and of course the other tensions across that whole, Mandab, the Bab el-Mandab situation. So I think the whole tension is really starting to gain again, and it's going to be, again, quite fascinating how it leads up over the next couple of days, Manisha.
Absolutely. And today, the US Fed meeting announcement as well, that's going to be an added thing that the markets will be keeping an eye on. Having said that, just one more thing on crude. So what's your sense on prices from here? Because it's a big range that we already have seen for this year, 60 to 120. July has seen a range of 70 to 100. So $30 of a range already done in case of July as a month. How are you looking at the prices moving from here on?
Well, I would expect if you're looking at the situation, I would expect it to start to become in some sort of order moving into August and moving towards that, September, October timeframe. That's what I'm thinking, but that may not be the case. No one really no one knows all the deal tension concerned. So you would have to say probably the $70 to $90 handle, but you've just got so many variables that can be thrown into the argument. It's very difficult to try and center it on not only a time consideration, but also a price consideration, Manisha. So I think volatility is going to be the name of the game over the next month or two, and let's hope that it's more to the downside than it is to the upside.
Oh, well, yes. The dollar index holding above 101, Peter, would that continue to put pressure on gold and silver, as has been the case? Because overnight, it's been a 2 to 3% of a decline for most of these precious metal prices. Are you looking for the downside?
Well, I think, first off, you've got to look at what Kevin Walsh is going to do. Are we going to see a rate hike? Also the consideration, if it doesn't happen today, and I doubt it very much, if it moves into September, Manisha, that really puts a political interference sort of standpoint on. That's starting to gain a little bit of awareness. Everyone's realising that. You've got a 10-year running at 461. You've got a 2-year running at 429. If they were to raise rates or they don't raise rates, that's going to have an impact to gold. I'm expecting gold to have a strong fourth quarter. This third quarter is going to be, I think, a little bit sideways. But I'm thinking fourth quarter and early 27 are going to be standouts.
Peter, what's your sense also on silver? Because the way we have seen declines onto that one, does that look more bearish for the current quarter? Fourth quarter, as you said, is bullish. But third quarter, are we looking at lower lows, and would those be accumulation levels?
It seems to be holding. I'm looking at 58.20 sort of number, Manisha. It seems to be very range bound. It gets down to 57, back to 59. It's tight. There doesn't seem to be, huge breakouts on either side. So I'm going to call it, maybe a 55 to 62 sort of handle. It might have $1 or $2 shave off it, but there are just, again, so many big themes that need to be considered when you're looking at the precious metal market. Not only interest rate policy, but also geopolitics, and of course, what happens as far as, the markets in themselves and confidence levels and sentiment.
Point taken there, Peter. You know, a whole host of updates will come in even tonight, given what Kevin Walsh will do. But Peter, as well as Manisha, thank you so much for joining in. Manisha, thank you so much for taking us through that conversation as well. On that note, we're going to slip into a very short break. After the break, we'll have the management of Navneet Education to discuss their Q1 numbers and the road ahead. Stay tuned.
Welcome back. Well, let's get talking to some companies. Navneet Education is under pressure after reporting what was a weak set of numbers. The revenue was absolutely flat this quarter. The publication revenue declined. Export stationery revenue declined as well. The management, however, seems to be confident of delivering healthy growth in the publication segment for the year. To discuss more, we have Gyanesh Gala, who's the MD of Navneet Education, joining in now. Mr. Gala, thank you very much for taking the time out. I just wanted to start by talking about, the publication revenue, which is down around 3% Your total revenue is just about flat. You've said that that was because the curriculum changes in Maharashtra and Gujarat actually didn't come about as anticipated, and that's probably shifted revenue to Q2. Is that correct? Is that the main reason for this? And if you could guide for the following quarters?
Yeah, that's the correct reason. We can bring out or finally give the books in the market whenever the textbooks from the respective state government gives in the market. We can't give that before. Unfortunately, those textbooks were delivered in around mid-June, and we have to after some breathing period only we can supply in the market, and therefore the major revenue of the curriculum change will come in the second quarter.
Okay, so what happens to overall revenue growth that you're anticipating in FY27? If you look at your revenue growth trajectory, in FY23 it was 55%, and since then there has been a fall. It's been either single digits or there has been a fall that we saw in FY26. What are the current macros for the industry, and what does that mean for Navneet Education FY27 growth targets both on the revenues and EBITDA margins?
Yeah, the comparison that you just referred to FY23 may not be correct because the earlier two periods were the pandemic period wherein schools were shut. But normally in publication business, if we grow by 10 to 12% reasonably on a CAGR basis, is the right decision for a right view for us. And therefore, in the current year, we believe we should be growing around 10 to 12% in content publication business.
Okay. That's about your publication business. Also, overall, could you help us understand what would that growth be? And for EBITDA margins also, what is the level for FY27? Because versus last year Q1, which was at 29%, now EBITDA margins are at 26%. Q1 is always in terms of higher in terms of that margin. So what would the full year margins be for the company?
I understand. So first of all, and every time I have been saying this, that please don't look Navneet at a quarterly basis because it is one seasonal business, and spillover of business from one quarter to another is very, very common in our business. Therefore, please look at it at least half yearly. Overall, if I talk about the margins, then publications, we are sure to retain the same margins as last year. And in stationery, there would be little dip in the margins, mainly on account of the challenges that we are facing in our exports business and little aggressive branding strategy that we have adopted for the Indian market, which is a long-term benefit that we are looking at. And therefore, in stationery, our overall margin would be in the range of 10 to 12%.
Okay. You did mention exports, and that was one of the reasons your margins also saw pressure. It was down 9% on a year-on-year basis. What were the key challenges that you faced in your export business this quarter? And what might your guidance be?
Yeah, so part of the quarter, we had to supply at a subsidized rate to our present customers. And once the tariffs were rolled back, we could pass it on in the mid of the quarter. So therefore, that was one of the hit. The other hit was the manufacturing plant for the plastic category that we had put up specially for exports, that we could not utilize to its full capacity, being the first year, as well as the orders that we were expecting for that category from our customers didn't come through because of these challenges. And therefore, all the cost for that plant, including manpower, depreciation, everything that was debited to that business, and therefore margins came down.
Okay, take that point. Mr. Gala, coming back to the growth point, because you said, of course, we cannot compare it to what happened a few years back. There was a COVID impact. But what are you anticipating in terms of FY27 growth? Also asking you, because we are talking about this current curriculum change, right? For how long does it create that replacement demand? Will it show big time in your numbers in FY27, FY28? Give us a sense of that, because we've seen paper prices increase as well. How will all of that combine into FY27 and FY28 targets?
So curriculum change cycle normally happens over a period of 4 years. Now this year, the curriculum changes were in the lower grades where the volumes are not that great. And therefore, I just mentioned about growth target of 10% or so. Next year, FY28 and 29, we are going to see higher standards curriculum change where the volume impact as well as the price impact of each title is quite high, and therefore that time we will see better growth than even 10%. So overall for a period of 4 years, we will see total CAGR growth of around 12 to 13%.
Okay. 12 to 13% overall CAGR growth is what you're talking about?
Next 4 years, I'm saying.
Okay, next 4 years. Okay. Sir, I just want to know one more thing is in terms for the domestic stationery side of the business. Now, how much of your revenue is coming in from non-paper products? Could you help us understand that mix and how is that changing for you all?
Yeah, that is changing, but as a percentage of total stationery domestic is very, very small for non-paper, which we had recently started and aggressively planned to increase the categories there. So at present, the revenue is hardly 30 odd crore, but that will really grow in almost double or more than double. It will grow every year going forward because we are focusing in more and more categories now.
Okay, thank you so much, Mr. Kala, for joining us this afternoon, helping us understand the business of the company and the outlook for the company going forward as well. Thanks so much for that. That is Navneet Education. As of now, the stock is recovered from the day's low, down almost 2.97%. But let's talk about another stock that's in focus right now and seen a sharp spike up. That's Hitachi Energy. The Hitachi Global reported its numbers just now. They've upgraded their guidances across all their segments. For India business, only the energy segment is important, where they've seen order inflows of around 87% on a year-on-year basis. We'll wait out for more details, but only one segment is important. But after that guidance upgrade coming in there were a lot of HVDC projects on the Europe side, which they're talking about. All of this is something that's kept Hitachi Energy, the India side of the business, where energy segment is important, on a bit of an up move over there post the numbers. So let's keep an eye out on that. Now up 2% in the trading session. On that note, we'll step into a short break. After the break, we'll have Manisha, who will take us through what's happening in the world of crypto. Stay tuned in.
CNBC TV 18 presents Crypto Corner, powered by Binance.
Welcome back. Well, the equity markets are doing well, but what's the action in the crypto market? Let's go across to Manisha Gupta with all the update. Manisha.
Well, thank you so much for that. Well, as has been the case with all asset classes, even cryptos are watching out for the US Fed meeting announcement today, and the further cues would come in from that. But interestingly, before that, we have the Bitcoin, which seems to be holding steady above $62,000 to $63,000 therein. There are struggles, of course, to secure a more bullish breakout onto this one. But interestingly, Ethereum seems to be outpacing Bitcoin in relative ETF interest. There also is support from the decentralized network usage therein. You also have the Solana institutional boost coming in as Morgan Stanley rolls out Ethereum and Solana funds featuring ultra-low 0.14% fees therein. But there also are a lot of pressures within the DeFi system. To begin with, US Clarity Act, well, that has been officially shelved now by the US Senate, and that is something that has taken a backseat and weighing onto the cryptos. The second point is about the CME Group, which is logged in a legal battle with CFTC for the approval of on-chain perpetual futures marketplaces. And then there's capital consolidating away from Tier 2 crypto native towards regulated institutional traditional finance platforms. There's bad news also coming in from Bitmart and BitMEX, where they have announced a market exit. Similar case coming in from the decentralized data storage network Storj, which also has filed for Chapter 11 bankruptcy protection. And then finally look at the way the markets have moved in the last 1 week and the month as well. Week-on-week basis, we are looking at declines here. So when Bitcoin fell 3.5%, Ethereum is declined less at 1.5%. Month-on-month basis, you have Bitcoin gaining 9%, Ethereum clearly outperforming with 21% of gains there. And that exactly has been the case on a week-on-week basis. But month-on-month basis, most of the cryptocurrencies still holding to near double-digit gains for most of them.
Okay, all right. Thank you so much, Manisha, for joining us with that crypto update. And with that, we'll do one thing. We'll take your leave on this edition of Halftime Report. Do stay tuned. Business Lunch will take all the action ahead.
Stocks gain despite a fresh round of strikes in the Gulf as the street looks beyond the daily seesaw and puts the lens on earnings. IT, FMCG and metal stocks gain while the rest drag.
Gulf tensions hit L&T's execution in Q1, hurting profitability, but order inflows stay strong. The engineering behemoth maintains its FY27 guidance, and analysts see growth coming back once Middle East tensions subside.
It was a strong quarter for Tata Capital with improving interest margins. The lender sees growth picking up further in the commercial vehicles, corporate and gold loans, with a further expansion in margins to meet its ROA target of 2.5 to 2.7% for the year.
India's largest private hospital network, Manipal Health, launches its 9,275 crore rupee IPO, of which 8,000 crore rupees fresh issue will help it pare debt and become net debt zero. A marquee list of anchor investors buy in.
Oil reverses its overnight losses after Iran strikes a US base in West Asia. The US Senate taking a first step by passing the Russia sanctions bill can also spell 100% tariffs for big Russian oil importers such as India and China. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I am Hormuz Fatakia. With me as always, Arundhati Ramanan. Arundhati, good afternoon.
Good afternoon, Hormuz. The market starting the series with on a positive note. The Nifty holding well above that 24,200 mark.
Indeed, and it's been an August start to the August series, if you would like to call it that. It's a very earnings-heavy day. A couple of numbers have already come out so far. But the index doing well for itself, 24,230 is where we are, 250 points higher, and it has been steady all through the day. Unlike the last few sessions, there have not been any sharp gyrations and so on. And comfortably holding on to that 24,200 mark so far is the index. And this is despite the rise in oil prices that you have seen after a 3-day sell-off. A couple of results that I wanted to highlight. Devyani International was one of them. The stock was up 9% after the results were announced just a few minutes ago. It will be interesting to see whether it has held on to those gains or not. It was a sharp jump in profitability, still holding on to gains of around 6.5% is Devyani International. Adani Ports just came out with numbers as well. So the first of the Nifty names to come out with results. 4 Nifty names reporting results today. Adani Ports, Enterprises, Asian Paints and Eicher Motors. Adani Ports were 2.25% down after the company maintained its revenue and EBITDA guidance for the full year as well, Arundhati.
Absolutely. And if you take a look at the sectors, it's the IT index that's gaining for 3 straight sessions, and it's up 9% this week alone, right? Infosys is up 4%, TCS up 2%, Coforge continuing its up move, clocking gains of over 2%. The metal pack, if you take a look at that, that's also doing very well in trade today. The index is up over 2% in trade. We've got Tata Steel, Hindalco, JSW, all of them gaining over 2% in trade. But the top losing index is the realty pack. It's down 0.4%. We've got Phoenix Mill, which is down over 5% despite a decent Q1, but mixed brokerage views weighed on sentiment. We've got Brigade and Oberoi, both of them flat, but with a slight negative bias. So that's how the markets are shaping up this afternoon, Hormuz.
Indeed, and the one stock that was possibly the result reaction of the morning from results that came in after market hours yesterday was L&T. The profits and the order info numbers were surpassing expectations. The EBITDA was a slight miss though, but the stock's doing well. Positive brokerage commentary coming in as well. Vivek is here to break the numbers down for us and of course what brokerages are saying. Vivek.
Well, absolutely right. You summed it up very well. EBITDA missed expectations, but the street already had a hint given the fact that the management had alluded to the fact that H1 could be soft as far as execution is concerned, given so many supply chain disruptions. And they had highlighted that this particular year, FY27, H2 is going to be execution heavy. Now, what's actually kept the street quite upbeat as far as prospects for L&T are concerned is the fact that the management, number one, delivered a positive surprise as far as order inflow is concerned. Over 1 lakh crore of order inflows, up 14% on a year-on-year basis. That's very strong. Along with that, the management also has maintained the FY27 guidance of 10 to 12% top-line growth as well as order inflow growth. Along with that, maintaining the core margin expectations that they had set at the start of the year at 8.3%. What a broker is saying, along expected lines, quite upbeat. Jefferies has a buy rating, they have a target of 5,000 rupees. They are saying that the L&T stock could see a leg up to rupees 4,278 if global tensions ease, with earnings visibility adding to upside thereon. CLSA believes that Q1 was a beat across 3 of the 4 guidance parameters. It was a beat on new orders, recurring E&C margins, working capital, but on the other hand, execution was something that was a bit of a miss. JM Financial says that they expect double-digit growth in second half of FY27 as war-related disruptions subside, and along with that, they say that the core margin at 7% was ahead of their estimate of 6.3%. Overall, a thumbs up from most of the brokerages as far as L&T's prospects are concerned.
All right, Vivek, many thanks for taking us through those details. Now, a whole host of stocks were buzzing on the back of news flow and Q1 results. Ria is here to take us through all of those updates. Ria?
Well, yes, let's start off with Devyani International first. The numbers have been good for the company this time around. Net profit has come in at nearly 14.5 crores versus just about 3.5 crores that we saw in Q1 of last year. Revenue also seeing a healthy increase of nearly 17% compared to the previous year. Swiggy as well is up in trade today, up nearly 6 to 7%. And this is on the back of a comment from the outgoing Instamart CEO, who has said that they have successfully charted the path to profitability in the quick commerce segment. And remember, the results for Swiggy are going to be coming out tomorrow, so that will also be key to watch tomorrow. Moving on to DCM Shriram, which has been in focus on the back of healthy numbers. Revenue has gone up by nearly 9% compared to the previous year. Margins also holding steady at 9.5% in this quarter, with the net profit seeing a significant rise to nearly 614 crores versus around 114 crores that we saw in Q1 of last year. Bharati Phosphates also holding on to strong gains of nearly 13% today after a strong set of numbers. The results have been better than estimates on all fronts, though the volumes have been muted for them. Revenue has gone up by nearly 26% this time around. EBITDA also seeing an increase of nearly 24% versus estimates of a 23% decline for them. However, sales volumes have grown by nearly 4%, quite muted this time around versus expectations of a 7% volume growth. Moving on to car trade, which has also reacted to its earnings. In fact, despite healthy numbers, the stock has corrected nearly 4% today, and this is on the back of the fact that the stock had gone up by nearly 60% in the last 4 months. In terms of the numbers, we have seen healthy growth continuing for the company, with the margins crossing 30% in this quarter and all of the segments seeing double-digit growth. Thangamile similarly has reacted to its earnings. The stock has corrected nearly 10%, seeing profit booking despite strong numbers seen in this quarter. Remember, this stock has gone up by nearly 250% in the last 1 year. In terms of the numbers, the net profit has seen an increase of over 86% and revenue also going up by over 71% in this quarter.
Yeah, thank you for that update there. Of course, yesterday the other major sector that was in the news was FMCG after results from HUL and Varun Beverages, and most of these stocks have been big underperformers over the last few years, some of them still at multi-year lows due to slowing consumption growth, weak volume recovery and changing consumer preferences as well. Manglam is now joining in to get us more insight on the space as a whole. Manglam.
Well, notwithstanding the bounce that we're seeing today, traditional FMCG is at multi-year lows, feeling a serious loss of love. And as the names come up for you, you would see, pedigreed, blue chip, quality names trading at levels last seen 5-10 years ago. So HUL currently is back at August 2019 levels. If you look at ITC, that one too is back at nearly June 2017 levels. Almost 9 years ago, the stock would be available at 285 rupees itself. Then you have, Dabur, which is again July 2019. And as these names come along, just pause and think of the time. 10 years, 5 to 10 years is 2 business cycles. It's nearly 3 times lost in opportunity cost. And amidst this last 10 years, we've seen the demonetization, we've seen GST transition, we've gone through an entire pandemic and business models changing as well. Names like Imami and the others, all of them down to January 2015 levels as well. So across the board, there has been a serious sell-off. Case like Asian Paints, which has seen positive returns every financial year back at 2021 levels because of the disruption that we've seen on account of competition in the paint industry. Godrej Consumer, you had management changes. A whole series of analysts have also, come up and they've moved on as well. But these stocks have been just there. Why is that? High valuations, opportunities in other places, and slowing growth. But most importantly, the underlying consumption itself has changed. So it's these stocks which have been languishing at 5 to 10 years lows. But if you look at the last 5 years, and I'm not looking at companies which have listed in the 5 years, all the new age companies that we're visibly seeing a shift towards, but look at companies which have actually been listed for a long time, but seen a big move. Indian Hotels up 400% in the last 5 years. Radico Khaitan up 381%. Trent up 375%. Interglobe Aviation is up nearly 217% as well. And among the traditional FMCG companies, the ones which have actually managed to evolve with times, perhaps via acquisitions or growth into the urban premiumization themes, have done extremely well. Titan, for one, jewelry up 182%, Nestle up 70%, 45% gains for Tata Consumer, and Marico as well. So all love is not lost, but it's definitely lost for ones who haven't grown and who've perhaps stayed steady when the world was moving and the underlying consumer trends were shifting.
Absolutely, Mangala. Many thanks for taking us through that. But on that note, it is time for us to head into a short break. Up next, we will get you all the updates on the escalating tensions in West Asia. Stay tuned. Welcome back. You're still with us on Business Lunch. Oil prices rebound sharply after a three-day fall as renewed military action in West Asia revived concerns over disruptions to global crude supplies. In a statement on X, the U.S. Central Command said IRGC launched multiple ballistic missiles in an attempted surprise attack on U.S. forces based in the Gulf. CNBC's Dan Murphy joins us now with the latest. Dan?
Tehran launching what's being called a surprise ballistic missile attack on American forces in Jordan. But the significance here isn't the damage, it's the decision, because the US had said it had paused strikes on Iran, but Iran decided to strike anyway. The US military saying all of these missiles were intercepted and no casualties were reported. But now the focus shifts to how the United States chooses to respond. Overnight, CENTCOM said the US had already teamed up with Saudi Arabia to conduct strikes against Iran-backed groups inside Iraq. Groups it says that the Revolutionary Guard had directed to attack American troops and specifically Saudi energy infrastructure at the weekend. So we've already seen a retaliation to that. It's understood the kingdom was forced to shut down its 400,000 barrel a day Jazan refinery on Monday following what it said was attacks from Iran-aligned militia inside Iraq. The Houthis also claimed responsibility for that attack. CNBC has reached out to both the Aramco and the Saudi government for comment and for clarification. So we're now in a situation where the president will ultimately have to decide how to respond to this. On the one hand, he's working with the Saudis to strike back against those Iran-backed militia inside Iraq. That's now happened. Whether or not the president chooses to retaliate against this Iran strike on the base in Jordan remains to be seen at this point. At the same time, President Trump and Israel's Prime Minister Benjamin Netanyahu meeting in the Oval Office for 90 minutes overnight, the White House calling this meeting good and productive. However, this was a meeting that was also behind closed doors, and this is important to note. This is quite rare, even for President Trump, who of course, prefers to host leaders in front of a full-court press. Netanyahu's communications director pushed back on suggestions of a rift or a disagreement between the two on how to proceed when it comes to what to do next in the Iran war. And Netanyahu's team also pushing back even harder on the suggestion that Israel is driving American policy, saying that there is no truth in the claim that Israel is pushing the US in a certain direction on the Iran issue. Trump and Netanyahu also reportedly discussing Saudi normalization with Israel as well, which President Trump has now attached to the Saudi nuclear deal. So once again, the Middle East really working out exactly what's going to happen next year after what appears to be the end of President Trump's pause and what also looks like possibly an escalation in the region that the energy markets are also now responding to. With that, it's back over to you.
Dan Murphy, thank you for that update there. Now, shifting focus, U.S. Senator from Connecticut, Richard Blumenthal, says that the key Russian sanctions bill will see India and China explicitly targeted by up to 100% tariffs, and adds that these two nations are fueling Vladimir Putin's war machine. Listen in.
It authorizes tariffs up to 100%, the 5 largest purchasers of Russian oil and gas. It's carefully crafted to make sure we are not hitting our allies and that we are hitting China and India. Let's be really blunt. China and India are the main culprits here. They purchase the vast majority of oil and gas. They are fueling Russia's war machine, and they are doing us no favors anywhere else in the world. And you can see the effect of tariffs by the recent history here.
And on that note, it is time for us to head into another short break. More news and updates on the other side. Stay tuned.
Welcome back. Now, a big leadership trend is emerging in India's private banking space. The RBI clearing CEO's appointment much faster than before, with the recent approvals coming in weeks ahead of months. Ritu is joining in with more insights on this space. Ritu.
Well, an interesting trend that can matter for every large private bank out there. It's a new Jefferies study which shows that the average time that RBI takes to approve CEO appointments has now come down sharply. Now, Jefferies has looked at 9 private sector banks in the last 7 years, and it found that the average gap between a bank board naming its CEO and the RBI approval has been about 163 days. That's a little over 5 months on average. But in the most recent approvals, that amount of time has come down much lesser. Now, look at the recent examples. At IndusInd Bank, the RBI approved Rajiv Anand's appointment in a record 35 days. At Federal Bank, KVS Manian got the green light in 40 days. At Kotak Mahindra Bank, Ashok Vaswani's appointment took about 3 months only. Compare that with the historical average of more than 5 months, and the trend is really hard to miss. The study also shows that, there's another interesting pattern where boards typically don't wait till the last minute. So on average, they will tend to announce their choice about 238 days. That's nearly 8 months before the new CEO takes charge. And in most cases, RBI does approve the same tenure that the boards ask for, which is typically 3 years. But of course, there's been exceptions like Suman Katpalia at IndusInd Bank or Shyam Srinivasan at Federal Bank getting shorter terms than the boards had asked for. Which brings us to HDFC Bank. Now, Sashidhar Jagdishan's current term ends on the 26th of October this year. But the bank has already got RBI's approval for Rajiv Kumar as part-time chairman and is yet to announce the recommendation for the CEO. Now, HDFC Bank's own track record suggests it doesn't usually leave these decisions to the very end. So when Sashidhar Jagdishan was first appointed CEO in 2020, the board announced its choice in 191 days, or about 6 months before he took charge. But his second approval, it came in 2023. The board moved even earlier, 236 days, or nearly 8 months before the new term began. This time, with just 3 months to go, it's a much tighter timeline the bank is working with. But I suppose for the markets, the takeaway is this, that RBI approval timelines have come down quite a bit. So if RBI moves at the pace that it has recently, a nod could come through in as little as a month or two. And that hopefully eases some anxiety over this CEO appointment news.
All right, Ritu, many thanks for those details. Moving on, the all-important Fed decision is due tonight, and the central bank is widely expected to hold interest rates steady. Here's Steve Leesman with the findings of the CNBC's latest Fed survey.
Yeah, change is coming. Respondents to the CNBC Fed survey see no change in rates, however, this meeting, but they're divided on the outlook for hikes in the next year. And they are expecting big changes to how the Fed operates under new Fed Chairman Kevin Warsh, which come, by the way, with a measure of concern from our respondents. Just 39% of the 29 respondents expect Warsh to hold a press conference after every meeting. That's down from 59% of the June survey. 18% think it's going to happen only when the Fed issues the forecast or the SEP, and 19% say rarely, while 25% they just don't know. 59%, meanwhile, believe the dot plot or estimates about the future course of rates from individual Fed officials, that's going to be eliminated. Another 30% think they will be modified. A big issue here has been Warsh's refusal, not just to provide forward guidance, but even his reaction function, or how the Fed will forecast rates. Forecast rates will be set under different economic circumstances. 70% say the Fed should be doing this, that is, providing their reaction function. More than half, meanwhile, say not doing this will lead to less effective monetary policy, and 70% say it will lead to more market volatility. Guy Labat, chief fixed income strategist at Janney Montgomery Scott, says the uncertainty generated by Warsh's early pronouncements are forcing firms exposed to overnight interest rate swings to hedge against those swings, which will incur a cost in the long run. We might soon that volatility. We might see that volatility as soon as tomorrow. Fed futures markets place a 28% probability right now on a rate hike at tomorrow's meeting. That's a big number for a meeting where most expect no change, followed by a 76% chance of hike by September. Some significant adjustments are going to be needed depending upon what Warsh says or what he doesn't say.
All eyes on the big Fed decision later in the day. Numbers from KPIT Tech were flashing at the bottom of your screens. The dollar revenue growth is the one that you need to watch out for. When we shared in its investor presentation, the stock is recovering from the lows of the day after the results announcement. But we take your leave on this edition of Business Lunch from Arundhati and me. Thank you for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, Vivek Eicher. Good afternoon, Vivek. It's a broad-based rally. There's a green-looking screen across the board. The mid-caps are underperforming the benchmarks by a wee bit. And look at the IT move, 9% this week.
That's
and we're
right.
just done with 3 days.
Just done with 3 days, and IT clearly is the outperforming sector of this particular week, and strong start to the August series as well. But we have a lot lined up on the show, some important corporate conversations as well. So let's start off with the top headlines. Market continues to extend gains, trade near the high point of the day. Nifty trades about 24,200, led by gains in IT, FMCG, metals and pharma. Realty and auto trade with marginal cuts.
Thangamayil jewelry tanks despite a robust June quarter. Profit soars 86% and revenue climbs 70%. But the management's weak outlook fails to enthuse the street. Stock falls 10%.
Colgate delivers a decent Q1 show. Profit grows 7%. Revenue of over 1,600 crore beats expectation. Toothpaste segment sees high single-digit volume growth. Devyani International's profit skyrockets to nearly 15 crores from a mere 4 crores last year. Both stocks steady at lunch hour.
Phoenix Mills trades lower despite robust Q1 results. The retail realty major is set to buy CPP Investments' 49% stake in Island Mall developers. Investors wary of the large cash outgo and the likely risk in leverage, though this was announced earlier and is just a reiteration now.
Profit booking on shares of Cartrade Tech despite a strong showing in the first quarter. Margins post over 600 basis point expansion. Company posts double-digit growth across segments.
Okay, all right, those are the top headlines that we are tracking. The market mood is in favor of earnings. Good earnings are getting rewarded, but there are extreme moves if they are not in line with street expectations as well. But mid-caps, they continue to be on our radar, and this is our segment, Mid-Cap Movers. We have Ria to take us through the mid-caps that are moving around in trade. Ria.
Well, yes, starting off with the gainers first, we have Paradeep Phosphates reacting to its Q1 numbers and trading on the back of very strong volumes as well, nearly 52 times the monthly average volumes traded today. First Source Solutions, Jupiter Wagons as well as Devyani International all performing well today. In fact, all three of these stocks are also trading on the back of strong volumes, anywhere between 15 to 32 times the monthly average volumes traded on all of these counters. And Honeywell Auto also seeing a strong gain today. Also looking at the EMS sector, which is seeing strong performance today, we have Keynes Technology up nearly 13% and Dixon Technologies as well as Syrma SGS also following in that pack. And on the flip side, looking at the losers in today's trading session, we have Phoenix Mills, Sumitomo Chemicals as well as Cartrade all reacting to their Q1 numbers. And apart from this, MV Photovoltaic as well as KFin Technologies also taking a cut in today's trading session.
Well, thank you so much, Ria, for joining in and giving us all of the movers as far as the broader end of the markets are concerned. But like promised, Knowledge Realty Trust is the first management on the show. The company reported a good set, steady growth in revenue, operating income. To discuss this and the road ahead, let's welcome Shirish Godbole, CEO of Knowledge Realty Trust. Good afternoon, sir, and thank you so much for joining us. And thank you for coming to our studios. Well, give us an outlook as far as how exactly Q1 panned out and what is the DPU per unit we can expect for the rest of FY27.
Thank you, Sonal. Thank you, Vivek. Well, it's been a solid beginning to our year. The first quarter results we just announced yesterday and, led by very strong leasing performance, 1.4 million square feet of leasing, 700,000 square feet of sort of new leases and 700,000 square feet of renewals have allowed us to move our occupancy up from 92 to 93% overall, which is very strong across the board. And that has allowed us, and it sort of filters through to revenues and then to income and then to distributions, right? So we've had 15% year-on-year growth on both revenues and on income, and then a 5% quarter-on-quarter growth up to 1.70 rupees per unit for our distribution. So it's been a strong performance across the board, and we're very happy to have that footing as we sort of move forward. What I wanted to add, though, is, while the leasing performance gets a lot of attention, I think it happens for a reason, right? It is because I think KRT is what we call, it's because of our 3 Gs. And that's because we've got grade A assets in grade A locations with a grade A team. And I think it all has to come together, right? Because it doesn't just happen in a vacuum.
So exactly, Shirish, because the going has been great for the industry, for REITs in general. We are talking about high leasing coming in from GCCs in particular, and that's driving demand. So what kind of growth aspirations does Knowledge Realty Trust have from here? The dividend per unit is the most important thing that a REIT unit holder would look at. What kind of growth are you penciling in here?
So again, we don't give out guidance, so I'm not going to put specific numbers on, but it's been a solid performance, right? With 40% of our last year's leasing target. I mean, all of last year we did 3.5 million square feet. We've done 1.4 already this year. So clearly we're going to go past the 3.5 million number, whether we go to 4 or 5, I think that's the question. We're already at 93% occupancy, so we definitely want to push the pedal and see if we can get to a higher number, whether it's 94 or 95. We'll see over time, right? It's hard to put a number always, Sonal. I know you would love to get a number from me, but it's just hard. And it's not appropriate because, the world is a volatile place. And I think what's also particularly, good about these results is in light of the headwinds we've had and the geopolitics, there's been a lot of questions about how will office perform, will it lease, will it not? And in that context, to be able to come back with a solid performance, I think answers the question about, how Indian office is performing. And it's not just GCCs. Of course, GCCs are performing, but even the front office, in our Mumbai portfolio has done well. So all Hyderabad, Bangalore, and Mumbai have been firing.
But you said you can't give a number because you keep getting questions on geopolitics, and that is my question. Do you think that is a risk?
So, is it a risk? Of course it is a risk, right? Big picture. However, what is clear is that the office occupiers clearly have a long-term vision for occupancy in India. And despite the volatility, people are actually signing up leases, right? 1.4 million, 40% in one quarter. Just shows you, the numbers show you that despite the volatility and despite the headwinds, people are actually signing leases and moving forward.
Well, you said you can't put a number to it and we won't push you too much, but give us a sense of the prospect pipeline. And typically when you do make an acquisition, for a rented or a leased place, what is the kind of occupancy rates that you typically target? So will there be a ramping up capability or a potential over there that will help investors gain a little bit more?
Yeah. So, I think if you just step back, if you look at where we are in terms of acquisitions, we continue to look for acquisitions. It depends on the opportunity, right? There are opportunities we have looked at where the occupancies have been low, where we've had the opportunity to ramp it up, like you said, and then that'll increase occupancies. There have also been opportunities which are already leased up, but that's okay because, we have scope and potential to buy both. But I think in terms of growth, we're looking at not only occupancy growth, we're looking at mark-to-markets, right? Our portfolio has a 25% mark-to-market opportunity. So we're looking at growing rents in that fashion, right? We're also looking at 2.6 million square feet that's under development. So we're, going to get more rent and growth from, those opportunities. And then acquisitions, like you mentioned, and we're, on the lookout and we'll do all of the above in the next 12 to 24 months.
Okay, so you said you've done around 1.4 million square feet in quarter 1, which is almost half of what we did last year. Are you being conservative with your 4 to 5 million square feet of addition in terms of portfolio this year? Will it be better than that, much better than what you saw last year?
What I said is we did 3.5 and we're definitely going to eclipse that, right? Now, I really don't know. Honestly, it depends on the markets. It depends on a lot of things, right? It's timing. Sometimes
will it be organic addition or will it be inorganic addition that you'll see this year as well?
So the answer is we'll definitely have some inorganic acquisition and therefore growth from there as well. It'll happen this fiscal year. What size, what quantum, I think,
What area? Will it be Hyderabad, Chennai again?
Well, again, we're looking at multiple opportunities. All 6 office markets. Honestly, we're looking at Gurgaon, we're looking at Pune, we're also looking at the South markets, and then Mumbai continues to be a home base. So, we will make an acquisition, 18% leverage. We're very lowly geared, so we're well positioned to acquire. We just need to get the right asset at the right price. The problem is both the rights.
Right. So, last question, at least from my end. You've spoken about low leverage. Your cost of debt too has gone down meaningfully. So going forward, can there be further addition or further scope to increase interest rates, that gives headroom both for profitability to grow up and also, to take on more leverage as needed?
So honestly, that's not an easy task because rates are already at where they are, right? And if anything, there's pressure to move them up. So frankly, getting the rates lower, I don't think it's going to be that easy. We're looking at some green bonds and other ways to try and maybe reduce pricing. But overall rates are where we are. I think it's a different cycle now in the next 12 to 24 months. And I think it's more about showing growth in the demand, in the rents, as opposed to taking advantage of lower rates going forward.
Okay, so just a quick one on that, since you spoke about rents, 25% is the MTM potential, and there will be rent increases. What percentage of your portfolio is coming for rental escalation? How often does that happen?
Yeah, so it's a good question. It's about 6% per year, roughly comes up. So you're right, it's not overnight. But, you know, we always look for opportunities to see if we can move a tenant or a tenant wants to expand. Or in some cases, some tenants want to leave. And that's also okay, because if they leave, we get a great opportunity to ramp the rents up as well. So there's multiple ways to take advantage of this. We don't have to keep waiting for the 6%. Yes, the 6% is going to happen anyway, but I think we can do more.
Well, thank you so much for coming in. Thank you so much for joining us in the studio and answering all our questions. We would have loved a few more numbers and a few acquisition targets, but that's for another conversation, I guess.
Thank you. Thank you for having us. Yeah.
Okay. On that note, we'll take your leave for now. It's a short break, but up next, we'll come back with Moltec Packaging's management on the other side on their Q1 numbers. Stay tuned. Welcome back. You're still tuned into Midcap Radar. Moltech Packaging, that is the management on the show now. The company reported a strong set of Q1 numbers. Revenues were driven by healthy demand across the businesses. To discuss this and the road ahead, we have Lakshman Rao Janumahanti, who's the chairman and managing director of the company, joining us now. Mr. Rao, good afternoon. Thank you so much for joining us. Well, you have maintained your volume growth guidance of around 10 to 12%, but you've increased the EBITDA per kg guidance to around 44 to 45 rupees versus 42 to 43 rupees earlier. What makes you confident of increasing the EBITDA per kg guidance at a time when raw material prices are higher, there are supply issues, but the volume guidance is the same? Can you explain the reason for that?
Yeah, volume guidance remains a little muted because of the war situation around and some of the input material problems for especially lube oil industry. But for that, our internal consolidation of units in Hyderabad and improved efficiencies, better capacity utilization, driving our margins up. And mainly the contributing factors are pharma and food and FMCG have gone up by 38% and 26% quarter on quarter, which add more EBITDA per kg compared to our overall mix. So that's why I'm confident that we'll be able to improve our EBITDA margins going forward in spite of the raw material price hike. Because as I always say, raw material price hike, we pass on either ways, up or down, in a gap of 1 month to our clients. And that's the way we have been doing business for the last 30, 35 years. So raw material price hike only happens little impact on our interest costs because for increased working capital needs. But for that, there is no major damage to the company. So the benefits are coming because of the consolidation we have done in the last 6 months and improved efficiencies and high margin product sales growing at a higher base.
Okay. Sir, give us a sense of how exactly is the paint segment panning out. How was Q1? Was there increased offtake that you saw in Q1? What's the outlook for the festive season? And is there increased ramp up of capacity as far as both Asian Paints as well as Grasim Paints portfolio is concerned?
Yeah, we have grown around 11% in this Q1 on Q1, which is a very good growth in paint industry, which we have been not seeing in the previous quarters. So going forward, we are confident we will maintain double-digit growth in the paint industry with both our major clients and even other 3-4 major clients like Narolac and Berger adding more numbers and growing at a good pace. So I'm confident of maintaining a double-digit growth in the paint packaging segment.
Okay, so the paint segment continues to do well. What about, you said that volume growth is a little muted, the guidance that is because of West Asia crisis. Had there been no crisis, would the volume growth be much higher than that, considering that you are seeing more contribution coming in from pharma as well? How much did it contribute this quarter? What is the target for the entire fiscal?
Yeah, we have given a guidance of 50 to 55 crores for pharma. I think we have done close to 11 crores in the Q1, which is up by 38% compared to last Q1. And going forward, major clients are still being added. As we talk, every month we are adding a couple of clients into audit level to commercial supplies level. So that will hasten up the numbers in pharma further, and we'll be sure in the bracket of 50-55 crores for the entire year. And pharma, food and FMCG is now 26% growth, which we have not seen in the last several years. At least for last 3-4 years. So 26% in one of our high contributing margins is what gives me confidence of sustaining higher EBITDA going forward. And we see trends are reversing even in the lube industry because of better connectivity of base oil, which was a problem in March, April. I think now they made alternative arrangements and the lube numbers, which have slipped by 17% in Q1, are going to at least come back to neutral. So which will add almost 3 to 3.5% of our volume growth. So going forward, volume growth can reach close to 10% again. And EBITDA should grow at least at around 20% is our minimum target.
So, you took a structural change, in the quarter gone by over the last couple of years where you've actually gone down and ramped down or consolidated 5 units that you had in Hyderabad and you've now brought it down to 2. So give us a sense of how exactly this aids cost reduction for you and what is the kind of margin expansion you will get only from the cost reduction efforts you've made?
Yeah, this is a very important move we have taken up a year ago. consolidating 5 units spread across Hyderabad to 2 major units. The first unit, Anaram, and the other one, Sultanpur. In this process, we brought entire printing operations under one roof in Sultanpur. Earlier, die cutting used to happen elsewhere, rotogravure printing elsewhere, flexo at another unit. So there was need of more manpower. There's a loss of movement of goods, which entail costs and also damages during transportation. So now we brought everything under one roof. All printing happens in Sultanpur C block, where we have found at least 2 to 3 rupees per kg savings, which are permanent. These savings are not one day or one-time benefit. And this is going to stay and may to improve also further. So we could reduce the number of people, number of management staff, supervisory staff, and also movement of goods between the units and rejections rates. And now the accountability on people is more because it's all under one roof, which has improved our efficiencies considerably.
So one last quick question from our end. So what we want to understand is end of FY27, what will the revenue mix look like, in terms of paints, in terms of pharma, in terms of food? And amongst that, do you expect the higher margin contributing businesses to start inching higher in terms of the revenue pie?
Certainly. We are looking at various things in pharma, which will enhance our
KPI data.
not only this year, but going forward, we are confident of maintaining 40% growth. We are looking at entering into dosage pens and ophthalmic products, ophthalmic packaging for pharma, and also semiconductor trays, which are injection moldable and which are directly suitable to our existing machinery, which are imported from Japan. So all these new products are really exciting and high EBITDA contributors. And these three segments, apart from that, the base of our paint industry is also rapidly sustaining at 8 to 10% growth, which is very important for our overall numbers. So I think we are on a very strong wicket going forward. And with pharma and food, especially in North, plant is now doubled capacity for food and FMCG. And we are finding more and more clients are coming over there. And a new team has been created in Delhi to expand our marketing efforts. So with all these things going forward, EBITDA margin improvement and also can be achieved.
Thank you so much, Mr. Rao, for joining us and patiently answering all those questions. So strong commentary coming in from Moltech Packaging after a very strong Q1 earnings that the company has reported. The stock is at the day's high, but we do have KPIT Tech, which reported numbers a while back, and the commentary is positive, especially on margins. They see that Q1 FY27 EBITDA was impacted because of revenue reduction. However, from here on, margins will improve successively every quarter, aided by revenue mix and growth and AI-led productivity gains as well. They say that there was decent growth in US geography and after sales and vehicle engineering and design practices, and healthy traction is seen in products and solutions as well. So the commentary has been strong. They say we will return to stronger growth in second half and FY27 and beyond. So that is the reason that sharp spike from the lows of the day on that stock, and it is higher by 8%. Slip into a short break now. Come back with more on stock specific action and market moves. Stay tuned. Welcome back. You're still tuned into Mid-Cap Radar. Well, earnings are coming in thick and fast, and that is something which is leading to major moves that we are seeing on a couple of these names. Nifty continues to be higher, 270 points higher. There is an important news piece coming in on M&M, where they've approved the sale of company's truck and bus division to SML Mahindra for 525 crore rupees. The stock is sharply off the highs of the day and is at the day's low. So it's within the group, the transaction that has been made, but of course it's a sale of 525 crore rupees for the truck and bus division to SML Mahindra for 525 crore rupees. Important one, but trying to understand how big that particular segment is for Mahindra. And 525 crore rupees coming to the books of the accounts. Of course, any cash is good, but in terms of the revenues that this particular segment has is something that we'll get into Darshan and understand.
That's right. For a while, the market was expecting that, looking at the passenger vehicle as well as the truck vehicle, PV as well as CV, there was expectations that at one point of time, post the acquisition of SML Isuzu, there could be, some sort of corporate arrangement of this sort. Of course, Sudarshan will join in and give us a lot more details, but we will have to take your leave on this edition of Mid-Cap Radar. Your stocks when we return.
Hello and welcome to Your Stocks on CNBC TV 18. We're coming live from the CNBC TV 18 Motilal Oswal studios. I'm Vinny Motiwala. With me is my colleague Arundhati Ramanan as well. Arundhati, good afternoon. And today we're seeing back about those 24,200 levels, 24,250. Around that mark is what the Nifty is as of now, trading at day's highest point for the Nifty 50. 1%, more than 1% gain for the Nifty 50. We have the IT pack that's managing to hold on to very strong gains. In the last 3 days also, we have seen a very sharp move coming in for the Nifty IT pack today, also holding on to around 2 to 3% gains. Banks also seeing a bit of a support there, almost 0.8% of gain coming in for the Nifty Bank as well. Broader end of the market today is doing well in the trading session as well. We have a lot of earnings that are coming in as well, Arundhati.
Absolutely. And you know, the market's starting the new series on a strong note. If you take a look at that advanced decline ratio, we've got 2,054 stocks advancing for 1,005 stocks declining. And the IT pack, as you mentioned, is the top gainer today. And that index has seen gains of 9% this week alone. On the downside, we've got very few losers, but it's that realty pack and the auto pack that's lower in trade today. We've got Asian Paints numbers coming out there. Net profit at 1,539 crore rupees. And and its EBITDA at 2,169 crore rupees versus the poll of 1,870. So looking better there on the EBITDA front. Margins also better than what the poll was throwing up. Margins coming in at 20.6% versus the poll of 18.3%. That stock also gaining 1% in trade. It's reacting to its earnings. It is higher in trade right now. Net profits also coming in better than estimates at 1,539 crore rupees. Revenues too mildly higher than what the estimates were throwing up at 10,542 crore rupees, Vinny.
Absolutely. As of now, you know, we're seeing a bit of a spike up coming in. The decorative business volume growth, that's important as well, right? Coming at 9%. We're expecting in that 8 to 10% range as well. So just right in the middle of there, 9% is what the decorative business volumes have come in for the company. Like we said, right, margins slight bit better as well. What we are also seeing in terms of commentary coming in, industrial coatings, that sustained a mid-teen growth momentum. So that is interesting. Decorative segment as also seeing a growth as well. So there's broad-based growth across the coating portfolios as well. And to understand more in terms of what Asian Paints, you know, where the beat is coming in, we're seeing 2% uptick now almost for the stock as well. Mangalam is here to take us through those details. Mangalam, afternoon and over to you.
Well, it's a good set of numbers that have come in from Asian Paints, though it's mildly better than street expectations. And remember, the stock has been a bit of an underperformer. So as a result of which we are seeing an uptick on the counter as well. Decorative volume growth coming in at 9%, bang in the middle of 8 to 10% guidance that the company had given and the expectations for the company as well. The good part is that on a reported basis, on absolute EBITDA, revenue as well as the bottom line, there has been a mild beat. And more than anything else, you know, all the factors are playing out for the company. Remember, they had said that there could be a bit of a renewed focus coming in on account of pricing up moves that these companies have taken. So the paint industry is benefiting from higher prices. Add to all of that, remember, you know, they also will benefit from some of the low-cost inventory that they had in the first quarter, which is why the margins have seen a bit of an expansion. These companies have taken a near 12% price hike, so realizations have moved slightly higher, and alongside that, we've seen volumes coming in as well. The last leg of growth over the last few years for the company have been increased industrial performance, and that's something that has been coming by for Asian Paints as well. While the overall decorative paint business has grown at 9% volumes, the industrial business growing in mid-teens is something that, you know, puts the thesis back on growth for these companies. And as we speak, the stock continuously moves higher. The only couple of things that we have to monitor from here on is the demand that we see, particularly on the decorative side in rural and beyond, largely because of weaker monsoons, and also the uncertainty that we're seeing in raw material prices. Crude oil prices fell lower. From there, they've seen an increase. So what does that do to the overall pricing scenario? And finally, we monitor what happens to competitive actions as well. Because remember, the latest disruptor, Birla Opus, in the last couple of quarters has taken a price hike enough to normalize all the price-led competition for the industry, which means that all the other competition for all these companies will only be below the line. So we'll just monitor how this goes. The stock continues to surge because it is a positive set that has come in slightly ahead of expectations, volumes in line, and all growth triggers being in place, along with the stock having underperformed in the past. In fact, this morning itself, we were talking about how at current prices, Asian Paints is at levels which were last seen in 2021. So obviously, it has been an underperformer and now bucking the trend.
Absolutely bucking the trend. The stock doing well there after its positive numbers coming in Q1. It's now 3.2% in the green. But joining us today is Somil Mehta, Head of Retail Research at Mirae Asset Sharekhan, and Parthiv Shah, Director at Trackcom Stock Brokers, to answer all of your stock queries. But before we get to that, Parthiv, Asian Paints, they're coming out with a positive set. The stock surging now. What do you make of this?
I think fantastic set of numbers, I would say, despite the fact that we know that this is a very competitive intensity after entry of Birla Opus. And the management did manage a 9% volume growth in the decorative space in FY26 and come FY27 Q1. I think they've again delivered that 9% growth, which is very good on a substantially higher base. And as Mangalam rightly pointed out, there could be some element of lower inventory that they were enjoying. But I think the margins are also pretty good. So overall, it's a beat. And I think the worst is over for the paint industry. Now we are seeing the repainting growth, which is happening as a result of it. The entire industry is witnessing a very decent growth in terms of volumes, which is what I think the street focuses on. And that's why big thumbs up on the stock.
Okay, big thumbs up coming in there for the stock. But let's move on and get started with the stock-related queries for today. We have Ravi Kiran, who's writing to us from Bihar. He's writing this query from his father's behalf. His father's holding 100 shares of Ashok Leyland. Price is 160 rupees per share. That bought it recently in the past few months itself. Now, since then, the stock has been a bit on the declining trend versus their buy price of 160. It's at 157. So they want to know what should they be doing with the stock. Continue to hold the stock, average, or get out of the stock. Parthiv, let me take the fundamentals first and then go to Somil for the technical as well.
So assuming the investors are 3 to 5 year horizon, I think there's nothing wrong holding this stock for long. Reason being, it's the second largest manufacturer of commercial vehicles in the country. It is like the fourth largest in terms of manufacture of buses globally. And they forayed well into the EV space as well, especially for the light commercial vehicles. And I think the company is continuing to benefit in terms of the good cycle in the CV segment, where the replacement cycle is pretty high. There's high infrastructure spend, and there's a lot of improvement going on in the fleet utilization levels. So as a result of which, I think both Ashok Leyland and Tata Motors CV are finding it good in terms of the cycle. So I would suggest, I think it's really very well poised. And in terms of, I think the valuations after the correction, I think is looking pretty reasonable. So I would suggest a hold for long term.
Sure, Parthiv. And Somil, Ashok Leyland, the viewer has bought it at 160 rupees. Should they continue to hold the stock? What's your view? What's the technical view on the stock?
Yeah, absolutely hold on to it. Good stock to be in. It's been consolidating between 145 and 170. It's a broad range, but I think this range should break on the upside. It's already in the uptrend in the long run. It's been in the range, and I'll be expecting this range to break on the upside. Now, on the downside, as I said, 145, 140 remains a very, very crucial support for Ashok Leyland. My view would be positive in the short term, in the medium term, in the long term, all three time frames. And my target in the medium term at this point of time would be around 180 to probably 185.
All right, positive in all three time frames, so very positive on the stock at this point. So that's the view coming in there for Ashok Leyland. The next query is coming in from Natarajan Ramanathan, who writes to us from Chennai. He wants to know if it is a good time to enter into any of the sugar stocks at current levels for the long term. He's looking at an investment of 5 years or more than that. So Parthiv, any of these sugar stocks that are looking exciting at this point in time?
No doubt, I think sugar as a sector is a very difficult sector to track because it involves a lot of cyclicality. But I believe the fortunes of this sector have slightly improved because of government policies of higher ethanol blending and also government support in terms of the biofuels and increasing in contribution of ethanol and power generation. So I think that has given some stability to this sector. But our sense is, I think it's best if the investor has a long-term view, then to go with the best managed companies, namely Balrampur Chini or EID Perry. I think these have been, I think, one of the finest running companies, and despite the massive cyclicality, a company like Balrampur Chini has also done a lot of buybacks because of a very pristine balance sheet that they have. And going ahead, I think they're diversifying into more organic sort of products in terms of replacement of plastics. So I think our sense is that it's better to go with a company like Balrampur Chini, especially if the viewer has a 5 year.
Okay, Balrampur Chini is a better bet for the long term. That's on the fundamentals. On the technicals, Somil, what's your view coming in for Natarajan, right? He's looking at any of the sugar stocks, long-term story. What would you suggest?
I would choose the same, Balrampur Chini and EID Perry. Balrampur Chini is already in the uptrend, high top, high bottom formations, great setup. The stock is looking really good. But if you are looking for a reversal trade, if you're looking for some a trade where you want to fish the bottom, then EID Perry looks really good. A triangle formation on the daily charts, trading about 20 daily moving average. I'll be expecting this, triangle to break on the upside. Breakout level is above 792. So if it closes about 792, I think it's a great bet. My targets on the upside in the medium term would be around 870, 875.
Okay, that's a view coming in there on the sugar stocks. But on that note, we're going to step into a very short break. After the break, we'll come back with more of your stock-related queries. Stay tuned in.
Welcome back. You're watching Your Stocks. Still with us are Somil Mehta of Mirae Asset Sharekhan and Parthiv Shah of TrackCom Stockbrokers to answer all of your stock queries. The next query is coming in from Vinay Gorai, who writes to us from Calicut. He holds 100 shares of Sula Vineyards at 311 rupees. He's making a loss on that stock. And he also has shares of Vikram Solar at 332 rupees that he bought it at. And he wants to know whether to hold or sell both of those stocks. He's making a loss on both Sula Vineyards and Vikram Solar, very different sectors. Parthiv, what do you make of the stocks? Should he continue to hold or should he sell both those stocks now?
Somehow we are not very upbeat on Sula Vineyards. If you see, ever since the company got listed, it has destroyed a lot of shareholder wealth. And if you even look at the sales trend over the last 5-10 years, it's hardly managed to grow on low single digits. And even in terms of the margins, I think they've been quite eroded. So what margins we saw near about the IPO time, I think the company is doing a lot lesser. Goes to show, I think, due to maybe a weaker discretionary demand, and more importantly, I think the other brands taking over, I think it's been struggling. So our sense is, I think the better way to play the sector is by going with players like United Spirits or Radico Khaitan, where I think in terms of the real premiumization trend, they've really picked up in terms of the volumes. And more importantly, if you see, the market share has been going up for these players, and they've been focusing on the key prestige and above segments, which has also been helping them. So our sense is that I think the investor is better off being investor in United Spirits or Radico Khaitan vis-a-vis Sula Vineyard. Talking about Vikram Solar, I think we are not very upbeat on the module manufacturers or the guys who are also backward integrating into cells and ingots. I think it's better to go with the independent power producers, mainly say companies like Team Max, where currently they have operational capacity of almost 3 gigawatts. And going ahead, I think they have contracted almost 5.7 gigawatts, of which 2.7 gigawatts is under construction. So there is very good visibility. It's a fantastic business model. They cater to a lot of prestigious clients like multinational corporates and more importantly to data centers, etc. So I think we prefer these players as compared to the module manufacturers.
Okay, that's a view on the fundamentals for Sula Vineyards as well as Vikram Solar. But Saumil, coming to you, Sula Vineyards, obviously, wealth destruction, even Parthiv highlighted it. What should they be doing, right? They bought it at 311, and even Vikram Solar, 332 is the buy price. Suggestion for this too on the technicals.
Sula definitely a wealth destructor, but fortunately at this point of time it is moving up. Now I would suggest wait for a little while. It should touch probably around 180. So sell on rise should be the strategy in Sula. Enter into United Spirits. United Spirits definitely looks really good from here. I'll be expecting new highs for United Spirits. So United Spirits would be a replacement for Sula. Now now Vikram Solar, I'm positive on this stock in the short term, in the medium term also, because we have positive divergence on the daily charts, and I'll be expecting this stock to go above 200 210 levels in the very short term. But if it closes about 235 236, then I think the next move on the upside starts for Vikram Solar. So I'll hold on to Vikram Solar right now.
Okay, you would hold on to Vikram Solar. You also said United Spirits, that's looking exciting as well as of now. Let's move on to the next query for today. This one is coming in from Sambi Reddy, who's writing to us from Guntur. He's holding 200 shares of HDFC Bank. This is at a price of 860 rupees per share. Then you have other stock that they're holding is 100 shares of Shipping Corporation of India at a price of 290 rupees per share. Long-term investor wants to know if they should continue to hold both the names. Parthiv, HDFC Bank, obviously, we know it's one of those biggest banks, private side, but so many things that keep happening that investors are now worried that should they continue to hold this. And right now, from the buy price of the viewer, it is below their buy price. So what should they be doing with both these names?
Yes, Vinny, you rightly pointed out at one point in time, HDFC Bank used to be a type of bank which never disappointed in terms of the results, and it would always grow almost twice this growth of the industry or twice the growth of the country's GDP. And of late, we have seen in terms of the growth, despite the overall credit growth being very healthy at to the tune of 17%, the bank has kind of slowed in terms of the disbursement. But I think that could be a strategy that the management is working out. And more importantly, I think looking at the last quarter, I think the markets were slightly disappointed, as a result of which I think post the results, when the other private sector banks did relatively well, I think HDFC Bank kind of corrected. But I think what we feel is that the investors already invested around 860 levels. And at these levels, I think the valuations are extremely attractive. So I would suggest some cost averaging, because we are confident that over the next 3 quarters, this will be the bank which will certainly bounce back, thanks to the fact that it has a very good quality balance sheet, both from the asset and the liability side. And the liability side is growing, which gives us confidence that going ahead, they'll be able to disburse loans and also try and improve the NIMs. So I would suggest cost averaging in HDFC Bank.
All right, cost averaging in HDFC Bank. Somil, you know, he holds 200 shares of HDFC Bank and 100 shares of Shipping Corporation. There's been a lot of news around HDFC Bank in the recent past, but what do you make of the stock, and, you know, what levels to watch out for the viewer?
The SCI, Shipping Corporation of India, definitely a hold. I definitely like for long term. A short term, there is a little bit of pain. Medium term, a little bit of pain. But I think long term definitely should hold on to it. My targets would be above 350 levels for in the medium term outlook. But HDFC Bank, there are two ways to look at it. If you're holding HDFC Bank to balance your portfolio, to give a balance to your portfolio, then it is absolutely fine to hold on to HDFC Bank. But if you're trying to, make good returns out of your holdings, then the smaller banks would give you more returns, because since 2021, HDFC has been around 750, 800 levels. There was only a couple of months where it went to 1,900 levels and then came back. So if you're trying to make money out of the returns out of your holdings, then IDFC Bank or the smaller banks would do really well. HDFC Bank view is positive. I definitely like the rates at this point of time. 750, 700, very crucial level to watch out for HDFC Bank, and I would be a buyer. But yeah, I would prefer IDFC, Federal Bank, AU Small Finance Bank for more returns.
All right, so you've given your view there on both SCI and HDFC Bank. All right, Somil and Parthiv, thank you so much for joining us on the show and answering all of our viewer queries. But with that, it is a wrap on your stocks. But do remember to email us your queries and we will address them with our experts. Stay tuned to Closing Bell to take you through the last hour of trade.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Taiwan is the clear laggard here. Index is in the red, down over 1%, close to 2%.
But once again, threatened to destroy, bridges, power plants, etc. if no deal is made. It's a good start. It's up 0.8%. 24,190 is where the Nifty is right now.
Being adventurous is going to pay off in the near term or even in the medium term.
Building that to scale in international markets like Southeast Asia, Dubai, Australia markets.
Remember, the strategic petroleum reserve is the lowest since 1983.
The core order inflows is something that surprised the street quite positively.
Generally for us, H2 is better than H1.
Intermediate goods up again almost 10%, 9.3.
It's a broad-based rally. There's a green-looking screen across the board. The mid-caps are underperforming the benchmarks by a wee bit.
Okay, well, that is the day so far. The Indian market here holding up very well against what's happening in the rest of Asia. And it's a sharp contrast. I think Taiwan, Kospi, some of the other northern neighbors are all down. Here, it's a solid 300-point rally. This is Closing Bell coming to you from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. Nigel is with me. Nigel, afternoon.
Well, afternoon, Prashant, and it's looking quite good, right? First day of a new series, and we're off the blocks in a bit of a fashionable style actually, because the Asian markets were in a bit of a flux. The Indian markets are at the high point of the day. And Prashant, you had two opening batsmen that used to come out to bat every day. The Bank Nifty tried to do its bit, but the Nifty IT index was always under some pressure, out of form. Now suddenly the Nifty Bank is doing okay, and the Nifty IT index has just taken off. It's playing the power play in style, and that's why both the cylinders are firing out. And yesterday we could quibble a little bit that the FMCG index was under pressure. But today, HUL, closer look of the numbers, it's not that bad that the street was fearing. So that stock has popped up. Asian Paints came out with its set of numbers in the last 30 minutes. The street likes that as well. That's moved to the high point of the day. And other stocks as well, like Varun Beverages, have pulled back. So good to see. The pieces are coming together for India after the underperformance that we have seen. The hope is, too early to call, but the hope is that India can at least relatively outperform from here on, provided that Brent crude prices remain well, under that mark of around $90, $95 per barrel odd, which is the case right now. So a good start to the August series.
Absolutely. It's a good start, and lots of numbers, by the way, in the last 1 hour, which we will focus on at this point in time. Mitesh is with us with what he'd want you to do as far as trades go. Mitesh, what do you have?
Good afternoon. So I think the market is good, and the positive thing is that we had a gap up opening, and there was no, effort. There was no situation when the gap was under threat. So I think we should now head towards 24, 350, 400 zones again. Having said that, I have a buy on Bharti Airtel. After a long time, the stock has managed to get past 1920, 1925 zone. And if you get a mild pullback, a good entry would happen around 1945. Keep a stop below 1920, and 1990, 1995, 2000 should be the first target area. And Blue Star is another one. It's kind of given a pullback last few days, is now picking up again. That's a buy with a stop just below levels of 1655 for targets of around 1725.
Okay, got it. All right. Thanks a lot for that, Mitesh. We'll come back to you as the show progresses and get your picks. For the time being, the market's holding strong. But let's talk about some of the earnings reactions. KPIT Technologies has come out with its set of numbers. Let's go across to Vinny, who helps us with a quick analysis of those numbers. Well, Vinny, if it came in earlier, when the IT index was being ignored, I guess the stock would be under pressure. But now the street wants to look ahead. They like the commentary that the CEO has given. Run us through the numbers and the commentary as well.
Absolutely, Nigel. That's the main reason why we are seeing the stock run up and trade, the commentary that's come in. First, in terms of numbers, obviously, it's a weak quarter that came in, but profit warning was already issued by the company previously for Q1 FY27. So that is what was already factored in. Now, three reasons why we are seeing this up move. CEO says that Q1 FY27 performance has been slightly ahead and of the outlook that they had shared as well. So they had given an outlook and guidance of negative 1% in terms of the revenue decline that we would see. Now, we're seeing a revenue mild uptick of 0.1%. So it is better than what they have given in terms of a warning. Now, the sharp contraction in EBITDA and margins is at a multi-quarter low, but the management expects sequential improvement from Q2 onwards. So margins will also start seeing an improvement. And the CEO is saying that they're well positioned to return to strong growth in the second half of the year. Say H2 FY27, we'll be seeing better growth coming in, diversification across clients, geographies, offerings over there will start improving as well. So despite that weak number in Q1 FY27, CC growth revenue down 3.6% as well, we are expecting better outlook for the company going forward, and that is the reason we're seeing an run-up coming in the stock as well.
All right, thanks a lot for that, Vinny. Well, the stock clearly has cooled off a little bit from the top, but still up close to 6% on actually subdued numbers. But earnings are coming in thick and fast. So from Vinny, let's hop across to Mangalam. Mangalam, Asian Paints is painting the town green yet again. It's beat estimates a little bit.
It's beat estimates. In fact, the war-led uncertainties actually come in as a positive surprise for the paint companies, largely because they've gone ahead and taken price hikes. So price hikes were missing from this industry over the last many years, last couple of years at least. And this time around, because there's been a near 12% price hike, that's reflected across the board. So the revenue growth for Asian Paints is at a 16-quarter high. And it's a mix between price and volumes, which have led the overall beat. So revenues coming in at around 10,500 crores. The street was working with a number of 10,200 crores. And that's reflected in EBITDA as well. 2,100 crores, 2,170 crores, as against expectations of sub 1,900 crores. Margins at the upper end of the management's guided band of 20.6% versus 18 to 20%. And we've seen net profit come in higher by almost 40% as well. So it's a big jump that we've seen. Domestic volume growth at 9% versus expectations of 8 to 10%. So that's pretty much in line. But the additional kicker has come in from nearly 7.5% growth, which is led by price hikes. The company has announced a price hike of about 12%. Importantly, the additional lever for growth for Asian Paints for the last few quarters has been industrial, which has actually been growing at mid-teens, and this time around as well, it continues. And add to all of this, despite the uncertainty that we're seeing in raw material prices, the first phase of their vinyl acetate monomer plant will be commissioned in the first half. So that helps their backward integration as well. So all these factors are doing well for Asian Paints, along with the fact that the stock has been an underperformer. Even after an up move today, it's trading at levels we last saw about 3.5, 4 years ago. So all of this is causing a bit of an up move, and that's why the stock is colored green today.
Right, numbers pretty okay, and the under ownership and the relative underperformance as well playing out, so that's why the stock is up close to 2%. Sid Khemka joins us to help us out with what is his analysis. Hi Sid, good to see you in. Sid, what's your view on Asian Paints? These numbers look pretty good in comparison to what the street was working with. The stock has underperformed, and now it seems the street has digested that new player threat. Bidla came. They have spent their 10,000 crores. They have captured some part of the market. But it appears the street wants to look ahead. Your view?
Hi, good afternoon, Nigel. I think definitely if you look at the paints industry, there are two factors. A, the demand has been pretty strong. And I think, as you rightly said, some of these new players and the new entrant threat, that has been absorbed by the market itself, the paints industry. And that is why we are seeing that after a long time, some of these players, including Asian Paints, are now able to push price hikes, which was not seen the entire of last calendar year. So I think back-to-back two price hikes, that is positive. The volume growth, I think that is pretty positive for the paints industry, especially if you look at the market leader Asian Paints. They have been able to report a strong volume growth. So I think overall now with the market stabilizing, with the new players also looking to expand the profitability, given that there is a huge pressure on the cost front since the West Asia crisis has led to a sharp rise in Brent crude prices and other raw materials. I think this is a good step for the entire paints industry and especially Asian Paints, where we are seeing that business growth is pretty strong, especially the volumes growth. So I think overall things are turning around, and at the margin now, from here on, I think we will, the next quarter, that is Q3, we will enter the festive season. And we have seen last 2 years of dismal performance in the key festive season. So hopes are that this time we'll see a better year for Asian Paints compared to last 2 years.
Okay, the hope is that things will improve from here on. Got that, Sid. We're going to come back to you and ask you about tech as well. But let's talk about another company, Colgate. That came out with a set of numbers. Mangalam, you've had a hard-working day, brother. I believe in the evening, Sonal's prepared something special. A hot cup of tea with some cookies, I believe. But for the time being, tell us about Colgate because that's imperative.
You take that point, Nigel. That is imperative. And, FMCG staples companies, in terms of numbers, they're turning a corner this time around. We've seen that with Colgate as well. So the stock is slightly higher post results, 12% revenue growth, which is the highest that we've seen since, first quarter of FY24. The company has reported 12% revenue growth with high single-digit volumes. Here as well, the beat has been led by volumes, which has been high single digits as against expectations of about 5 to 6% as well. So if you look at the reported numbers, EBITDA has come in at absolutely in line with expectations, 483 crores. The revenues where the beat is 1603 crores versus 1577 crores. The net profit's pretty much in line. What's good? Underlying volume growth, high single digits versus 5 to 6% expected. Gross margins have improved by about 110 basis points. But importantly, the company has taken those gross margins and spent into increasing premiumization and category growth a lot. So ad spends are up by 33%. As a percentage of sales, ad spends are up from 13% to about 15.7%. And the street would like that because Colgate anyway, upwards of 30% margin, is among the highest margin players in the consumer industry, but lowest growth. So analysts were saying, why is it that the company is, not investing as much in growth? And that's exactly what's doing. And that is something that the street likes. The stock is higher by about 1% right now. It's been a bit of an underperformer. Let's see where it goes from here.
Mangalam, I was listening to the poke from Nigel, but you should have come right back saying, well, I'm the one preparing the snacks and the tea or whatever.
I just wanted to keep quiet because I knew that, Devyani International and Thangamile is something that you guys are going to ask me about as well. And then Nigel would have asked me to buy some gold jewelry for Sonal or maybe some pizzas for you guys, so I kept quiet.
Mangalam, I'm glad you've learned. You never enter the jungle and you fight with the tiger. But there's a reward waiting for you and you tell me about it tomorrow. Thanks a lot, Mangalam, for giving us that input. Well, let's go across to Sid. Sid, what do you think about Colgate? Mangalam still wants to tell us some more, but you tell us about Colgate first. What do you think about that?
I think another, if you see back-to-back, we have seen 2-3 FMCG companies reporting better numbers. Nestle was a strong number. Now Colgate, we were expecting a revenue growth of about 10%, volume growth of about 4.5%. And we were expecting Colgate to report healthy mix because of pricing, volume. So I think overall decent numbers coming out there, back-to-back 2-3 now. FMCG companies coming out with good numbers. HUL, yes, I think some miss there in terms of the margins that are under pressure. But otherwise, if you look at in terms of growth, after 2 or 3 years, HUL also reported a strong growth in Q1. So that is something I think market will take a note of. Wherever the margin pressure ease off, I think that will help in terms of the overall view. But for now, I think if you look at the entire industry is showing a strong volume growth. Demand has been pretty strong across both urban as well as rural areas. And with, again, monsoon now picking up pace, I think the second half of FY27 looks to be pretty good for other staples. But definitely we have to be selective. It's not across the board kind of a thing where stocks like Marico and Nestle and now I think Colgate, they definitely have delivered or are expected to deliver better performance.
Okay, all right. Mangalam doesn't want to stay out of the action today. Mangalam, you've got a couple more stocks and there's no relation to the evening or to Sonal. Tell us about why Thangamile is down.
The reason why Thangamile is down is quarter on quarter there is weakness, and at the same time we've seen management commentary which is not particularly good as well. Year on year, these numbers, if you look at the reported numbers, 71% revenue growth, 67% EBITDA growth, margins staying at around that 5.5% mark as well, and the net profit growing at 86%. You'd say, why is it that on these numbers the stock is down 10%? Well, one, because this was already baked in. The stock in this year itself, despite the 10% cut, is up 100%, and in the last 12 months is up 250%. And, while that is baked in, quarter on quarter, momentum has become fairly sluggish. Same-store sales growth from 72% has actually moderated to about 44%. The company said volume and gold segments of business was relatively lower because of steep increase in import duty from 6% to 15%. Uncertainty caused by West Asia and slowdown in purchases of gold because of lower inward remittances coming in from West Asia have also impacted business. That's the first quarter. But they go ahead and say even the first 28 days of the second quarter, they haven't seen any visible improvement in sales because of the uncertainty around war. And that explains why, despite a big up move year on year and a solid rally that we've seen in the stock, it's now down 10%. I reckon it may continue in the next couple of sessions as well.
Okay, and now tell us about Devyani.
Devyani, research analyst, or Devyani International, the listed company?
Mangalam, come on. Don't ruin your chances of the evening. Kya kar rahe yaar? Tell us about the results.
Let's tell you a little about the, highest profit before tax is what we've seen in the last 8 quarters, Nigel. 16.5% revenue growth. 23.5%, we've seen in the EBITDA. The margin's doing extremely well. Net profit on a very low base from 2 crores has gone all the way up to 17 crores. Importantly, for Devyani International and all the other Yum brand franchisees, it is KFC which is doing extremely well. KFC reported a double-digit revenue growth this time around, backed by 3.5% same-store sales growth. Pizza Hut same-store sales growth moderated to 2.2%, but that moderation itself is lower than what we've seen in the fourth quarter and the first quarter of last year. So that's doing well. And then there's smaller franchises like Biryani by Kilo, Costa, Vango. All of them have grown between 7 to 10%, so that's a positive. They've added 11 net new stores in KFC. And for Devyani, the big imponderable is the merger, where the management has said that there has been improvement in both dine-in and takeaway, but the merger process with Sapphire continues, and they are hopeful of completion by the end of FY27. That explains why the stock is up around 5%.
Got it. All right, Mangalam, go take a good rest. Devyani is behind in case you want to have a chat with her. Thanks for analysis on this. And Thangamail, Sonal says that you can change the fortunes. Thanks a lot, Mangalam. You can go home with a gift. Well, Sid, anything you liked from what Mangalam had to say? We already discussed Colgate. But you want to give us your quick analysis on the last two? Thangamile Jewelry, what a big outperformer it's been. Sometimes those expectations catch up. In terms of growth, it's much better than its peers. However, there is some margin compression as well out there. And if you want to come in on Devyani as well, I think that's a stock you like.
We don't have coverage on Thangamile, so unfortunately no views there. But I think Devyani, they are showing improving trend, especially if you look at the India revenue that was up 15% and largely in line with our expectation. They're supported by the KFC as well as the acquired brand. Same-store sales growth for KFC was at 3.3%. Our expectation at 6%. So kind of lower than expectation. But overall, I think the broad headline numbers in terms of gross profit, in terms of gross margins, volume growth, I think overall looks decent. And within the QSR space, I think this is one company where we are seeing some rationalization, consolidation of brands. Plus, I think the KFC performance, that is showing some improvement. Plus, even Pizza Hut, that somehow is, if you look at compared to what Jubilant Foodworks, both are not showing that. So what we also saw is that within the QSR, pizzas is something which is not showing that much of growth compared to the burgers and the other segments, which is where KFC is helping Devyani show that kind of growth. So I think a mixed kind of numbers, but overall, we continue to remain positive on the QSR space, Devyani being one of the ideas there.
Got it. All right. Quick word then on Ferris companies. Sid, just looking at some data points, and today Ferris actually has bounced back. One factor could be that as those stocks have corrected, so that's why you're seeing a bit of a bounce. And also ahead of the Fed decision, sometimes you see a lot of movement on metal stocks. I guess that's precisely what's happening as well. The metal pack itself has bounced back today. But let's run you through a couple of data points just on the Ferris side. The India piece is looking good. If I look at the production numbers for the last month, it's up by close to around 4%. That's good. And consumption is up by close to around 7%. On a month-to-month basis, it's down a little bit, but that has something to do with regard to the seasonality factor. So the India piece is actually looking good. But the bigger piece is what happens in China. And China is fairly stable for now. At least the production is not surging up. It's at around 84 million tons odd. One worry is that suddenly the exports again are perking up a little bit. It's clocked closer around 10 million tons approximately, which is more or less flattish on a month-to-month basis. Though in the first few months, the exports as well were down. Now we'll have to keep an eye out on that because on a year-on-year basis, actually exports is up. And you do want China to export more. Production is lower because demand is lower out there. But as their exports goes up, that's what's put pressure on global ferrous prices itself. Nomura, they have come out with a note. They say that, in fact, they're positive with regard to the outlook on India's steel sector, because they believe that the domestic steel industry is well positioned in the first half of this year itself. The price hikes that were implemented in Q4 of last fiscal and the first quarter of this fiscal, they are sufficient to absorb the cost inflation that's coming out of this Middle East crisis. So that's why they have a buy rating on a lot of stocks: Tata Steel, JSW Steel, JSPL, as well as Lloyd Metals. So putting all this data together, India part of the business looking good with regard to consumption in particular, while China, the exports are not going up and the production is under control. And Nomura believes that, the price hikes will be more or less enough to take care of the higher input costs. So could explains why these stocks are up. Sid, you like any of these companies? And normally we don't talk about these metal stocks too much when it's monsoon season, but since they popped up, just thought we'll tell our viewers about it. Your take?
So definitely, Nigel, I think the globally, what you rightly said, the Fed meeting and the dollar index has a lot of bearing on the metal prices. And even Q1, we are expecting a strong results from the metal pack, driven by a higher realization. Favorable metal prices are likely to drive earnings, while volumes are likely to be a much more flattish. And within that, if you look at ferrous, again, we are expecting the sector to report about 3% revenue growth led by healthy realization. Volumes, again, not that strong. Realization is likely to improve about 3,000 to 5,000 rupees per ton on a sequential basis, while volumes are likely to decline about 15 to 20% on a YoY basis. Non-ferrous is something that looks much more interesting, where we are expecting revenue growth of about 6%. There has been favorable LME prices for the non-ferrous like aluminium, zinc, copper. And I think within the ferrous space, what we like JSW Steel and Tata Steel. These are the two preferred picks. And non-ferrous, Hindalco is one of our top picks. We believe the volume growth with the capacity expansion in second half of FY27, that will drive growth for Hindalco.
Got it. All right. Prefer non-ferrous over ferrous. Thanks a lot, Sid, for joining in and running us through that analysis on all those stocks. We catch up soon during the course of this week. Well, for the time being, we slip into a short break. When you come back, our Alpha Manager of the Day, Shubhani Sirkar Kurian of Kotak Mahindra AMC, is waiting for us.
Okay, looks like some negative news for Tata Chemicals. The Kenyan government has ordered Tata Chemicals arm to suspend mining operations. So that is coming in for Tata Chemicals right now. Not to export soda ash. For Tata Chemicals, of course, soda ash is one of the, actually it's a dominant part of the business. And the government in Kenya asking them not to. Stocks selling off a little bit, but we'll have to see how large this is for Tata Chemicals, how significant, etc. But that is news which is coming in right now. More in just a bit. I think we have Shibani now joining in. Shibani Sirkar-Kurian is head of equity research and fund manager at Kotak Mahindra Asset Management Company. Shibani, lots of earnings. Every day by about 3 o'clock. You're inundated. It's the heaviest part of the earnings season. But so far, so good, isn't it? All in all, numbers are tracking very, very healthy.
Yeah, hi, good afternoon, Prashant. Absolutely. So we are keeping busy with the earnings season. And as you rightly mentioned, so far numbers have been tracking. In fact, if you look at the Nifty numbers that have come in, so 28 Nifty companies reported as of yesterday out of the 50. And if you look at the earnings growth, that's been close to about 12% on a YOY basis, which has been slightly ahead of estimates. So, and if you also look at the broader market, X of the OMCs, overall, even the broader market earnings, as far as what has been delivered so far, continue to look fairly buoyant. This also gives us some, hope that for the year as a whole, right now consensus is building in mid-teens earnings growth. And if this delivery of continues, then hopefully for FY27 and then going into 28, we start seeing better earnings trajectory for the market as a whole.
What about... for your coverage universe, what has been growth like?
So, like I said, that if you look at the overall, if you look at the broader market, mid-teen sort of earnings growth is what has been seen for this quarter. At a Nifty headline level, so far it's been about 12%. Mid-caps and small caps, mid-caps X of the OMCs continue to show better earnings profile than maybe the large caps. And small caps of a low base also have been reporting improvement in terms of earnings. In terms of sectors, a few stand out in terms of the segments which have reported better than expected earnings. One has been within the financials, the NBFC pack, where I think the earnings growth has been better than expected. Some parts of auto, and then maybe some parts of industrial capital goods where earnings have been slightly better than expectation. But net-net, I think overall, both at a Nifty as well as at a broader market level, earnings growth has been fairly good for the quarter so far.
All right. Hi, Shivani. Good to see you in. Shivani, I want to ask you about one sector. You know which one?
IT? Is that
Absolutely.
what you want?
Let's go straight at it. The biggest outperformer in the last 1 month or so, various reasons are being given. The anti-AI trade is coming out. The entire AI trade has unraveled. In fact, if you look at it, the Kospi has corrected, the index has corrected 30% just in the last 2 months or so. Which side of the fence would you be? There is a very, very good bullish argument as well that valuations and, maybe that entire anti-AI trade will play out right now. What's your view? But still, these companies are not going to grow too much, barring, say, a Coforge, which is in a league of its own. But otherwise, some of these large cap names will struggle. How would you be positioned on IT index? Give and take everything, the positives as well as the negatives.
Yeah, so I think this is the key debate that's on at this moment from a sector perspective. Our positioning on IT remains unchanged. If you look at our portfolios and the data that is already available, shows that we have been neutral to slightly underweight as far as the sector is concerned. And that continues. There are two parts of the argument, as you rightly said. On a more technical aspect, if there is an anti-AI trade which plays out globally, then our sector, as far as services is concerned, seems to benefit, and that's possibly happening in the near term. However, when you look at the earnings and the season gone by, as well as commentary in terms of discretionary demand, as well as growth outlook seems to be fairly muted for the sector. There has been no meaningful pickup, even in terms of expectation, as far as management commentary seems to suggest, except for pockets where companies have reported better than industry growth. So that's one factor. The second factor is that while there is enough room for companies to win deals as far as AI is concerned, as enterprise AI adoption increases, there is definitely pricing pressure. And most of the management commentary seems to have alluded to that productivity benefit pass-through pressure reflecting in terms of earnings. So our belief is that the sector becomes a segment where it will be susceptible to short-term movements depending upon what happens globally. But growth outlook seems to be fairly muted at this point in time, which is why our positioning continues to remain neutral to slightly underweight as far as the sector goes.
But someone who's buying it for the longer term, do you think they're coming to those levels that, in the next 3 years or so, you'll make a decent amount of money? It'll outpace what the index has done. After all, this is a sector that has underperformed by a large margin.
So, Nigel, our view is that this usually is a very, very homogeneous sector. However, going forward, this is a sector which will become more stock specific. If you have to generalize, our belief is that mid caps appear to be better placed as far as the sector goes as compared to large caps. One, they are far more agile. They are actually winning deals even when there is vendor consolidation. That means that the growth profile as far as some of the mid caps go tend to be or are expected to be better as far as large caps are concerned. And therefore, one has to be picking and choosing stocks where companies are able to offer solutions to their clients, which are possibly value addition as far as AI or AI adoption goes. So I think it's going to be a sector that's going to be fairly heterogeneous, and stock picking is going to be the key.
Do you, I know you can't talk individual names, but just as an example, right, sheer momentum play has been, or name rather, has been this stock called MTAR Tech. Own it any of the portfolios, Shibani?
So Prashant would not want to get into specific names. Of course, our portfolio disclosures are there for, on a monthly basis for everyone to see. So would avoid getting into a specific name.
Got that. And the stance on real estate, has it been, again, against expectations that maybe there is a bit of a slowdown in sales, underlying sales growth has been pretty solid. How are you positioned?
Real estate actually has been a sector where we have been underweight. However, at the margin, as you rightly pointed out, especially in pockets, premium sales, or at least in the premium end of the spectrum, the growth seems to be kind of holding up. There has been some slowdown in some pockets, which may be more geography specific. And of course, the sector has seen a significant correction as far as stock prices and valuations are concerned. So at the margin, some of the larger players who are present in geographies where the pre-sales number tends to show that things are holding up, those are some of the segments that we would be incrementally positive on. But yeah, this is a sector where we have, if you look at data in the past, we have been underweight on.
Got it. All right, Shibani. Thanks a lot for stopping by, giving us those views. We catch up soon, and we'll have a more detailed discussion. Thanks for joining.
Thank you so much. Thank you.
All right, well, let's take a quick check on the F&O market. A start of a new series, and the bulls, they're on the front foot. They're seeing the ball big and smashing it out of the park, at least on day one of this series. So if you look at it, the Nifty at the high point of the day, 100, 150 points is what we're bracing for in terms of a start. We're going to go home with almost a 300-point gain, which is not bad. The India VIX as well has cooled off, and that's a bullish sign as well, coming to the lower end of the range. Now, moving to the options data, 24,200 put. Well, the premium out there was around 250 rupees. So for those writers, they are working with the 23,950 mark holding out. And now we're gradually trending up, and you'll have the time value of money as well that will erode that premium. So that's why, for those, the reference point comes in at around the 23,950 odd. Even the 24,250 put, the premium was close to around 280 rupees. That's come down to around 128 rupees or thereabouts. So clearly signs of writing being seen. Now you'll have to say the reference mark on the downside is around the 23,900, 23,950 odd. And what's happened in today's trade is, for the last few trading sessions, we've been visiting the 20 DMA and getting rejected out there. Now today we have mildly crossed the 20 DMA. And the bulls will want to drive home the advantage, provided there's no global, shocker that comes about. And now the eyes will be set on moving to around the 24,500 and then making a bit of a challenge towards the 200 DMA or thereabouts. As I said earlier today, the markets are relatively lighter. The rolls as well were relatively lower. And the FIs, though they're net short, in absolute terms, in absolute contract terms, the short positions are much lower than we saw a month or so ago. Two stocks that have come in for a good short covering bounce today. Wipro, that's seeing a good squeeze out there, so that's why that stock has moved up. And SAIL as well has moved up in today's trading session. Both of them seeing a bit of a short covering bounce. Keep an eye out on Kalyan as well. Kalyan Jewellers, for the last few days, we've been seeing good amount of price action out there. So you have to get used to those kind of pullbacks. But, that one is holding on to its own. A stock that rallied 45-50%, it continues to build on to those gains. And now you're seeing some delivery-based buying as well. Shorts getting squeezed, delivery-based buying. Keep an eye out on that particular name. Well, we'll slip into a short break, but Nimish is waiting for us on the other side. He'll tell us what's going on in terms of dealing room chatter, and we'll also get in our technical experts. Welcome back. Good start to the series, but let's get in Nimesh to tell us what is he picking up in D-Street Chatter. Hey, Nimesh.
Hi, Nigel. So absolutely a strong start to the August series, but my sense is there is an element of short covering in many stocks. We saw very sharp reactions to a lot of the earnings yesterday because of the expiry. Now you're seeing a bit of a pullback thanks to that short covering. So that some element is playing out in many of the F&O names. Interestingly, from a flow perspective, first signs of genuine buying in the technology names. The first leg of the rally was short covering. Now there is a bit of buying as well. So in fact, there is a basket buying in technology stocks and leading FIDs. So across large cap and mid cap, it's a basket across IT names which is getting bought in today's market. A sharp reactions to earnings continue, and that's the reason why the mid-cap index has gained another 1% today. So the momentum is clearly there in terms of winners in the broader markets if the earnings are good. Technically, watch out for 24,350. For the last 4 to 6 weeks, that's been acting as a very strong resistance. If that gets taken out, the feedback is at least the first half of the August series might see a sharp short covering rally. So on the Nifty, that is possible. But today, for a change, there is a basket buying in technology stocks.
Foreign FI desk, essentially.
Yeah.
Okay, got that. Now, Nimesh, in terms of individual names, what's on the list?
So the first on my list is Tractors India, TIL, up 10% after a large block. My sense is a leading influential HNI investor and the AMC associated with him is a buyer in today's block deal. So if there is any disclosures, could be interesting to track in TIL. So that's the first name. The second name is Sandur Manganese. It doesn't come out in the list quite often, but surprisingly, there is a buying at an FI desk in Sandur Manganese. Expect high delivery volumes in this particular name if the trade gets executed. So watch out for delivery stats there. Third, Wipro and Siemens. While there is a basket buying in all the technology stocks, Wipro is going to see a small MOC sell flow, and so is Siemens. Not Siemens Energy, but Siemens Limited. So both these names could be under pressure in the last 30 minutes of trade on the back of that MOC sell flow. And the last is Piramal Finance. While the stock has been consolidating post Q1, it was a strong earnings for Piramal. But now my sense is the company is likely to raise funds via QIP very soon. The roadshows have started, so maybe it'll hit the market soon, and they're going to raise money via QIP.
Well, absolutely. So sheer, I mean, a big run coming into this now, and a QIP perhaps around the corner. Thanks very much, Nimesh, for that. That's the D Street Chatter list, and of course, what Nimesh is picking up. Well, Mitesh is with us with what she'd want you to do. Mitesh, what do you have?
A BTST on IEX. After a long time, the stock has managed to clear this 130, 132 zone. So BTST with a stop below 132.9. Look for a target of 137, 138 possibly tomorrow. And the other one is a BTST on Glenmark, which I would recommend taking a BTST with a stop at 22.54, 53, and a target of 22.85 for tomorrow.
Anything in IT you're running positions in, Mitesh?
So, Prashant, IT, have had buy calls in the last few days, not today. I think Infosys was today morning, TCS was day before yesterday, before that LTIM. I think they have now run away a bit far from their 10-20-day averages. Maybe, you would just want to see some kind of a pullback before initiating fresh calls.
Okay, all right. Sorry if we've spoken about it earlier in the show, but Kalyan Jewellers, what's your view there? It's left all the moving averages very far behind now with this sort of a move. Is there any signs of some resistance, or if someone has it technically, where should they be placing their stop loss at?
See, I think one, trade a stop loss about 540. And two, while the stock has run up and is clearly away from the short-term averages, I think the weekly charts have also reversed over here, which means that the up move eventually will see a few more higher highs and higher lows. That's a strong possibility. I think one target is 640. Which is where the stock had a weekly closing low on the 14th of November 2024. But once it clears that, good chance that we are seeing numbers beyond 700 over here.
Okay, got it. All right, got that, Mitesh. Thanks a lot for giving us that call. By the way, keep an eye out on Eicher Motors. That's the big boy that comes out with a set of numbers. Sudarshan had given us, the expectations out there. But that one, in fact, has just slipped to the low point of the day. So I think Eicher Motors should come up for you on the screen. But Bajaj Finance, that as well is the one that will be reporting its numbers tomorrow. Let's hop across to Ananya. She's here to tell us what is the street penciling in. Ananya?
Well, yes, a strong quarter is expected from them. Healthy set of numbers the street is expecting. They are expecting net interest income growth of around 28% year-on-year, operating profit growth of around 17%, and profit after tax growth of nearly 23% to 28% range. Sequentially too, if you look, earnings are expected to improve with NII rising around 11% and PAT growing about 5%. So a decent growth also sequentially is expected. Beyond the headline numbers here, the key focus will be on asset quality, margins and loan growth. Credit costs are expected to remain around 1.7 to 2% range, while NIM is likely to stay broadly stable with only a marginal sequential decline expected. Investors will also watch whether AUM growth sustains above 20% along with momentum in gold loans, recovery in MSME lending and continued traction in the newer businesses such as vehicle finance. Now, in the last con call for FY27, the management has guided for 20 to 24% AUM growth, 25 to 40 bips improvement in operating efficiency, credit cost of 1.45% to 1.6% range, and ROA of 4.6%. Now, management has also cautioned that NIM could moderate slightly depending on the geopolitical and interest rate environment. So let's see if they delivered better than expected growth this quarter.
Got it. Okay. All right. Thanks a lot for that, Ananya. Well, Mahindra Mahindra as well will be reporting its numbers tomorrow. Let's bring in Sudarshan to understand what is the street penciling in on this name. Sir?
So tomorrow during the market hours around 1 p.m., Mahindra Mahindra will be coming out with its earnings for Q1 FY27. Like all the other auto companies here too, we are expecting a strong growth as far as revenue is concerned, and that's being aided by the strong volume growth that company has seen in both the segments, auto as well as tractor. But on the margin front, it might see a dip mainly because of higher increased mix of electric vehicles and increased in the raw material costs. Now talking about the headline numbers, profit can see an increase of 4%, but revenue can see a jump of more than 23%. And talking about EBITDA, it can see an increase of 8%, but margin can see a dip to 12.6% versus 14.3% that company had reported in the same quarter last year. Realization on YOY basis, it might increase by 1%, but sequentially it can fall by 1.5%. On the volume front, total volumes have increased 21% YOY, but were down 7% on a sequential basis. And both auto as well as tractor volumes too had seen an increase in the range of 70 to 23% YOY and fall in the range of 2% for auto, but tractor segment was up even on a sequential basis, up almost 32%. In the commentary, exactly what would be watching out for? First, what does company talk about the FY27 outlook for SUV, because SUV growth continues to remain more than 20%. Now, also about the tractor, after Q4 earnings, company had given the mid-single-digit growth outlook for FY27. Let's see if company manages to sustain for the industry, and also what about the launches on electric vehicle front?
All right. Well, so thanks very much for that. That is the Mahindra expectations. Mayuresh Joshi is with us. Mayuresh, let's just talk about these two, the largest NBFC and maybe the largest or the second largest auto company, Bajaj Finance and Mahindra. What's the view?
Afternoon, Prashant. So I think we carry a positive outlook as far as these leadership stocks are concerned. And therefore, I think the expectation largely getting penciled in is a very stable set of numbers. Specifically in the case of Bajaj Finance, I think what probably goes through over the next few quarters in terms of the digitalization that they're embarked upon a few quarters back, and what kind of an effects does it bring in terms of operating leverage, cost optimization, as well as the cross-selling opportunities that obviously it has, specifically very strongly in this consumer durable loan segment that it operates out of. Therefore, our take is that it should be a stable show. It's a leadership NBFC, and obviously I think it should do well over the next few quarters. For Mahindra and Mahindra in general as well, I think our own sense is it should be a steady state number as well. The new launches that they've probably done in the previous few quarters and new launches which will come through in the next few quarters as well, I think that should augur well in terms of the automotive business. Having said that, I think the farm equipment business as well, I think that has been a steady performer for Mahindra and Mahindra. And therefore, if you look at the sum of parts, I think both segments over a longer period of time should do well. So yeah, I think leaders in their own spaces remain positive on these ones.
Okay, all right. Any view on Newgen Software? Mayuresh, that stock was up, I think, 5% odd. That spiked to the high point of the day. You have a view on that name?
So it's not in our coverage, but again, I think out of the numbers that have been posted specifically by IT companies, our own sense is that Coforge has given a stellar set of numbers, and the management commentary itself was pretty encouraging. I think the street has grabbed Coforge's numbers with both hands. And therefore, I think if Coforge is to deliver what the management is saying, I think the numbers exit 27, numbers exit 28, I think will look stupendous. So I think Coforge has been an outlier as far as the entire IT pack is concerned. And one dark horse, which we are not owning, or I'm not owning personally as well, which has probably remained very, very immune, as I've mentioned time and again, has also been Datamatics Global. I think the stock has not fallen as much as the IT index has. It's not part of the index itself. But the work that Datamatics is probably doing in terms of IT services as a business venture, the Fortune 500 clients that it services, and generative AI that they embarked upon a few years back, the agentic AI tools that they're deploying for Fortune 500 clients. They've deployed something for the metro system as well in Mumbai. And it is a steady show. I think the cash balance on the balance sheet remains extremely strong. And the outlook probably looks, as per the management, looks very, very optimistic as well. So not in another active holding list, but this is one stock which has probably stood the test of time.
Okay, got it. Got that, Mayuresh. Stay with us. By the way, a stock that we had highlighted in the morning itself, Tractors India. Nimesh just told us that could have been an influential investor as well as an AMC that could have bought a large chunk in the company. That's why the stock from the low of the day of around 210 rupees, it's moved to the high point of the day. Wonder whether or not the promoter is part of that deal. So we'll have to keep an eye out on the disclosures later this evening. But there was a large trade between 9:15 and 9:20 a.m. today. But let's move on to the important Q. All-important Fed decision is due tonight. The central bank is widely expected to hold interest rates steady. Here is Steve Leisman with the findings of the CNBC's latest Fed survey.
Yeah, change is coming. Respondents to the CNBC Fed survey see no change in rates, however, for this meeting, but they're divided on the outlook for hikes in the next year. And they are expecting big changes to how the Fed operates under new Fed Chairman Kevin Warsh, which come, by the way, with a measure of concern from our respondents. Just 39% of the 29 respondents expect Warsh to hold a press conference after every meeting. That's down from 59% of the June survey. 18% think it's going to happen only when the Fed issues the forecast or the SEP, and 19% say rarely, while 25% they just don't know. 59%, meanwhile, believe the dot plot or estimates about the future course of rates from individual Fed officials, that's going to be eliminated. Another 30% think they will be modified. A big issue here has been Warsh's refusal, not just to provide forward guidance, but even his reaction function, or how the Fed will forecast rates. Forecast rates will be set under different economic circumstances. 70% say the Fed should be doing this, that is, providing their reaction function. More than half, meanwhile, say not doing this will lead to less effective monetary policy, and 70% say it will lead to more market volatility. Guy Labat, chief fixed income strategist at Janney Montgomery Scott, says the uncertainty generated by Warsh's early pronouncements are forcing firms exposed to overnight interest rate swings to hedge against those swings, which will incur a cost in the long run. We might soon that volatility. We might see that volatility as soon as tomorrow. Fed futures markets place a 28% probability right now on a rate hike at tomorrow's meeting. That's a big number for a meeting where most expect no change, followed by a 76% chance of hike by September. Some significant adjustments are going to be needed depending upon what Warsh says or what he doesn't say.
Okay, well, the programming around what the Fed will do, says, doesn't say, all of that we can catch from 11 p.m. onwards here on CNBC TV 18. So it's a relatively new Fed chair and will be closely watched for cues, not just here in July, but of course September, which perhaps is a much more closer meeting, which is being widely acknowledged. We'll take a break. We're back. There's, I think, about 9 minutes to market close. More coming up. Okay, welcome back. This 5 minutes to market close. From the insurance space, we just want to put out a story. This is all source-based. The IRDAI, that's the insurance regulator, may put out a commission paper to crack down on what they describe as dark patterns used by insurers. Yash is standing by with a quick update. Yash, take it away.
Well, Prashant, this is a very interesting, step brewing at the IRDAI's desk. We've heard the chairman speaking about the issues around dark pattern in the insurance industry, and there could be something important following that concern from the regulatory board chairman. What we've been given to understand is the regulator may ask insurance companies and insurance distributors to not seek personal details from potential policyholders. These restrictions may include not being allowed to seek the contact numbers or email IDs of potential policyholders at the time when they are looking out, understanding, researching on insurance policies, trying to get quotes. Also, what we are given to understand is that the regulator is studying various aspects in terms of advertisement, marketing, communications, in terms of what all can be brought under the definition of dark patterns, and a consultation paper could be expected as far as eliminating all those aspects from the insurance sector itself is concerned. What we've been given to understand is that either it could be not allowing insurance companies and distributors to seek personal details like contact number and email ID, or having a very clear and visible option of opting out of any callback from the call centers of these insurance companies and insurance distributors for the sale of insurance policies. What we've been given to understand, and in terms of data also, is like largely insurance distributors like CoverFox, Insurance Deco, as well as Policy Bazaar. These platforms do seek personal details of potential policy holders at the time, at the start of, giving them information on various insurance policies itself. Distributors like CoverFox, Insurance Deco and Policy Bazaar, as I said, also receive majority of the business or majority of the premium which they generate for insurance companies through the call center assistance, which is by calling back these potential policy holders.
Okay, well, it's an important story. We'll track this. Thanks very much, Yash, for it. We've got about 2 or 3 minutes to go for market closing. There is a news flash. Public Examination Prevention of Unfair Means Amendment Bill 2026 passed in the Lok Sabha. That's what's coming through. Mayuresh, anything else on the radar? By the way, just put up the stock of Blue Jet. I'm just noticing it's run up sharply, about 602, 603. Stock's up about 5.5%. Had a one-way move, then it cooled off. But back, I think numbers are next week. Mayuresh.
No, so I think the numbers for Blue Jet are expected and they're in the right field. However, I think our recent addition has been Usha Martin. I think a fabulous set of numbers that Usha Martin has posted in the last week. The ratings and rankings look absolutely fabulous at Markets with India. In fact, the cash balance has gone up. It was 336 odd crores end March. It is now 465 crores as we are exiting Q1. The wire rope volumes and business has done exceptionally well. And in spite of steel prices going higher in the quarter gone by, the EBITDA per ton that Usha Martin has reported at 40,600 odd rupees is one of the highest in the recent few quarters. The return ratios look very steady state, 21% ROCs, 18% ROEs, EBITDA margins around that 19.5%, 20.5% bracket look very interestingly poised because 27% of its top line comes from Europe. 13% comes in from Middle East, where the portion might actually start edging higher in the next few quarters, leading to relatively better EBITDA margins, relatively better cash flows and profitability as well. So this is one recent addition that we've done to our portfolios.
Got it. All right, Mayuresh, thanks a lot for giving us that call on Usha Martin. Big turnaround and it's done quite well. Well, let's wind things down then with a quick wrap of what went on in today's trading session. Let's talk about the broader markets first. Kelkar, well, that stock went on with gains of 15%. Big bounce back is what we saw. Paradeep Phosphates, as again, good set of numbers. The street liked it. That stock as well was flying away in trade. TIL, large trade been seen out there. Influential names apparently bought. Let's see whether or not the promoter entity is part of that trade as well. So that's another stock. KPIT Technologies, disappointing numbers, but the street wants to look ahead, and the street was very positive about the commentary that came on that front. That's why that stock went up. You had Swiggy that was swinging it away in today's trading session. There's a bit of a change at the top, and the street has taken that positively, so that stock moves up. In the coming month or so, we have Sagility that will be welcomed into the F&O market. And for today, the stock, in fact, was up and about. Kalyan Jewellers, it's no stopping that one. Moving from strength to strength, 630 rupees. And Honeywell, well, it was quite sweet today. That stock, in fact, was up close to around 7% in reaction to its numbers. So good move out there. But the sector of today and the sector of the last 1 month or so has been tech. Everything that had something to do with tech has done very, very well. Whether you look at Infosys, TCS, Coforge, all those stocks, they were flying away in trade today and went home with solid gains as well. So that's clearly the sector to watch. In terms of stocks that were a little bit under pressure, well, you had Adani Ports that ended with a cut of 3%. Mahindra Mahindra as well paused for breath in today's trading session, but nothing really to worry out there. And Phoenix Mills, in reaction to its numbers, that stock went home with a cut of around 6.5%. We talk about tech doing well, but you have Infosys. That was a stock that relatively underperformed today. Went home with a cut of close to around 3%. And a lot of chatter about Keynes Technology. For today, there was a bit of a short squeeze, pushed the stock up close to around 13%. Good move we saw out there as well. Well, on that note, we'll wrap up on this edition of Closing Bell. We wind up on this edition, and the team of Markets Forward comes up next. Stay tuned.
Markets kick off the August series on a strong note. Broad-based buying lifting benchmark indices. The Sensex surged 900 points, while the Nifty reclaimed the 24,200 mark. And a big move is what we saw in the broader markets as well.
Asian Paints delivered a strong June quarter with the domestic volume growth of 9% in line with expectations, while margins expanded by 240 basis points to over 20%.
Gulf tensions hit L&T's execution in the June quarter, hurting margins, but strong order inflows, record backlog and unchanged FY27 guidance kept brokerages bullish. The stock ended higher. Good evening. You're watching us here on Markets Forward. This is your go-to show where we aim to get you all the key data points to get up for the next trading day while we recap today's session as well. I'm Mangalam Malu, with me Vinny Motiwala. Day one of the August series, and it's been a good one. The Nifty reclaimed that 24,200 mark, and we've seen some sort of stability that came by in the geopolitical markets as well. And alongside that, more importantly, a lot of the earnings that kept the street very excited, and the remarkable recovery that we've seen in the IT pack continues today. The Nifty Bank came back into action as well with a gain of nearly 500 points. 57,200 is where the Nifty Bank closed.
Hi, evening Mangalam. Yes, a day where we started off the August series on a positive side as well. IT obviously continues to trend upward even in today's trading session. We saw it go home with gains of around 2.5%. We have the metal pack that did well. And for the week also, IT is leading the chart. So far, 8% gains for the Nifty IT as well. All in all, a good day coming in for the markets. But let's talk about what's signed up for you all on the show today. And we'll start with the top movers and shakers of the day with Sudarshan. And then earnings season, amidst earnings season, whole lineup of earnings seasons that were reported today and earnings reported today. So we'll catch all up with all the earnings that were reported, as well as last but not the least, we'll delve into the key market events to watch out for in tomorrow's trading session. First up, let's go across to Sudarshan, who's here to take us through the top movers and shakers of the day from the big wall. Sudarshan, over to you.
Good start to the August stage. Nifty well managed to claim the levels of 24,200, and at the close also it was above that level 24,250 that you can see on the screen, the closing level. And now it was supported by the broad-based gains. Market breadth was firmly in favor of advances, and some of the top Nifty gainers, or say movers, first was Jio Financial. In the second half of the trade has moved sharply higher at the end, up more than 5%. HUL, remember yesterday it had fallen more than 7%. Today recovered most of its losses and up almost 5%. And IT stocks have been moving higher over the last few weeks. And today also Infosys, TCS, you talk about the names, all the major names were higher. Infosys amongst top Nifty gainers up more than 4%. Bharti Airtel was 2 amongst top Nifty gainers, closed with a gain of almost 3%. Adani Ports, despite reporting an inline set of earnings for Q1, at the end stock was down more than 3%. Some of the other stocks that have reacted to earnings, Asian Paints after the earnings at one point was up more than 4%. Earnings were in line. Margin has seen an expansion. Volume growth was in line at 9%, but at the end closed with a gain of almost 1%. KPIT Tech came out with the earnings and it was better than company's expectations. That's the reason you can see an uptick of 6%. Phoenix Mills, it was a subdued set of earnings for Q1. At the end, down almost 6%. Cartrade Technologies had moved sharply higher ahead of the earnings. That's the reason stock has seen profit booking down almost 4%. And PCBL, very strong set of earnings, closed with a gain of almost 15%. Some of the other mid-cap movers, SML Mahindra, because it's going to acquire the truck and commercial vehicle business of Mahindra Mahindra for more than rupees 500 crore, up almost 20%. Case Technology has seen a sharp move, closed with a gain of 13% with healthy volumes. Crompton Consumer 2 in the second half of the trade has moved sharply higher, closed with a gain of 7%. And Swiggy and Eternal have been moving higher over the last few weeks, and today also it was up almost 6%, and all the EV names too have moved higher after cabinet approval of Haryana government, and Ather Energy up almost 4%.
All right, take that point. So thanks a lot for that. Those are a bunch of stocks that were buzzing around. So did mention Asian Paints. Let's talk about that one. That saw a near 3% up move in today's trading session. It was a good performance that came in. Overall numbers, reported numbers, beat street expectations. At one point, the stock was higher by about 4%. The revenue growth that came in was a 16-quarter high. And price and volume, both of them led growth this time around, with gross and EBITDA margins improving. So if you just look at the revenue, 10,500 crores, above street expectations of 10,200 crores. The EBITDA under 2,200 crores versus expectations of under 1,900 crores, taking the margins upwards of 20.5% mark. And the net profit as well surged by 40% year on year, much above street expectations. The important part, volume growth was 9%, led by 7.5% price hikes. That meant about 16.5% in domestic business. And industrial coatings sustained their mid-teens growth trajectory. So that stock did well today.
Okay, Mangalam, Asian Paints obviously in focus, but you also had Colgate delivering a bit of a smile, a decent quarter that came in Q1 as well, and Devyani International also. That's another one. So Mangalam, again, it's been an FMCG sort of a day, a QSR sort of a day. Both these numbers, what's
Yes, it has been an FMCG sort of day, and all these companies are, at least at an inflection point. Yesterday we saw a 13-quarter growth, revenue growth coming in for HUL. We saw a big jump coming in on the stock price in today's trading session after a big gash that we saw yesterday. And today as well, Colgate did well. The revenue growth was a near 14-quarter high, the highest that we've seen in, since the first quarter of FY24. So near 12 quarters is what we've seen on Colgate in terms of growth, 12% revenue growth. We've seen the EBITDA jump as well. The margins came in at 30.1% because the gross margin expansion was plowed back into ad spends, and as a result of which we saw the company report in-line EBITDA as well as profitability. What stood out for Colgate for me was, apart from the gross margins expanding and the company plowing that back into marketing, is that the growth was led by high single-digit volumes. This was expected to be about 5 to 6%, but overall the numbers were better in terms of volumes, and that's what led to the top-line beat that the company has reported. Devyani International as well. Quick service restaurants doing well, in particular certain categories. In that, chicken sandwich via KFC has been on a tear, and that's something that continues. Double-digit revenue growth for KFC, led by 3.5% same-store sales growth, meant that the overall revenue for Devyani International grew in slightly high teens, EBITDA doing a lot better, and on a low base, we saw a surge in the net profits as well. The important part for Devyani International, of course, is that the profit before tax is at an 8-quarter high. Because of good revenue growth, we've seen the operating leverage play out as well. Even Pizza Hut. Now here there has been moderation in the same-store sales growth. It was minus 2.2%. But compare that to what they did in the fourth quarter or the first quarter of last year. The reduction in moderation is something that the street likes, and the company has said that they are on track to complete their merger with Sapphire Foods by the end of this financial year. And their other verticals, Biryani by Kilo, Costa, and even Vango, maintain between 7 to 10% same-store sales growth. So looking good for Devyani International.
Okay, looking good for most of the companies that reported their numbers today, at least on the FMCG side. But on that note, let's continue this discussion forward. And we're joined by Mayuresh Joshi of MarketSplit India, as well as Shrikant Chauhan of Kotak Securities. Mayuresh as well as Shrikant, hi, thanks so much for joining in as always. Mayuresh, I have to talk about the FMCG names, right? They all Paint, QSR, Colgate. Good numbers coming in from all of them. What are you looking at in terms of the FMCG side? Anything interesting that you're finding now?
Absolutely. I think as the numbers have played out, I think they have played out wonderfully well, because I think the expectation largely was for a muted quarter, and FMCG companies by and large have surprised on the upside. Having said that, I think two numbers which stood out within the pack so far have been Nestle India, which has given an outstanding set of numbers across all its product categories. And though input cost inflation will be something to comprehend with and the volatility thereof, I think the sheer underlying volume growth that Nestle has produced across its business segments has been stellar, to say the least. The other one also has been Tata Consumer. I think if you probably leave the coffee business aside, to a certain extent, I think what you've probably done in terms of the growth businesses, specifically the acquisitions that have done, Organic India in particular, I think the growth there, along with the gross margins, have been pretty stellar. Secondly, I think the expectations in terms of the Starbucks store expansion is very much on track. And looking at how tea and coffee, or the beverages part of the business, is expected to play out, I think it can be a steady show going forward. So again, very, very good underlying volume growth. The EBITDA margins have been steady state between 13.5% for Tata Consumer. And therefore, from the FMCG perspective, I think two numbers, in my opinion, which stood out, one is saying.
All right, we take that point, Mayuresh. Thanks a lot for that. Just a word before we move forward on all these FMCG companies. Do not go by the reaction that the stock price shows on the day of the results, because yesterday a 5% volume growth meant, as again 6 to 7%, HUL shares were down 7%. We saw decent performance coming in from Varun Beverages as well, and all the other companies that reported their numbers, we saw a big cut on those stocks. But today they've bounced right back without any fundamental change in the commentary that came in overnight to now as well. So important to track FMCG stocks on a sustained basis as against just the post-result reaction. Over the longer period, the ones which have outperformed have actually seen a big gain as well. Like we pointed out yesterday, Nestle was a top performer alongside all the others as well, including the likes of Marico. Good time to get in Shrikant Chauhan now. Shrikant, we bounced back on day one of the August series. The question is whether we continue this bounce, or maybe this is just once again us testing the upper end of the range, closer to 24,300, 24,350.
Afternoon, Mangalam. Afternoon, Vinny and everyone. So while looking at the setup of the market, most of the time on the first day of the expiry, we see a new expiry. We see market bouncing back to its important resistance level. And this time also, we have seen quick comeback to the levels of 24,250. In fact, now the markets are very close to the resistance zone. In last 1 month, if you see the entire technical pattern of Nifty, most of the time, whenever the market has approached to 24,250, 350 levels, we saw some profit taking, and eventually the market has again came back to the levels of 24,000. So since last 4 expiries, markets were very close to 24,000 levels. During the expiry, we saw 23,600. But now, after this particular up move, I am of the view that again the supports have shifted from 23,600 to 23,900 and 24,000. One correction is definitely due because the way the market has fallen in last 15 days, I am of the view that it's a bounce back, it's a pullback to the recent sell-off. And again, the market can come back to the levels of 24,000 or 23,900, where the market is having good support to create some long positions.
Okay, point taken there, Shrikant. But let's move on and talk about some other names also that were in focus today. A lot of earnings, right? So we had a strong performance that came in from V-Guard, Paradeep Phosphate, while KPIT disappointed in terms of numbers, but the commentary was good, and that's why we saw an uptick coming in for the stock as well. Let's go across to Devyani, who's here to give us a wrap on what happened there. Devyani?
Well, first up is V-Guard Industries. There was a broad-based growth with a strong margin beat for the company. Revenue was up 23.5% at 1,811 crores. EBITDA was up 55.5% at 192 crores, with margins expanding to 10.6%, and net profit was up 76% at the end of it. Now, coming to Thangamile Jewellers, there was a good set with revenue up 71%, EBITDA up 66.7%, with margins coming in at 5.3% this time around, and PAT coming in at 86% above Q1 of FY26. But it was the management commentary that was weak this time around. Now, next up is Cartrade Tech. Now, it was a healthy growth which has continued for the company this time around, with margins crossing 30% this time. All segments saw double-digit growth, and as a result, revenue was up 16% at 201 crores. EBITDA was up 45% at 63 crores, and margins came in at 31.3% this time around. Now, coming to KPIT Tech. Now, this was a weak quarter for the company, but the company had already issued a profit warning for Q1 of FY27. Now, where it gets interesting is that management expects sequential improvement from Q2 onwards, and the company is well positioned to return to stronger growth in the second half of FY27 and beyond. So, while the revenues fell 3.6% on a constant currency perspective, the stock gained in trade today. Now, last up is Paradeep Industries. Now, the results were better than estimates on all fronts, but volumes were muted this time around. Revenue was up 36% against an estimate of 9%. EBITDA was up 24% versus an estimate of 23% decline. And margins contracted by roughly around 110 basis points to 11.8% against an estimate of 9% margins. And net profit as a result was up 17%, so good set of results from Paradeep Phosphates.
Right, a bunch of stocks doing extremely well post their numbers. We saw a big jump on PCBL and the others as well. Mayuresh, of the numbers that came by today, is there anything that stood out for you? Anything worth investing?
Also, I think Asian Paints had a very decent show among the large cap names, Mangalam, to be honest. The expectations in terms of how volumes have probably played out and how the entire business structure is expected to behave, specifically if crude prices normalize, I think that can be a huge plus going forward. I think a large part of the competition has now simmered down to a large extent. And therefore, I think organized players will gain significantly in the unorganized market. Asian Paints probably holds up. PCBL was a very interesting set. And again, I think the kind of work that PCBL is doing, Mangalam, and the management that is expecting to add value-added products over the next few quarters, my own sense is that if they are successful in doing what they have probably envisaged, FY28 for PCBL or FY29, let's extend that, might be drastically different in terms of top line growth, in terms of margin performance, and how the profitability will play out. So I think PCBL can be one dark horse if they execute well as they have planned.
Okay, PCBL, that's an interesting one. We'll keep an eye out on as well. But Mayuresh as well as Shrikant, thank you so much for joining us on the show as always and helping us understand in terms of markets as well as individual stock names. On that note, we're going to slip into a very short break. We'll come back with more in terms of corporate voices, key events to watch out for after the break as well. Stay tuned in.
You're watching us here on Markets Forward. Let's talk about Indigo. Indigo is ready for a decade of international expansion as the airline clocks its 20th anniversary. The MD, Rahul Bhatia, says India needs global airlines of scale, and Indigo is well positioned to reclaim the economic wealth handed over to foreign airlines. Let's listen in to Shireen Bhan's conversation with Rahul Bhatia.
1/3 of our production is in markets where nobody else flies. These are unique markets where we are doing everything we can to bring the nation together. And it's only the balance in markets that we compete in. We only have, I think, about 44%. So this thing about, Indigo being what it is, what is often lost in translation is the fact that we are connecting the hinterland of this country like no one else. And it's not because other airlines cannot fly those routes. They can, but they choose not to. And the reason we are able to do what we do is because of the cost structure, we are able to experiment. And the 33% or 34% of the flying we do into unique markets represents something like 250 city pairs. So while we keep getting badgered on our size and scale, like I said, what is not understood is what we are doing, which no one else is doing.
As you look at expanding both domestically as well as internationally, what changes, if any, are you bringing in to kind of ensure that you leverage on the new momentum that you want to build on?
I think Indigo's journey over the last 20 years was all about building an extensive domestic network. We are not finished doing that. We will continue to do that. That will remain the core of the airline. But having built this network, the next logical step is really to take Indians to the world and bring the Indian diaspora that resides in other parts of the world to India. And that's something which, for reasons I probably prefer not to discuss, was handed over to airlines and geographies outside of this country. With that, there was a lot of export of economic wealth from this country to airlines that don't reside here and were carrying Indians. I think there's an immense responsibility on our part as Indigo and on the part of airlines like Air India to bring all of that back. So that's our sort of next step. And I think we are well positioned to do that just because of the domestic network. We are able to collect people into a hub and then fly them on bigger planes to other parts of the world. So that's really what we want to do as stage one. And there will come a time at some point in the future where we will, once see the airport hubs sort of mature, where we will carry customers from one geography to another through India. They don't necessarily have to be our customers, but I'm taking an example, somebody from the UK to Australia. I think once we build our network and once the airports are transit friendly.
An interesting conversation there with Rahul Bhatia from Indigo. But let's move on to some other corporate voices for today. And we spoke to Suzlon Energy's management, who told CNBC TV8 that commissioning more than doubled year-on-year basis in the June quarter. The company expects to sustain industry-leading margins, sees FY27 operating outperforming the FY26 performance as well, and reiterated that there will be no change in its capex guidance.
In an exclusive conversation with CNBC TV18, M&M Financial says that its tractor business performed well in the June quarter, though it remains a key monitorable. The company is targeting an ROA of 2.2 to 2.5% while maintaining LIMS at around 7%. Also expects portfolio mix to comprise 70% wheel financing by FY31, with goals being about 4,000 crore in AUM over the next 3 to 4 years.
And speaking to CNBC TV18, Tata Capital said that it continues to see strong growth in the housing as well as two-wheeler segments, while commercial vehicles financing is expected to pick up from the second quarter as well. The company is guiding for an ROA of 2.5% to 2.7%, with 2/3 of the improvement expected to come from NIMS expansion.
All right, and before we wrap, let's go across to Devyani, who will bring you all the key events that you need to watch out for trade tomorrow.
Well, let me start with the domestic events first. Now, it's a packed earnings calendar for the Indian markets. Bajaj Finance, Mahindra Mahindra, Mankind Pharma, Tata Steel, Hyundai Motors, Ultratech Cement, Mazda Docs all come out with their Q1 earnings. Now, there's also an IPO issue opening of Juniper Green Energy, which comes out with an 1,800 crore fresh issue of shares. Now, there's also a couple of listings, including Extranet Tech, Lohia Corp, Indo MIM, that are all set to make their stock market debut tomorrow. And on the global cues front, the US FOMC press conference happens tonight, where the markets will be watching out for whether the Fed keeps rates unchanged, and more importantly, what Chair Kevin Warsh's commentary on the policy outlook is going forward. Now, the headline and core PCE price index on a month-on-month and year-on-year basis data also comes out. So does the Q2 GDP data for the US, and the initial jobless claims of the US also comes out tomorrow. Now, from an earnings standpoint on the global front, in the US, Apple and Amazon both come out with their earnings, and from South Korea, Samsung Electronics is set to come out with their Q2 earnings. So these will all be the ones that we will be watching out for tomorrow.
Devyani, thank you so much for that. But with that, it's a wrap on this edition of Markets Forward. Thank you so much for tuning in. We'll be back with more news and updates on the other side.
and welcome to Business 360. I'm Arundhati Ramanan, and here are the headlines that we're tracking for you this evening. Crude oil prices jump as US and Iran resume attacks after a brief pause. US claims to have prevented a surprise missile attack from Iran and joins forces with Saudi Arabia to target Tehran-backed militia in Iraq. At least 20 killed in joint airstrikes by US and Saudi. US government moves a step closer to impose 100% tariff on Russia's trading partners, including India and China. Senate votes overwhelmingly to advance a new Russia sanctions bill in a rare bipartisan move. One of the authors of the bill accuses India and China specifically for fueling Putin's war machine. Sensex and Nifty rebound. Thanks to a broad-based rally, Nifty moves back above 24,200. IT stocks continue to reclaim lost ground.
There will come a time at some point in the future where we will once see the airport hubs sort of mature, where we will carry customers from one geography to another through India.
Indigo gets ready for a decade of international expansion as the airline clocks its 20th anniversary. MD Rahul Bhatia says India needs global airlines of scale, and Indigo is well positioned to reclaim the economic wealth handed over to foreign airlines.
We keep getting badgered on our size and scale. Like I said, what is not understood is what we are doing, which no one else is doing.
Rahul Bhatia responds to critics raising alarm over Indigo's overwhelming market share, says 1/3 of Indigo's network are unique markets that no one else flies to, credits their cost leadership for their size and their scale.
I think there was a confluence of several different things that came together, and then the cookie crumbled.
Rahul Bhatia says the large-scale Indigo flight cancellations last December was not something customers and frontline employees deserved, adds a multitude of factors including new rostering rules and fleet upgrades broke the camel's back, highlights corrective action has been taken and the airline's punctuality has never been better in the last 6 months. Lok Sabha passes a new bill proposing stricter punishment for exam frauds. Government and opposition clash in Parliament after Rahul Gandhi accuses Home Minister Amit Shah of ordering the police action on student protests in Delhi. BJP denies the charge and demands an apology. Delhi police asks Elon Musk's social media platform X to remove abusive social media posts against Prime Minister Modi made during the student protests, seeks details of the accounts that posted this content, including full name, address, email, and contact details. Supreme Court clears former Prime Minister Manmohan Singh over the alleged coal scam nearly 2 years after his death, accepts CBI closure report over the allocation of a coal block in Odisha to Hindalco in 2005. Supreme Court quashes a 2021 government memorandum allowing retrospective environmental clearance to projects that commenced without obtaining one. Government retains the power to issue retrospective clearances, but only through a valid notification and not through an office memorandum. The death toll due to floods in Assam rises to 75. More than 3 lakh people remain affected across 7 districts, including over 600 villages. More than 32,000 people take shelter across 82 relief camps. At least 13 people are dead following a powerful 7.1 magnitude earthquake in Japan yesterday. Rescue workers race against time as several people remain trapped under the rubble. And the top story this evening, tensions in West Asia escalated as retaliatory attacks resumed after a 3-day pause. Here are the latest developments. Iran launched a surprise attack targeting American air bases in Jordan. The Iranian Revolutionary Guards also said that it has struck and stopped 3 vessels in the Strait of Hormuz overnight. According to a report of the Wall Street Journal, U.S. officials believe that IRGC is actively trying to undermine negotiations to renew the ceasefire and reopen the strait. U.S. forces said that all Iranian ballistic missiles were intercepted. Soon after, U.S. US and Saudi Arabia struck parts of Iraq that are allegedly being used by Iranian proxy groups. Saudi Arabia said that the strikes were in response to drone attacks on its oil facilities. This is the first time that US and Saudi forces have coordinated to launch an attack in the region. This comes as Israeli Prime Minister Benjamin Netanyahu met with US President Donald Trump in Washington. This was the first time that the two leaders met in person since the start of the conflict in February. The Israeli Prime Minister told Fox News that the meeting was one of the best he has ever had with Trump. However, neither Israel nor US have provided details of the conversation just yet. Oil markets remain on edge as Brent crude prices have hovered near the $90 per barrel mark. As per ship tracker Kepler, 39 ships have transited through the Strait of Hormuz as of the 28th of July. According to a Reuters report, Iran has ruled out Oman's proposal for joint management of the Strait of Hormuz. And in the markets, Dalal Street starts the new series on a positive note. Nifty gained over 1% to close firmly above the 24,200 mark. IT stocks led that up move, with that index clocking 8% gains this week alone. While the broader markets underperformed the blue chips, both the Nifty Bank and the mid-cap index entered nearly 0.8% in the green. Adani Ports is reportedly eyeing Britain's biggest ports business, Associated British Ports. Money Control has reported that Adani Ports is evaluating a bid for 64% stake. The deal could be valued at close to £10 billion. The deal could hand the Adani Group control of 21 ports across England, Scotland and Wales. Adani Enterprises has reported a net loss of over 1,100 crore rupees in the first quarter. This is in comparison to a net profit of 885 crore rupees that it had reported during the same quarter last year. The net loss for the quarter is due to a one-time loss of over 2,600 crore rupees, which it paid as a settlement amount to the US Office of Foreign Assets Control. Revenue grew 50%, while margins narrowed by over 400 basis points on an annual basis. Asian Paints has reported a strong set of numbers in the first quarter, beating estimates on all parameters. Net profit jumped nearly 40% on a yearly basis, comfortably ahead of the cnbc TV18 poll. Revenue grew 18%, also topping estimates. The paint major's decorative business posted healthy volume growth as well. From a low-cost airline to now a dominant force in the Indian skies, Indigo's 20-year journey is one of resilience and cost efficiency. Now the airline is betting big on global expansion. Promoter and MD Rahul Bhatia has highlighted that their ambition is not only to connect India to the world, but also to establish India as one of the most important global aviation hubs of the future. In a rare television interview with Shireen Bhan, Bhatia said India needs global airlines of scale, and Indigo is well positioned to reclaim the economic wealth handed over to foreign airlines. He also responded to critics raising alarms over Indigo's overwhelming market share. Bhatia said 1/3 of Indigo's network are unique markets that no one else flies to. That's not all. Bhatia also touched upon the episode of the mass flight cancellations in December last year. He said that a multitude of factors, including new rostering rules, broke the camel's back. He also highlighted that corrective action has been taken since then, and the airline's punctuality has never been better in the last 6 months.
1/3 of our production is in markets where nobody else flies. These are unique markets where we are doing everything we can to bring the nation together. And it's only the balance in markets that we compete in. We only have, I think, about 44%. So this thing about, Indigo being what it is, what is often lost in translation is the fact that we are connecting the hinterland of this country like no one else. And it's not because other airlines cannot fly those routes. They can, but they choose not to. And the reason we are able to do what we do is because of the cost structure. We are able to experiment, and the 33% or 34% of the flying we do into unique markets represents something like 250 city pairs. So while we keep getting badgered on our size and scale, like I said, what is not understood is what we are doing, which no one else is doing.
You know, as you look at expanding both domestically as well as internationally, what changes, if any, are you bringing in to kind of ensure that you leverage on the new momentum that you want to build on?
I think Indigo's journey over the last 20 years was all about building an extensive domestic network. We are not finished doing that. We will continue to do that. That will remain the core of the airline. But having built this network, the next logical step is really to take Indians to the world and bring the Indian diaspora that resides in other parts of the world to India. And that's something which, for reasons I probably prefer not to discuss, was handed over to airlines and geographies outside of this country. With that, there was a lot of export of economic wealth from this country to airlines that don't reside here and were carrying Indians. I think there's an immense responsibility on our part as Indigo and on the part of airlines like Air India to bring all of that back. So that's our sort of next step. And I think we are well positioned to do that just because of the domestic network. We're able to collect people into a hub and then fly them on bigger planes to other parts of the world. So that's really what we want to do as stage one. And there will come a time at some point in the future where we will, once see the airport hubs sort of mature, where we will carry customers from one geography to another through India. They don't necessarily have to be our customers, but I'm taking an example, somebody from the UK to Australia. I think once we build our network and once the airports are transit friendly. I've gone on record to say that December should never have happened. It's not something that our customers deserved. It's not something that our frontline employees deserved. But I think there was a confluence of several different things that came together, and then the cookie crumbled. There was implementation of FDTL. We went through a massive upgrade on our entire fleet. A couple of days before that, there was, I think, volcanic ash. There were several things that came together, and that sort of, broke the back of the camel. But talking about disruptions, the disruption at Indigo was not unique. It was not something that's happened for the first time anywhere in the world. You've had some carriers larger than Indigo that have been through issues like that. Southwest, Ryanair, JetBlue. I mean, there's a long list of these things. Is this something that we wanted? No, of course not. But it happened, and we took corrective action, and we were back up and running in, I think, 2 or 3 days.
How much of what we saw happen in December was a result of poor management decisions, a leadership issue, and hence you believe that the leadership changes that you've been able to bring in will help address some of those challenges?
I think the changes that we have seen over the last 3 or 4 months, some of them have to do in preparing this company for the future. Some of them have to do with holding some people accountable for what happened in December. It's a mix. It's not about one thing or the other. It's really taking stock of what happened that should not have happened, and also building resilience in the organization for the future.
Now, the DGCA, in its findings of what happened in December, talked about operational deficiencies. It talked about optimization, which perhaps had been pushed beyond its limits. It talked about the lack of FDTL preparedness. Now, if I were to ask you on each of those fronts, which has of course been publicly spoken about by the regulator, what is the corrective action that's been taken?
I mean, we have now been flying for 6 months since December, and our punctuality has never been better. And this is something where you earn your wings every single day. We fly, over 2,000 trips a day, and I think the machine runs fairly smoothly. And our only appeal to the government has been that when you look at FDTL regulations, look at it from 2 lenses. One, that we must do what is best in class on a global basis, right? Look at regulations around the world and figure out what's the right thing to do. But if we put in regulations in place which actually, in the garb of being safe, make the industry as a whole uncompetitive because you're actually taking down productivity of the cockpit. I think is something that we need to look at, because you cannot have on the one side an aspiration for the nation as a whole to get on to the stage of global aviation and yet have its airlines compete with the rest of the world with an uncompetitive cost structure.
So you're saying the current FDTL regulations make Indian aviation uncompetitive?
In terms of cockpit productivity, absolutely. We constantly, the industry always gets, again, I use a word and you'll hang on to it, hammered for airfares. And this again something that I think we have not done a good job in educating the world at large. If I gave you the last 3 years statistic, airfares in India, and when I talk about airfares, I'm talking about a portion of the fare that actually belongs to the airlines. Has gone up, and this is the cumulative inflation over the last 3 years has been 12%. With that backdrop, the portion of the fare that belongs to the airlines has gone up between 1 and 3%. UDF charges at airports have gone up to 95%. Landing charges at airports have gone up to 34%. And the reason I make this point is this is not being critical, but I think if we truly want India to become a major global aviation market, I think the whole ecosystem has a responsibility to make sure that we have a cost structure that will allow us to compete.
The Supreme Court has closed the criminal case against former Prime Minister Manmohan Singh in the coal block allocation scam case. Nearly 2 years after his demise, a special judge has accepted closure reports filed by the CBI. The case pertains to the alleged irregular allocation of the Talabira 2 coal block in Odisha to Hindalco Industries during the UPA government's tenure. The Supreme Court has quashed the Centre's 2021 office memorandum that allows retrospective environmental clearances, terming it illegal. The Apex Court also restricted the Centre from issuing administrative orders granting blanket permission for retrospective environmental clearances. However, it clarified that provisions for such clearances should be introduced through a formal notification. On that note, it is time for us to head into a short break. But coming up, government and opposition clash in Parliament as Lok Sabha passes a new bill proposing stricter punishment for exam frauds. More on that when we return. Stay tuned. Welcome back. You're watching Business 360. A quick look at the global headlines of the day. Ukrainian President Zelensky met U.S. President Donald Trump in a closed-door meeting during his trip to Washington. Reports have said that the leaders discussed ways for Ukraine to produce its own weapons in its ongoing war against Russia. White House says that the talks were positive and productive without disclosing further details. The U.S. government moved a step closer to impose a 100% tariff on Russia's trading partners, including India and China. The U.S. Senate voted overwhelmingly to advance a new Russia sanctions bill in a rare bipartisan move. One of the authors of the bill accuses India and China specifically for fueling Putin's war machine.
It's carefully crafted to make sure we are not hitting our allies and that we are hitting China and India. Let's be really blunt. China and India are the main culprits here. They purchase the vast majority of oil and gas. They are fueling Russia's war machine, and they are doing us no favors anywhere else in the world.
The Lok Sabha has passed a new bill proposing stricter punishment for exam frauds. Government and opposition clashed in Parliament after Rahul Gandhi accused Home Minister Amit Shah of ordering the police action on student protests in Delhi. BJP has denied the charge and demands an apology.
Sir, the Home Minister authorized the shooting of our students, sir. He put pellets into the blood of our students. He ordered the students of India to be shot.
किस तर्क के साथ आप ये बयान दिया है, ये बहुत गलत बात बोला है राहुल गांधी जी, बहुत गलत बात बोला। मैं इसका आपत्ति करता हूँ, कार्रवाई से निकालना ही चाहिए, लेकिन राहुल गांधी जी आप माफी मांगिए, ये ठीक बात नहीं है।
अगर नेता प्रतिपक्ष ने कोई गंभीर आरोप लगाया सरकार पे, तो ये सरकार की जिम्मेदारी बनती है कि किसके ऑर्डर पे पुलिस ने बच्चों पर, छात्रों पर, युवाओं पर इस तरह का व्यवहार किया है।
कहीं भी गोली चलाने का आदेश कोई मंत्री नहीं देता, वो मैजिस्ट्रेट देता है, एसडीएम देता है, डीएम देता है। दूसरी बात, ये बार बार स्पष्ट किया गया कि गोली चली ही नहीं, अश्रु गैस, टीयर गैस का इस्तेमाल हुआ, लेकिन जब गोली चली ही नहीं तो आदेश देने का सवाल ही नहीं पैदा होता।
The Delhi police asks Elon Musk's social media platform X to remove abusive social media posts against Prime Minister Modi made during the student protests. Seeks details of the accounts that posted this content, including full name, address, email, and contact details. The flood situation in Assam remains grim. The death toll in the state has risen to 75, and more than 3 lakh people remain affected across 7 districts, including over 600 villages. Over 32,000 people have taken shelter across 82 relief camps. The state government has increased ex gratia assistance for families of flood victims to 9 lakh rupees and relaxed compensation norms. At least 13 people have died following a powerful 7.1 magnitude earthquake in Japan yesterday. Japan's PM Sanai Takaichi said rescue teams are in a race against time. The quake triggered fires, caused buildings to collapse and damaged bridges. Aerial visuals from the affected area showed severe damage, including partial collapses at a shopping mall. And with that, it is a wrap on this edition of Business 360. More news and updates continue right here on CNBC TV 18.
Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Markets have been confusing, the equity market that is, over the last 2 years. It's been a game of patience and also a game of understanding and learning. And I think a lot of us have already learned this lesson that we cannot be putting all our eggs in one basket. We've seen periods of outperformance, very sharp outperformance, for instance, in gold, in silver, in precious metals. There are periods when the fixed income markets and certain types of bonds do better. And of course, there are periods when equity markets are simply shooting higher and higher. Today on the show, we want to get a little more scientific about this generalized principle of being very well diversified. Why do we need to do it? How do we start by making sure that our portfolio is well balanced? And then what are the vehicles to look at? How do we achieve that when it comes to our personal finance goals? That's what we're discussing on the show today. And I have with me Vandana Trivedi, Chief Business Officer at Axis Mutual Fund, joining in to shed some light. Vandana, welcome to the show.
Thank you very much, Surfi. Nice to be here.
So, Vandana, like I was saying, that in general, I think there's return chasing. And let's face it, we all do it as investors. When some asset class is doing well, people will suddenly, flood you with queries, whether it's crypto, whether it's gold, whether it's, Indian small caps and mid caps. So, that's the human nature part of it. But I thought today, let's talk science and figure out, what you think about diversification and whether you think it's important.
Sure. Thank you, Surbi. And I like how you started that anyone who's been in the investment ecosystem has heard this before. Do not put all your eggs in one basket. I think that's the conventional wisdom, and that's something that everyone has bought into. But I like your question, why diversification matters. Now, if you were to take our investment ecosystem, what are the various avenues of investment which you've taken your investors through right now? There is equity as an asset class, and there is not equity only as an asset class, thankfully. There is debt as an asset class, bonds as we understand it colloquially. There is also commodities as an asset class, and from the Indian context is precious metals, more particularly gold, etc. So there are 3 different asset classes which are available in an easy format for investors to invest into. And we keep telling investors that it's a good idea to actually have an exposure to each of these asset classes, that is diversify. Now, why do we say that? We say that because what we've noticed is that as opposed to staying invested in only one asset class, with the hope, like you rightly said, that you make the most returns, when you invest across asset classes, what we have seen is that you're very close to the returns of the best asset class had you invested individually in just that asset class. But that's not the important thing. I think the most significant thing for an investor is that when you spread across asset classes, you're actually significantly reducing volatility, or the experience of your investment journey becomes a lot more smoother. And that's what diversification achieves. That's what staying across different asset classes helps achieve investors, which is to minimize volatility. And why is minimizing volatility important? If I were to draw the analogy of investor behavior, when investors today understand that the investment journey is going to be bumpy, driving on the road to investments or the investment highway is a bumpy ride. However, that's not where investors lose faith or confidence. Where they lose faith or confidence is when they land in a very big pothole, right? That's that one event in that year, that one big phase in that year, that one landing into that huge pothole that makes them relook and exit. And that happens particularly when you're invested in a single asset class. When you're diversified, that doesn't happen, and therefore diversification works.
So to take your road analogy forward, Vandana, what also I've observed around me in the last couple of years is that, so investing is like you have several lanes on the road, right? So you're in your lane, someone else is on the fixed income lane, someone is on the gold and silver lane. When you see that your lane, it could be, let's say, for instance, this is the equity lane, it's slowing down, your car is not moving, accelerating as fast, and now you're stuck in first or second gear, and then you see your friend on the third lane speeding ahead. Then you want to jump into his car or her car, and then you want to make those changes.
The FOMO.
The FOMO. So I'm not sure if that's the way to approach it. It could be a starting point of thinking about it. But what have you made of the FOMO trend, which I'm sure you see in your funds as well? Every time the asset class does well, I'm sure money trickles in.
Yeah, so the FOMO trend is evidenced in our industry. The FOMO trend, again, to stick to your road analogy, is also evidenced in, say, toll booths, right? It's a Murphy's law, right? The lane that you're not on is actually always moving ahead. Yes, we have seen that, Surabhi. And, you know, industry data of flows is there for us to validate this, that investor behavior is always chasing performance. So you know how the inflows into gold and silver were in the last year, not so much yet this year, but how now we are seeing flows into the small cap and the mid cap space. So yes, investors do fall into the trap of what we may call as recency bias, to actually try and stick to the current winning lane or the current fast lane, as you would call it. And yeah, that's something that we could avoid. And that's again why diversification would actually help avoid those kind of behavioral follies, in my view.
So I really believe in my career as someone who's been talking about personal finance for so long, that I think numbers sometimes are the most convincing. So when it's, I'm not saying only price performance numbers, so people will definitely chase the performance when they see an asset class up 30%. But we're going to present you different type of numbers now. And Vandana, I know that you and your team have done, the full correlation analysis.
Yes.
So let's start with
the
chapter
science
101.
behind diversification.
Chapter 101. What is the correlation, negative, positive, flat, between these three key asset classes, equity, fixed income and gold?
Right. So yes, for the last few minutes, I've been harping that diversification is important, stay invested in all of these asset classes. Now, what is the science behind it? Why do we say that, right? We say that because we notice that these asset classes are not correlated to each other. What do we mean by that? What we mean by that is that when there is an event, when there is a macro event or a trigger, these asset classes do not move in tandem. And therein lies the strength of staying invested across all of these asset classes. Bear in mind that when two asset classes have a very low correlation, highest being say +1 and the best situation being -1. -1 means they are at disparity with each other.
They're at opposite ends. One goes up, the other will go down.
Absolutely right. You know, when you say -1, that's the best space to be in. But the lower you are, the closer you are to zero, the better placed you are, or the better your potential of actually earning the best returns out of all of those asset classes. But more importantly, like I highlighted, the better you are in terms of your investment experience, in terms of the drawdowns that you experience. Now, why is drawdown so important? Now, one may argue that I'm an investor, I don't care about those potholes that you spoke about. I'm a very patient investor. I'm okay, I'll ride them through. Good for you. However, if you are in an asset class which has drawn down substantially, then bear in mind that your recovery also needs to be exceedingly high or sharp for you to recover those losses or that drawdown, right? Whereas if the drawdown is moderate, your recovery also needs to be moderate only. And that's where mixing asset classes which have a low to negative correlation is a great space to be in, because your drawdowns are lesser, and therefore your expectations on recovery is also not that high, and therefore it matters. Therefore, correlation matters.
So have these correlations also changed over the years, because the market is an evolving beast, right?
True.
For instance, a lot of people have asked the question on gold in the recent past. Gold is supposed to be a hedge against inflation. Now you're telling me gold is falling because expectations of inflation rising. So some of the correlations have also been challenged since COVID in the last couple of years.
You're absolutely right. There are a few reasons for that. But firstly, let us just substantiate or, table what correlation trends have been over longer periods in time, right? So gold has a negative correlation to both equity and debt as distinct asset classes. Negative correlation, mind you. I'm not talking low positive correlation, I'm talking negative correlation. That over the past 20 years, gold has, as an asset class, has shown a negative correlation to equity and debt. Now, you're right in that over the last 5 years, that negative has moved closer to zero, a little on the positive side. Now, why has that happened? So, see, the characteristic of gold, where does gold draw its strength from? Gold draws its strength from the currency status. Gold draws its strength from, say, a crisis situation, and therefore investors moving to gold, which is a real asset class as opposed to a financial asset class. All of those fundamental factors or triggers that determine the value of gold continues to remain. However, over the last 5 years, I think importantly subsequent to the Russia-Ukraine war and the fallout in how developed nations treated Russian reserves, dollar reserves, which is that, they put an embargo on Russia's ability to call its dollar reserves, which were lying across the world. That's when central banks across the world decided or realized that their money was not safe anywhere. So tomorrow you could be on the wrong side of a large country which decides to put an embargo on your own assets residing in their borders, within their borders. That's why over the last 5 years or so, with respect to gold especially, there has been heavy central bank buying. What you probably see now, especially to the question that, if there is a crisis situation that's persisting, if inflation could well be a problem again because of oil price rise, etc., why is gold not behaving, particularly over the last 1 or 3 months? You could actually, put that away to a lot of buying that's already taken place. 4 years, a kind of a, breather right now. At the cost of, sounding speculative, I would say that if your investors have been waiting for an entry point into gold, a good time to look at gold when there has been a drawdown, not advocating it as a distinct investment option, but as a part of a diversified portfolio, really. So that's what's happening with the gold. The inherent trait of that asset hasn't changed, which is that of a safe haven asset, right? Which is that which should not form more than 10 or 15% of your portfolio at best. It's just that the last few years we have seen such a huge run up in gold that gold is being treated almost at par with equity, and it's actually delivered performances in line with equity. But the place of gold remains as a safe haven asset. That hasn't changed. There are some structural factors which have changed in terms of institutional buying, central bank buying, and that led to the rally. That's how I'd kind of summarize gold.
On that point on gold being a winner in the last couple of years, I think that's well illustrated. There's a heat map. We'll just put that up for our for our viewers as well. We only took 5-6 years of data because that's how much the screen can hold right now. But in the last couple of years, you can see out of the last 6 odd years, gold has topped the league tables 3 times. But I'm sure Vandana will tell us that if you expand this data and go back in time, it's not like gold is always better than equities.
No,
right?
actually, I can tell you the years. Of course, there is some here on the screen as well. But to go back, 2008 was a great year for gold. 2011 was a great year for gold. But over the last 20 years, if you see the split between gold and equity is pretty much the same in terms of the number of years where gold has emerged as the top performing asset class vis-a-vis say equity. And as your table highlights, a lot of it, the catch-up has happened over the last 5 years, which is predominantly driven by institutional buying in my view. And then the retail obviously climbing on to that bandwagon.
I think that table answers everything like Vandana is saying. Please see the table. Last 6 odd years, gold has topped the tally 4 years. So let's not cry about why gold is not rising now, because look at what's happened in the last several years since COVID especially. Now, that's one part of it. So we've understood that asset classes typically are not too correlated. And even Indian fixed income and Indian equities, what is the sort of correlation, negative, flat?
So the longer term track record, the 20-year track record, which is a good track record to see because it kind of irons out aberrations, right? Has been a low correlation. It's not been a negative correlation. It has been a very low correlation. So essentially, fixed income has played its part of balancing your portfolios, doing well. So in the last 20 years, there have been years when fixed income has done has actually ended up being the best asset class. So it's not like it hasn't done its bit. But over the last 20 years or even over the last 5 years, if that's more relevant to the audience, fixed income has delivered almost a steady state return of about anywhere between 6 to 7+ odd percent. That's what you would expect fixed income to do. Fixed income holds okay, let me put it this way. If there is a relay race, right, the runners are all in a hurry, in a massive hurry. And now in that frenzy, when the baton gets passed, there is a chance that the baton gets dropped, right? I would think that equity would be that one runner that would likely drop the baton because it's in a hurry. Gold more recently, otherwise it wasn't so, but more recently, again in a hurry, and therefore you could drop the baton. But your fixed income runner will never drop the baton.
Very important final question on the diversification topic. And you made a very interesting remark just a while back that over long periods of time, if you're in a well-diversified portfolio, your returns would be very similar to say a pure equity type portfolio.
Yeah,
That was a big, powerful statement.
Yeah.
Tell us the data behind that, and then therefore, how should we construct our portfolios?
So essentially, I think that's the outcome that I told you about, right? That over longer periods of time, essentially, a portfolio which offers you a presence across all of these three asset classes has pretty much delivered returns in line with equity, assuming that equity is the best asset class, which history has demonstrated. And why is this happening? This is essentially happening because my drawdowns in a combined diversified portfolio is way lesser than my drawdowns in single. So none of these asset classes should be are volatility free. Okay, left to themselves, they are all significantly volatile. So it's not like any one asset class is less risky than the other, and therefore we are mixing all of them. What we are saying is that each of them individually carry their risks, but them together bring down that volatility in your portfolios. Therefore, if equity markets longer term returns have been around 12 to say 13% centric, your portfolios which have like hybrid funds, as we call them, the portfolios which have combined asset classes, be it balance advantage fund, which combines equity and debt, or multi-asset funds, which combine commodities as well to that equity-debt combo, they've delivered anywhere between, say, 10 to 11%, which is a great outcome to have, right?
Vis-a-vis, say, 13%?
Which is vis-a-vis 13% for a direct equity fund. Which is not bad. Which is not bad at all. And with 30%, and that's, again, long-term, data that we have seen, with at least 30% lesser volatility, which means
less
that...
heartache, less sleepless nights.
Yeah, less sleepless nights, less BP and all of that. So it's a great outcome to have. It's a great outcome to determine your own behavior, right? Much as we are great readers of investment wisdom, etc., you do fall into the trap of action to protect
FOMO,
yourself.
action and
the
hyperaction,
fear, all of
overreaction.
that, right? This makes that entire journey trap-free, is what I would say.
Wow, phenomenal. And I think the data speaks for itself. It really drives home the point that diversification is a no-brainer. It's a non-negotiable when it comes to our portfolios. Have to take a very quick break. When we come back, now within our favorite equity class, for a lot of us, it continues to be equities, right? So within this asset class, what should the mode of diversification be? We'll discuss it after the break.
Let's talk money. Let's talk money.
Welcome back. You're with us on Let's Talk Money, and this week we are discussing the importance of diversification and data that Vandana has shared with us, Vandana Trivedi from Axis Mutual Fund. It really tells us that it's a non-negotiable. We have to ensure that we are well diversified, definitely across asset classes. But within an asset class, Vandana, and that's what I want to talk about now, within equity itself, because there's always this debate, right? Should we be more indexed towards large caps? Is it time for, India is a mid-cap market, India is a small-cap market. So all that's fine. But what is your take on diversification within equities?
Yeah, so if I can explain that, we spoke so much about diversification across asset classes. Now, within each of these, this is like a funnel I like to visualize, right? Now, within each of these asset classes as well, there is place for diversification. And if we were to speak about equity as an asset class, I want to kind of zoom out a bit on what's happening in our economy right now, Surbhi. And we've spoken about this in the past as well. Essentially, given the macro environment outside, you're looking at an economy which is more domestic facing, which is relying a lot more on self-sufficiency and therefore a lot of policy heft towards, say, manufacturing, which is growing around the premiumization theme, and therefore a lot of action around earnings coming in from companies in the hospitality or the healthcare sector, manufacturing around auto ancillaries, around defense, etc. A lot of trust on, power transition, etc. Now, these are themes, right? These are themes that are driving the Indian economy, which consequently is also driving corporate earnings growth. Now, where does equity derive earnings from, or rather growth from? Equity derives growth from GDP growth of the economy and corporate earnings growth. As is evident, a lot of these emerging themes are in the non-large cap space, which is in the mid and the small cap space. So in the Indian context, staying across the mid and small cap is important. Now, that is kind of tabled. However, is there a place for large cap? Why not? I mean, definitely yes. The large cap is the largest by market capitalization, is the biggest. Importantly, they have stood through economic cycles and shown resilience to various economic and credit cycles. So definitely you have a place for large cap.
While everybody understands that you need to have large, mid and good small caps as well, I think till now the conversation has been all around, okay, I have a few mid-cap funds, I have two from the AMC, one from the AMC, True. I have some large caps. So anyway, my portfolio is diversified. Or maybe I have two flexi-cap funds, so usme sab kuch aa jayega. That's been the conversation till now. Why do you feel the time has come to look at multi-cap specifically within a portfolio, which kind of, does that job, rule-based job for you?
The only reason being that, it just trumps investor behavior. I believe, right? And
it puts those guardrails.
Yeah, it gives those, and it also helps you build patience, because what it does is, say today mid caps have taken a beating. Already there's chatter about valuations going high towards mid caps, etc. Right? Say today mid caps have taken a beating, and you have built 3 mid-cap funds in your portfolio. You also have large-cap funds in the portfolio. What you're going to do tomorrow when the NAVs get declared, or end of the month, or end of the quarter, is that you look at your mid-cap row items and you palpitate. You're like, oh God, look at this drawdown. While look at my large cap, oh, it's held fine. And what would you do? You would be tempted to
rotate some money.
You would be tempted to switch because mujhe pata hai, I know, right? And obviously, more than I know, I don't want to be caught on the wrong side. I think that's a bigger sentiment more than anything else. Whereas a multi-cap category actually does that for you. That's just one row item that you look at in your portfolio, which is actually doing the work of stability of earnings of the large cap space, and now with reasonable valuations, plus the growth potential that the mid and the small cap space is offering to you. And most importantly, the fund manager is not under any compulsion to build a portfolio of 50 mid cap stocks or a 50 small cap stocks, right? Typically what happens is, sometimes for lack of choice, you just build portfolios because you don't want to hold cash, right? In multi-cap, because you have the freedom or the requirement to invest across the 3 market capitalizations, you don't have to really, look for the tail. Your best ideas are going into each of these spaces, and therefore a combined scheme category is a great category to be in.
And what about returns from a multi-cap fund? I mean, not that past returns are any indication of future performance, but generally, what should investors
expect? Returns are on our side right now. So you're right, really do not want to pitch this category on returns, but returns are on the side of multi-cap as a category. Multi-cap is a diversified equity fund, a true to label diversified equity fund. One last example on diversification, right? Look at a large large cap portfolio, the stocks within the large cap space, right, the index, say Nifty 50 or Nifty 100, they have a very high correlation to each other. You understand what I'm saying? So within an index, stocks are having a, which means that if 5 stocks are going up, the next 5 will also have a larger correlation or possibility of going up. So even within one capitalization, you're running a high correlation, which like we just discussed so far is not good,
Not a great idea.
right? It's not really helping you at all. But given the stability and the growth mix that the multi-cap portfolio has been able to offer, it has shown the best performance. It has beat FlexiCap as a diversified category, which is a good comparison to make because FlexiCap also you can go across market capitalizations. There are periods in time when mid and small would do better than a multi-cap category, which is happening right now, especially over the last few months. But again, there
longer periods of time when you snap back and look at 3 years, 5 years.
You snap back and then you also look at the experience, right? The drawdown is also as severe in some of those categories, which is not so in multi-cap.
Got that. I think that's a lot of food for thought. And I think the takeaway from this conversation this week, Vandana, is diversify, diversify, diversify.
Yes, thank you very much.
That is the one way to ensure optimal returns, disciplined investing, and the best-in-class, perhaps, return expectation or experience with the market as well. Great to have you with us, Vandana, once again on the show this week. And thank you for making us sit up and really take note and think, given the data and the science behind the art of diversification.
Thank you very much. We always like coming here.
Lovely. All right. Well, with that, we are out of time on this edition of Let's Talk Money. Do send us your feedback, your comments, queries. Let us know what you're thinking. And we'll take up another issue on the show next week. For now, it's a wrap. Thank you for watching.
Let's Talk Money.
Hello and welcome to News Centre. I am Ashmit Kumar. Now, the Parliamentary Standing Committee on Communications and IT, chaired by BJP MP Nishikant Toubro, has summoned representatives of major social media platforms along with officials from the Ministries of Electronics and IT and Home Affairs. Now, the meeting will focus on digital governance and platform accountability for social media. The meeting comes at a time when social media platforms are under intense scrutiny. Most recently, Instagram faced criticism over the way content related to the student protests spread on the platform, with questions being raised over its role in amplifying the movement. Earlier, Meta also found itself in the spotlight after Facebook temporarily blocked the Prime Minister's selfie video. The government has also tightened its oversight of digital platforms. MeitY has issued notices to Meta over WhatsApp's username policy and alleged presence of child sexual abuse material on Instagram. Now, at the same time, the debate over restricting social media access for minors is gaining momentum. States like Karnataka and Andhra Pradesh are exploring policy measures, even as several European countries move to curb social media access for minors. Now, the Supreme Court, too, has flagged concerns over the misuse of AI-generated misinformation, particularly in so-called digital arrest scams. The centre has told the court that it is considering legislation to make such offences punishable under law. Now, to help us unpack all of this conversation is with us former NASSCOM President, former IT Secretary as well, Mr. R. Chandrasekhar. Also with us, Senior Advocate, Mr. Sajjan Puvaya, and Medianama Founder, Mr. Nikhil Pava. To all the gentlemen, thank you so much for joining us. Mr. Chandrasekhar, let me come to you. As we contemplate this question of perhaps stricter accountability, more regulations, more legislation, where do we stand currently? Is the current framework insufficient? We have the IT Act, we have the IT rules, there are AI guidelines as well. Is that insufficient to handle social media platforms?
I think that's really the most important question, Ashmit, because I think we need to remember that the definition of the crime is one thing, and technology is only a means of committing the crime in most of the cases. There are some exceptions, but by and large, that's the situation. So the first thing I think we need to look at is what are the gaps or deficiencies in existing law to deal with these kind of crimes. For example, if you take digital arrest, almost every action involved in digital arrest, whether it is impersonating a police officer or extorting money or confining people, all of these are already crimes in the physical world. And what we are seeing is the use of a digital mode, which adds one more layer, which is that the perpetrators may be remotely located, they may even be located in a different country. But other than that, the crimes are very similar to what has already been prescribed under law. So I think that is the first question which has to be seen to what is the specific deficiency. The second is it a deficiency in the law, or is it a deficiency in enforcement? Or is it a deficiency in the technological means to actually track the offense, the offender, and to be able to trace them? These are all very different things which require different remedies. So I think that for each of the issues that have arisen, those are very central questions which have to be addressed. The second point that you made about, the post by the Prime Minister being blocked for a short period raises a whole different kind of set of questions, which is who decided to block it, even if it was for a short period. Was that person here in India, or was that person sitting somewhere else in some other country or in the US? Or was it some faceless, nameless algorithm operating entirely without supervision? And for all of these, I think the responses will need to be very carefully articulated, keeping in mind the way individuals use the technology and the way the technology operates. And I think that in these cases, especially in the case of digital arrest and in case of the deep fakes, these questions do need to be considered.
Well, that's an interesting perspective. The government saying that at least as far as AI-generated misinformation is concerned, there could be dedicated legislation for that as well. Mr. Puvaya, let me take that question across to you. Is it a question of Is the law not sufficient, or is there something found wanting as far as the execution, the implementation is concerned? We know for a fact that social media companies have been challenging various aspects of the IT Act, the IT rules in multiple courts. They would argue perhaps there's too much regulation. Where do we stand right now, Mr. Puvaya?
It's a bit of both. It's actually the problem with the way legislation is drafted, number one, and number two, it's lack or in some cases inability to implement the legislation. It's one thing to have a legislation which is very strictly drafted. It's totally another to actually implement it in a digital domain. The problem in India, according to me, is not really the lack of legislation. We have, if I can say so, we have a little too many in terms of legislations governing this area of activity. But the problem for us is that we don't have legislations which actually deal with the newer technologies. Come to think of it, with all its amendments, etc., the Information Technology Act is almost 2 decades old. When it comes to artificial intelligence, when it comes to generative AI, when it comes to recommender algorithms, there isn't a legislation which can clearly, today in the country, curb it or govern it. We should really look at what Australia has been planning to do. The one thing when it comes to AI content or generative AI, the best thing to do is actually to watermark it, to flag it as content that is synthetic content and not really organic content. Whilst the Information Technology Act and the rules made thereunder now define what synthetic content is and then put some obligations on the intermediary to demonstrate that it is synthetic content, I think the need for a separate legislation for artificial intelligence, generative AI is very, very important, because a whole host of problems that we are facing is really not on organic information. It's really on synthetic information, number one. Number two, it's one thing, yes, for a parliamentary panel to summon intermediaries to actually, do whatever they can to get the intermediaries to act. But I think at some point of time, you're really shooting the messenger. You really need to look at the problem. There is only so much an intermediary can do. I'm not really holding a brief for an intermediary to say they must be given complete safe harbor in a situation such as this. But there is only so much that an intermediary can do with the extant technology that is available and with the volume of material that's available. Therefore, how do you actually dovetail these two? You dovetail these two from a perspective of making sure that there is digital literacy, at least for prima facie demonstration to say, this is synthetic material which is generated by artificial intelligence and the other one is real, number one. Number two, to actually bring in some sort of a strict liability when it comes to special categories. For example, children. When it comes to, for example, women, in terms of, although it says now the law says that in 2 hours, if private parts of a person is actually put up on the net, etc., in 2 hours, you will do whatever you will do as an intermediary to take it down, etc. But I think a standalone strict liability when it comes to these aspects. Child pornography is one example. You brought out the instance of a BBC journalist demonstrating that there was child pornographic content, or at least child sexual explicit material that was being fed, or that was really algorithmically fed to the recipient, although the recipient didn't call for it. I think those aspects require stricter legislations. Lastly, unfortunately, I think world over, and more so in our country, we attempt to govern the internet through an intermediary. That's really not the answer. Whilst intermediaries, of course, should be responsible in whatever framework within the safe harbor that they will be given, but you really cannot govern the internet through the intermediary. Governing the internet is a larger issue, and digital literacy is the most important. Watermarking is the most important. Identifying the content at its threshold is most important. Therefore, the law should cater to those foundational aspects first before looking at a top-down approach is my thought process.
Mr. Pawar, let me get your thoughts on that. The recent actions that we've seen, great amount of scrutiny by the government, whether it's blocking orders. Some blocking orders, of course, have been challenged as well. We've also seen the IT rules very clearly lay out that there needs to be watermarking, labeling of content. Where are we going wrong? Is there a deficiency that needs to be corrected as far as at least social media regulation is concerned?
Smith, I feel like we're back in 2020 again, because I proposed before the Parliamentary Standing Committee with Mr. Toubro there on the same issue back then. And the problem is that these are actually unsolvable problems, and that regulators, policy makers, and in some instances, even lawyers don't understand how technology is actually works and the fact that technology is not deterministic, it's probabilistic, especially artificial intelligence, right? So when you have let's say 1 billion pieces of content going up on a platform or cross platforms every single day, how can you be, what technology allows you to be deterministic about the fact that something is violating a law? Because laws themselves can be interpreted in various ways, even when it is something as deterministic as child sexual abuse material in this case, as the BBC investigation has shown. Tech will fail. Right now, the CSAM database does a 1:1 match. But if there is new material, it matches only when there's new material added to the database. So when tech cannot be deterministic, how can you have strict liability for platform, except when they do not act when they are informed about certain actions? Now, in the Shreya Singhal case in the Supreme Court, it was determined that the action that they're required to do is under a court order. And so they will, when they do act, how do we hold them liable for this? If we hold them liable for this, will they survive that liability? And under what circumstances will they actually survive liability? When you have 1 billion pieces of content going up on a platform, something is bound to be illegal all the time. How will any platform survive that kind of liability? Do we want no platform at all? On the other side, I want you to invert the situation and look at the kind of regulations that already exist, which the government uses to regulate our speech through these platforms. The government has all the power. Platform representatives actually have criminal liability under the IT rules. Where is it that someone's either been held liable or, when you look at the way both Section 69A and 79 are being used, and there's almost a merger between the two, look at the amount of censorship that has increased since February this year when the 3-hour takedown tool came into play. So effectively, what I'm seeing is, and since between 2020 and now, when I was looking back, what has happened is that the government has increased its powers to censor speech. It uses cases and instances like these and let's say protests like what we've seen to strengthen its own powers. They did that after the CA NRC protests and the farmer protests in 2021. So it uses these mechanisms to increase control over speech and censor. The same way that the Prime Minister's post could have been taken down by mistake, it could happen to anybody else. And it has been happening to them. The fact is they need to be more responsive to it, which is something the IT rules also enable. And we need to follow that process.
Let's take up that question, in fact, that you pointed out, one of claiming of censorship. Let me take that across to Mr. Chandrasekhar. Mr. Chandrasekhar, even as we speak, a notice has been issued to Meta to respond to its username policy. The government clearly wants accountability. For every user of social media, there needs to be an identifier as to who the person behind that account is. Is that what is missing in the current recipe? Is that what's needed? Is that what the government may perhaps contemplate?
Well, actually, there are a few things which are missing. I think I certainly do not want to give an impression that there is nothing which is missing. The user identity is something which is already there in a voluntary form. For example, the blue tick option, which was there in X. The question, however, is whether this identity option should be made mandatory or whether it should remain a voluntary effort. And so far, the culture of the internet has been to enable or at least to tolerate anonymity. Now, moving away from that is a major decision, number one. Number two is that, the question also is of uniformity across different jurisdictions. For example, if you take, the issue of CSAM, that is the child sexual abuse material, that is arguably more to a much greater extent enforced across the world, because universally that is regarded as something which should not be tolerated, and therefore its implementation is far more effective. When it comes to something like pornography, for example, definitions across the world vary, the practices vary, and therefore the implementation and enforcement becomes very difficult. That's why the Supreme Court various directives on pornography itself were, I would say, largely ineffective in curbing that. The one more aspect is that, the point that you mentioned about watermarking and declaring content to have been synthetically altered, that's a very important point. But the question is, who will watermark it? There are people who provide the foundational technologies, who alone can guarantee that all content prepared with that technology will be marked. Then there are people who use the technology to create synthetic content, and there are people who are recipients of that technology. Each of these are very different. Now, an Indian law which requires the technology provider to mark the content, I think we come to the question of extraterritorial jurisdiction. So there are all these questions.
That's an interesting point that you're raising, Mr. Chandrasekhar. We're running out of time, but Mr. Pava, I see you raising your finger. One quick shot to you, 30 seconds. Go ahead.
Yeah, find me a watermark that someone cannot remove using technology, right? And that's the problem. I also just want to point one important thing out, Asmit, in the short time that I have. The BitChat order that was issued by the government said that that the app doesn't have any mandatory registration. It has no phone number verification. It has no central log of who said what. And it effectively evades surveillance and it allows anonymous coordination. That should give us an indication into what the government wants to do, because that order itself was illegal. Because there is no law that restricts any of these things today.
Right, Mr. Pava. Clearly, this is a subject of heated debate. It will continue, of course. August 3rd, this coming Monday, is when the Parliamentary Committee will be hosting the representatives of the social media companies as well as the IT Ministry and MHA. We'll, of course, circle back to this issue and reach out again to all of our panelists for their insight as and when this conversation begins to take shape as to whether or not there is need for regulation, and if yes, then what shape and form that will take. With that, it's time now for slipping into a very short break. When coming up next, the US Senate has advanced sweeping sanctions legislating targeting Russia's energy sector and top buyers. What could that mean for India and an already strained global oil supply market? Well, we'll discuss that on the other side. Welcome back to News Center. Now, the U.S. Senate has advanced sweeping sanctions targeting Russia's energy sector amidst Ukrainian President Vladimir Zelensky's Washington visit. The bill seeks to sanction Russian officials and impose steep tariffs on countries such as India and China to curb their dependence on Russian oil and gas. If enacted, the bill would allow the U.S. to impose tariffs of up to 100% on major buyers of Russian energy, including India. Such a move could further tighten global oil supplies, which are already under pressure because of the conflict in West Asia. What does that exactly mean for India, its relationship with US? Well, to help us unpack that, we have with us former Foreign Secretary, Mr. Kanwal Sibal. Ambassador, let me get your thoughts on this. The US contemplating upon this bill. Now, this bill very cleverly grants an exemption to European countries. They can buy Russian oil. It grants an exemptions to the US itself. US can buy uranium from Russia. However, there appears to be a highly penal treatment of India, levying penalty of up to 100%. How do you see this? How can India respond?
You know, we've gone through this before. After all, Trump had imposed 25% penalty tariffs on us because we were buying Russian oil. Now they've upped the ante as a kind of a gift to the memory of this warmonger called Lindsey Graham. And of course, Senator Blumenthal, I don't know what ticks him. He's also one of those warmongers, deeply anti-Russian with no sense of geopolitics. And these senators have a very, they have a great sense of self-importance. They are far more important than countries and heads of state and whatever. They think that they can define international relations and also develop laws that will serve American interests, no matter if the interests of friends and allies are hurt. Now, what has happened is that that they have now had this cloture bill. Now, in September, they will discuss this legislation. Since the score was 86-12, so obviously it will pass. Now, the thing here is that we've always said and believed that there is a consensus, all-party consensus in the United States with regard to relationship with India, that it spans both the Republicans and the Democrats. Now, it is quite clear that this is an exaggeration. There is no multi-party consensus in the US Congress in favor of India, because they have very clearly said that the two countries that they're going to target specifically are China and India. Now, that is one part. The other is that the entire basis on which they want to do this is entirely bogus and self-serving. Right. India, of course, has been buying Russian oil. In fact, as you know, the previous government was encouraging India to buy Russian oil so as to keep a check on oil prices. Even the Trump administration has been giving waivers after waivers because they wanted to keep the price of oil low. They're very worried about the rising costs of oil.
Let me actually come in on that. Ambassador Sibal, let me come in on that. You mentioned the waivers that the administration has been granting. This bill, very interestingly, also has a presidential waiver provision. The president can grant a waiver. Do you see this as perhaps in the longer run, the president erring on the side of caution, granting a waiver to India, even as this point being used as a scare tactic?
No. There is a game behind this. And since I've served in Washington, I know what the game is. The game is to give powers to the president. And there is a kind of conspiracy between the administration and the Congress. It's not always that the Congress does what it wants, irrespective of what the White House feels. Very frequently, there is a conspiracy between the two that gives the president the power to impose tariffs or sanctions, and then give him the power to weigh, which means that they'll do two things, that they will hang a Damocles sword on the head of the countries they want to target, make those countries come to the United States to make a plea for waivers, against which a person like Trump, who's terribly transactional, will then want to extract further concessions from us on trade, because that issue has not yet been resolved. So this is a game, and it's a very unfortunate game, because after all, it is a sovereign right of any country, independent country, to decide who they should trade with. Who is the United States or the US Senate to impose restrictions on independent countries to decide who their trade partners are? And furthermore, you know, Trump has been caught in a very difficult situation because of the closure of the Strait of Hormuz, and of course his rash step to start the war against Iran, because he knows, A, that the oil prices will shoot up, and secondly, he admitted himself that the reserves of the United States were only 30 days, and therefore he couldn't pursue this. Now, in that background, I can't understand the rationale of what the United States wants to do. And number three, it'll be delivering a very strong blow to India-US ties. Already, there are big problems in our relationship. This will make it
for setback. Well, speaking of a setback, Mr. Sibal, we're running out of time. I'll come to you for another quick closing comment. What impact do you see this having on the India-US trade deal? It was already under a lot of stress on account of 301 tariffs. Now, will this muddy waters even further?
Yes, of course, because we have now said that, look, unless we get some additional benefit from the Section 301 tariffs as compared to our competitors, we are not going to sign the trade deal. Now, with the threat of 100% tariffs looming on India, then how can you have a trade deal? So, in fact, I think he has made the situation much worse by entertaining, I'm talking of Trump, by entertaining and encouraging this legislation by the US Senate.
Well, interesting thoughts. And we have to see, of course, how this pans out, whether or not it passes muster in Washington and what impact that will have on India-US ties. Ambassador Sibal, appreciate your time for joining us all the way from Washington, giving us clarity on what the road ahead may look like. But that, unfortunately, is all the time that we have. It's a wrap on this edition of News Center. More news and updates will continue right here.
Hello and welcome. You're watching the Global Reset with me, Prashant Nair. On the program today, in just a bit from now, we'll discuss whether AI spending is building a revolution or a bubble, and much more with two gentlemen who've got the answers to this question. Sylvian Duranton is Managing Director, Senior Partner and the Global Leader at BCGX, and Nipun Kalra is the Managing Director, Senior Partner and Global Leader for AI in Financial Institutions Practice at BCG. Well, that conversation comes up in just a bit. Here's a quick run-through of the news updates before we get to that particular conversation. Now, it's West Asia. This tension seems to re-escalate. The U.S. Central Command said that Iran's Revolutionary Guard, that is IRGC, launched multiple ballistic missiles in an attempted surprise attack on U.S. forces in West Asia, adding that all missiles were successfully intercepted. Oil prices, of course, bounced on the back of this news which came through. Saudi Arabia has also said that its air defenses destroyed several drones targeting its oil facilities in the eastern province, launched from Iraq by Iran-led aligned groups. Now, Iran's Deputy Foreign Minister has warned that Iran will consider any action to maintain control over the Strait of Hormuz, including the resumption of war. That's very much on the table, according to the Iranian Foreign Minister. Meanwhile, U.S. President Donald Trump met Israeli Prime Minister Benjamin Netanyahu and held positive and productive talks, according to the White House. Netanyahu said his meeting with Trump was excellent and one of the best conversations they've had. Additionally, Iranian Foreign Minister says that he was assured by his Ukrainian counterpart that the attack on an Iranian ship was unintentional and that Ukraine seeks no escalation. Well, there's a bit of news flow, not very positive, with regards to India as well, and actually India and China. The U.S. Senator from Connecticut has said that the key Russia sanctions bill will see India and China explicitly targeted by up to 100% tariffs, and adds that the two nations are fulfilling Putin's war machine against Ukraine. Listen in.
It authorizes tariffs up to 100%. The five largest purchasers of Russian oil and gas. It's carefully crafted to make sure we are not hitting our allies and that we are hitting China and India. Let's be really blunt. China and India are the main culprits here. They purchase the vast majority of oil and gas. They are fueling Russia's war machine, and they are doing us no favors anywhere else in the world. And you can see the effect of tariffs by the recent history here.
Okay, we'll come a full circle in that sense. There were these penal tariffs which were taken away. There were negotiations. Then this U.S. Supreme Court ruling which, struck down AIPA, the emergency clauses, illegal things. But basically, this is now back on the table. We'll have to see how far this goes. The Fed decision is tonight, and this is important because the Fed's got a new chief, perhaps aligned with what President Trump wants, who's been, constantly pushing for lower rates. I just want to quickly play out what our colleague in CNBC US, Steve Leisman, with the findings of our latest Fed survey.
Yeah, change is coming. Respondents to the CNBC Fed survey see no change in rates, however, this meeting, but they're divided on the outlook for hikes in the next year. And they are expecting big changes to how the Fed operates under new Fed Chairman Kevin Warsh, which come, by the way, with a measure of concern from our respondents. Just 39% of the 29 respondents expect Warsh to hold a press conference after every meeting. That's down from 59% of the June survey. 18% think it's going to happen only when the Fed issues the forecast or the SEP, and 19% say rarely, while 25% they just don't know. 59%, meanwhile, believe the dot plot or estimates about the future course of rates from individual Fed officials, that's going to be eliminated. Another 30% think they will be modified. A big issue here has been Warsh's refusal, not just to provide forward guidance, but even his reaction function, or how the Fed will forecast rates. Forecast rates will be set under different economic circumstances. 70% say the Fed should be doing this, that is, providing their reaction function. More than half, meanwhile, say not doing this will lead to less effective monetary policy, and 70% say it will lead to more market volatility. Guy Labat, chief fixed income strategist at Janney Montgomery Scott, says the uncertainty generated by Warsh's early pronouncements are forcing firms exposed to overnight interest rate swings to hedge against those swings, which will incur a cost in the long run. We might soon that volatility. We might see that volatility as soon as tomorrow. Fed futures markets place a 28% probability right now on a rate hike at tomorrow's meeting. That's a big number for a meeting where most expect no change, followed by a 76% chance of hike by September. Some significant adjustments are going to be needed depending upon what War says or what he doesn't say.
We'll take a break. We're back in just a bit with the top team at BCGX to discuss all things AI spending, the boom, bust, question mark, and of course, what all of it means for Indian IT services companies and how enterprises in India are changing up in that sense to what's happening globally. Stay tuned. Coming up. Welcome back. As promised, let's get into the AI discussion. Now, AI is no longer merely a technology story. It is becoming one of the largest capital allocation experiments in corporate history. Hundreds of billions of dollars are, of course, being committed to chips, data centers, power, computing capacity, and more. The biggest technology companies are spending at a pace that is beginning to test investor patience, raising every once in a while an obvious question. Are we witnessing the early stages of a genuine productivity revolution? Or is this the start of some sort of a bubble? We've seen these corrections, as I mentioned before we took that break. At the same time, the cost of intelligence, of course, is falling. Cheaper and increasingly capable open models, many emerging from China, are challenging the economics of the closed model leaders. That could accelerate adoption, but it could also commoditize the models themselves and shift value towards companies that control customer relationships, proprietary data, and business workflows. For corporate India, the questions are immediate. Should companies be building their own AI capabilities or simply buying tools? Why are so many pilots which are being used, still struggling to produce measurable large profits, and what happens to, of course, Indian IT services, about which we've spoken about and continue to speak about quite a bit. What's the shape of things for them as far as jobs go, business is concerned? Lots of these companies are moving towards away from time and materials kind of contract and billing to outcome-based pricing. Let's get answers to some of these questions, and we have with us Sylvian Duranton. He's Managing Director and Senior Partner and Global Leader of BCG. Nipun Kalra is Managing Director and Senior Partner at BCG. Gentlemen, great to have both of you here. Thank you very much for making the time. So let's get the global first, then the local.
Absolutely.
Sylvian, so what's happening? I mean, so much is happening, it's difficult to keep track.
So much is happening. I think one of the key concerns now is the cost of token, which is becoming very real for many companies. And companies know they might not be fully paying the full price because there's lots of investment, and they also see consumption increasing exponentially. So there's one question, which is how to rein in the cost of token. And part of that is the sourcing of token. And we see more and more companies starting to consider, should I rely only upon closed commercial models? Should I start using also open weight models? The previous AI ecosystem has been heavily relying on open source solutions, model, libraries of algorithms. So there's a bit this question on how much will be
So what is
open
happening?
source.
What is actually happening in Europe, in America? What are companies, because the cost of tokens, this argument has been going on for a while, right?
So
are companies actually making changes?
So companies are actually making changes. I think they are not to a point where they would say, we don't want to use the closed commercial models. They continue to use them. But as an alternative, they start to use open weight model more and more.
Like which ones?
It could be Chinese model. It could be also US model. You have versions of Gemini, for instance, that you can run also on your own infrastructure. But there's a move toward testing those models. The notion being a bit, companies will be using different kinds of models for different types of tasks. Today, we are a bit in a situation where everyone is using like a fighter jet to go and fetch their kids at school. So it's a bit weird, the current situation. And at some point, very advanced tasks will require super advanced models. Others might need more like less advanced models. And that's where companies start to mature. Many companies were in, let's adopt, let's push. And by the way, India is the place in the world where adoption is highest. So that has worked super well. Now comes a bit of reason and maturity, which is okay. Now, which model for which tasks?
It's interesting you say that American and Western companies are open to using Chinese models. I think there was a Wall Street Journal survey which kind of pointed to it. I ask companies, we speak with IT companies here all the time, who work with these enterprises, all Fortune 500 companies in the US, and they say, just one company told me yesterday, Coforge, that, well, it was a specific question. Are Western companies comfortable using Chinese models? He said, well, his clients mostly are not. They're still sticking with American models. And is that something you see, or?
You see two things. Some companies want to stick to Western models. So you have American models, but you also have European models. And some of them are also available with open weight versions of them. And some are starting to use also Chinese model. You have many multinational companies who anyway need to operate outside of the Western world, in China, in Middle East, in India. And here companies are used to use those technologies anyway in other markets. So they're ready to experiment, test, and see whether they can use them elsewhere. But we see that trend more and more prominent with clients because of the cost of tokens, basically. Then there's model, there's the cost, but I think the future is not just about the model. It's also about the features like safety, traceability, cybersecurity is really a booming topic
we'll
right
talk about
now.
that. But what does all of this mean? Which is what you said, that fighter jet example, right? There are not everything needs to go to the frontier model. Simpler tasks. You want to order food, you don't have to send it to the highest available, most advanced model. It can happen on your computer. So what does it mean? The 7 companies are spending $800 billion in capex, right? So have you seen the peak of that? It doesn't look like it, right? Alphabet just reported numbers. They've raised how much they want to spend in capital expenditure. So why is this happening?
I think this is happening because, of course, everyone is looking at the cost of token, what's happening now. But the key underlying trend is exponential growth of use. If you look by any measure, how much AI is used and consumed today versus the potential of use and AI, there's a huge gap. And to fill that gap, we need different types of models, different types of players, different types of approaches for companies. And that's why the market continues to be quite bullish and the investors continue to invest in those models, because there will be ample room and ample opportunities. We are just scratching the surface. And there's been many surveys looking at, potential use of AI, actual use of AI. Although everyone is talking about AI, we are very far from maxing out.
It almost, and this is the gap many have pointed out, right? These model companies are, far ahead, but enterprise adoption, I don't know, maybe it's picked up, but I think till about a year ago, maybe 6 months back, there was this big AI summit which happened in Delhi, and we met up with lots of companies at that point. That enterprise adoption is still lagging because but the model companies are running far ahead. How big is that gap right now?
So, the point that you were raising earlier, which is around the fact that the tech is evolving very rapidly. Everybody has seen token cost, this and that, we spoke about it. But the complementary innovation that needs to happen within the context of the enterprise, that has to keep pace. Now what's happening? So there are 2-3 different metrics that we keep tracking, and we survey this pretty much like every 6 months. What we found is that frontline workers' adoption for AI in India is actually the highest. Like Silvan said, 95% are using some of the other kind of AI several times a week. Now, to bank that productivity...
These are individuals? Or
these are individuals. Right. Individuals consuming AI, frontline workers, white-collared people, they're consuming AI, 95% of them in India.
In their work or
At work. At work. This is not personal happy birthday to my friend. This is not that one. But the idea is to say that is getting consumed, and this is several times a week, which is actually the highest in India. But as you think about this, banking this productivity back into the enterprise, that is really where the challenge is, right? And so good news is that people are getting comfortable around it. That actually is super good, right? But as you think about translating that into a P&L gain for an enterprise, that's where the gap is. Now, why is that happening? There are 2-3 different reasons, right? The first one is around the fact that the same survey also tells us that 55% of Indian CEOs drive AI as their own agenda, as compared to 72% globally. Now, what that means is that everybody else, let's say, out of the 55% outside, is being driven by either tech or, let's say, the data science function in the organization. When it is driven by only tech or data science, it is more of a tool. You build or buy something, may or may not get adopted in the P&L, and may not actually result in some real redesign of the organization. That is actually a huge challenge. There is one more important metric. What we found is that only 14% CEOs reported that there is a real P&L gain / metric that is tracked across every initiative that they have inside their organization. So to have, let's say, every initiative having a P&L impact, that matching is not happening yet, at least at this point in time. Only 14%.
Indian context.
This is 14% is global, but the 55-72 number that I told you is India versus global. 55% CEOs driving AI agenda in India versus 72% globally.
Sure.
That's the gap. So as it starts coming more at the CEO desk, that becomes an overall P&L agenda. Then you start seeing more impact.
More impact. There is no if especially I sometimes feel, right. I mean, if you're a public company, listed company, I mean, unless you have an AI strategy, I mean, is there a bit of a FOMO as well that I must have?
So I'll tell you an interesting metric on that.
I'm not saying it's not real and it's not going to change the world, but I'm just saying, is that perhaps also at the margin?
I can tell you an interesting metric on that one, right? Again, the same survey. What we figured is that we asked this question that what is driving your, let's say, optimism around AI, and why do you believe there is value and so on, right? And there is a bunch of sort of responses that we got. Only 3% came back saying that this is only because of FOMO. Only 3%.
I see.
Which means that a large majority believes there is real conviction around value getting delivered. 76%.
This is an anonymous survey, I'm assuming. But okay, you're saying that majority, only 3% said that was basically because others were doing it or whatever, right? But large majority believe this was transformational in that sense. And the cost bit, Nipun, you want to just comment on that? Is that an issue here when you talk to
So, when you think about any transformation in India, it's always very value-led, right? Every Indian company, every CXO, CEO is going to worry about value first. Consumption in India is not very driven by what is the lineage of this model, where is this coming from. It's very horses for courses sort of answer. It's a very multi-tiered consumption. And as you think about this, which is exactly the fighter jet kids point, right? Not every workload is a frontier workload, and it's okay. And people are super okay to have self-hosted models, open source, Chinese, American, doesn't matter. But as long as it's doing the job, everything's fine. But most companies are making sure that architectures are agnostic to models that are being consumed. That is actually a very key part of the strategy.
I see. So unlike in Western, maybe in the West, there's this big competition with China, etc. Here, I mean, you're saying it's largely, and we speak with IT companies and we ask them, are you working with everyone? They say, well, we are model agnostic in that sense, and they're implementing this stuff with as far as enterprises go. So is there an inflection point here, Nipun, with Indian enterprises? Does something need to happen in terms of how, because you are working with companies in India. So yeah, I mean, CEOs can drive it. Is it about, those what became a fancy word, forward deployed engineers, those kind of things? I mean, does it need to have, do legacy systems need to be updated to be able to sort of, integrate some of these new technologies in, and is all of that happening, or do we need the change agent here, and what will that be?
So I think the biggest reason for why it's taking time is that we are spreading ourselves too thin. Many organizations end up doing many POCs. Let's do a pilot. Let's look at a demo. There is a center of excellence that's building out a bunch of demos, rolling things out, making CXOs happy, looking at what people are using versus not, and so on. What we figured is that organizations that are most likely to succeed are the ones that are doing only a few things. And they're rewiring that entire function / let's say customer journey or any other important motion in the organization end to end. Till the time only a few things are picked up and end-to-end transformation is done, it's very hard to see benefit. And then it's also very hard to attribute it to something real, right? And the other part of the story is that often, it's the conversation is to say, is AI getting me P&L benefit or not, and so on, right? AI is just one part of the story. It's not the full answer. As you think about this, there's a lot of surround, including the digital process around it, the people that are manning that, the actual KPI of who's working on this one, the final outcome that's getting delivered, the whole story has to get reimagined, then you see real value. Yeah. And AI is one part of the story.
Yeah. So say, I'm just asking you, this is a question not so much about IT services, right? But you go in and advise companies into how you should do it, what the strategy should be. Are people within the organization, how do they typically work? I mean, they reorient themselves and they're able to do it, or you need outside help? I mean, outside AI experts to come in and change the whole thing up. How does it typically work? I'm just asking.
I'd be very happy to say you need outside help, but I
mean, you were there with regards to outside help in terms of strategy, right? But I'm saying purely in terms of technology.
Yes.
Who does the, someone who's familiar with how these works, integrating all of that. Do internal teams able to do all of it once the direction is set, or for that you need technology experts, outside technology experts?
So I can tell you at least the way the journeys are progressing. Organizations that have very clear AI strategy have figured that if they do not have internal muscle, it's going to be very hard to constantly iterate on what's being built. This is not a one-time story. It's not once and done, right? You may need some external catalyst to get you there. You may need some external help to get you build that muscle. But if you don't have that muscle internally, it's very hard to constantly keep pivoting, iterating, and thinking about what is your core operation and how's that becoming better every day, every year, every month, right? So that internal muscle is a non-negotiable.
And if I may build on that point, it's not incremental progressive change. I think we've seen that in the past with coding assistant, people could be a bit faster and all of that. Now in the world of harness engineering, where the job of engineers is no longer to code, but to build a sort of factory that will code for them and that will test and that will write the specs and everything, you need a major shift in the mindset, in the organization, in the chapters, in the way you price things. It's a major disruption. And for that disruption, I think, continuous progress that companies can manage themselves is no longer sufficient.
You need, as Nipun I think said, internally you need a set of people to be able to sort of drive this keep up to date and do all of that. So Sylvain, just a quick word. I don't know if you have a view on this. In terms of just sheer spending towards, because you have a broader view, global view, is the peak behind us, or you think the peak is still ahead of us?
The peak is ahead of us. If you look, we surveyed 1,800 C-suite members for Davos this year. And they were basically expecting between 25 and 26 a doubling of the resources dedicated to their AI transformation with an average of 2%. And that number will continue to grow. I don't see any signal of any hesitation, and I would even say CEOs start to see that their job, the legacy will be that they bring their companies onto the AI trajectory. And in that survey, one of the numbers that was very striking for me, 94% of CEOs told us, for my AI investment in 2026, if I don't see the return I expect, I will continue. And out of those 94%, 27% said, and by the way, if I don't see the return, I will increase my investment because it means we are not serious enough. Wow. So this will continue to grow for sure.
Okay. Which industries, Nipun, are taking to all of this? They say that since data is the prerequisite, so it's financial services, the entire gamut of financial services, right? Insurance and all of it. Is that going to be the top adopter if you look industry-wise? I'm talking about the Indian context.
It's definitely one of the front runners. Financial services for sure. Also retail. Also now manufacturing. There is a lot of data that's being captured over a period of time. And like you said, data is actually the most important proprietary sort of asset that you need before you can do any kind of transformation. So, and healthcare. I don't want to all of them are super important, but wherever, let's say within the industry, the company that has been able to, let's say, invest in their data capabilities are the ones that are able to somehow sprint ahead. And the others that have not necessarily done that in the past are actually doing that right now. This is kind of a forcing function to also invest in their data capabilities. So that's what's happening.
Is trust an issue? Because I think there was the Palantir CEO in the US who made some points, and others have spoken about it as well. So does that come up in conversations, or is just
Trust comes up very often because you read a lot of things on what's happening in the world, and you have misalignment of some agents.
You're giving everything to these models, and the models can maybe outcompete you.
Yeah, but that's exactly where, when you do experiments and you want to push those models to the limit, you give everything to them and you see what they do, and you can see things you don't want to see. In a corporate environment, on well-defined tasks and sequence of actions, you can build protocols so that what you do is safe. And we see companies investing more and more in terms of safety teams, responsible AI teams, cybersecurity teams, to make sure that what is done at industrial scale. Some companies do that very well, and there are technical ways to make sure that things are going well. Some, it's a blind spot, they're under-investing, and there's a big call for everyone to be super responsible in terms of how they deploy these things, because some companies are there and others are really not investing enough there. But there are technical solutions to make sure that in your business processes, what you build is reliable.
Well, fantastic conversation, gentlemen. Sylvain, you're based in Paris, right?
Yes.
I wanted to ask about, but maybe in the next time you're here, what's happening in Europe? Is Europe catching up? You've got a bunch of companies, Mistral and others, but maybe another time.
Another time, happy to discuss the whole geopolitics of AI, which is a fascinating topic.
Thank you so much for dropping by, Sylvain. Great conversation. Nipun, thank you very much for being here with us in the studios. Well, that's it. That's the show. Top experts as far as AI is concerned from the BCG team. Thank you very much for staying with me. More comes up on the other side.
Hello and welcome to Business 360. I'm Arundhati Ramanan and here are the headlines that we're tracking for you this evening. Crude oil prices jump as US and Iran resume attacks after a brief pause. US claims to have prevented a surprise missile attack from Iran and joins forces with Saudi Arabia to target Tehran-backed militia in Iraq. At least 20 killed in joint airstrikes by US and Saudi. US government moves a step closer to impose 100% tariff on Russia's trading partners, including India and China. Senate votes overwhelmingly to advance a new Russia sanctions bill in a rare bipartisan move. One of the authors of the bill accuses India and China specifically for fueling Putin's war machine. Sensex and Nifty rebound. Thanks to a broad-based rally, Nifty moves back above 24,200. IT stocks continue to reclaim lost ground.
There will come a time at some point in the future where we will once see the airport hubs sort of mature, where we will carry customers from one geography to another through India.
Indigo gets ready for a decade of international expansion as the airline clocks its 20th anniversary. MD Rahul Bhatia says India needs global airlines of scale and Indigo is well positioned to reclaim the economic wealth handed over to foreign airlines.
We keep getting badgered on our size and scale. Like I said, what is not understood is what we are doing, which no one else is doing.
Rahul Bhatia responds to critics raising alarm over Indigo's overwhelming market share, says 1/3 of Indigo's network are unique markets that no one else flies to, credits their cost leadership for their size and their scale.
I think there was a confluence of several different things that came together, and then the cookie crumbled.
Rahul Bhatia says the large-scale Indigo flight cancellations last December was not something customers and frontline employees deserved, adds a multitude of factors including new rostering rules and fleet upgrades broke the camel's back, highlights corrective action has been taken and the airline's punctuality has never been better in the last 6 months. Lok Sabha passes a new bill proposing stricter punishment for exam frauds. Government and opposition clash in Parliament after Rahul Gandhi accuses Home Minister Amit Shah of ordering the police action on student protests in Delhi. BJP denies the charge and demands an apology. Delhi police asks Elon Musk's social media platform X to remove abusive social media posts against Prime Minister Modi made during the student protests, seeks details of the accounts that posted this content, including full name, address, email, and contact details. Supreme Court clears former Prime Minister Manmohan Singh over the alleged coal scam nearly 2 years after his death, accepts CBI closure report over the allocation of a coal block in Odisha to Hindalco in 2005. Supreme Court quashes a 2021 government memorandum allowing retrospective environmental clearance to projects that commenced without obtaining one. Government retains the power to issue retrospective clearances, but only through a valid notification and not through an office memorandum. The death toll due to floods in Assam rises to 75. More than 3 lakh people remain affected across 7 districts, including over 600 villages. More than 32,000 people take shelter across 82 relief camps. At least 13 people are dead following a powerful 7.1 magnitude earthquake in Japan yesterday. Rescue workers race against time as several people remain trapped under the rubble. And the top story this evening, tensions in West Asia escalated as retaliatory attacks resumed after a 3-day pause. Here are the latest developments. Iran launched a surprise attack targeting American air bases in Jordan. The Iranian Revolutionary Guards also said that it has struck and stopped 3 vessels in the Strait of Hormuz overnight. According to a report of the Wall Street Journal, U.S. officials believe that IRGC is actively trying to undermine negotiations to renew the ceasefire and reopen the strait. U.S. forces said that all Iranian ballistic missiles were intercepted. Soon after, U.S. US and Saudi Arabia struck parts of Iraq that are allegedly being used by Iranian proxy groups. Saudi Arabia said that the strikes were in response to drone attacks on its oil facilities. This is the first time that US and Saudi forces have coordinated to launch an attack in the region. This comes as Israeli Prime Minister Benjamin Netanyahu met with US President Donald Trump in Washington. This was the first time that the two leaders met in person since the start of the conflict in February. The Israeli Prime Minister told Fox News that the meeting was one of the best he has ever had with Trump. However, neither Israel nor US have provided details of the conversation just yet. Oil markets remain on edge as Brent crude prices have hovered near the $90 per barrel mark. As per ship tracker Kepler, 39 ships have transited through the Strait of Hormuz as of the 28th of July. According to a Reuters report, Iran has ruled out Oman's proposal for joint management of the Strait of Hormuz. And in the markets, Dalal Street starts the new series on a positive note. Nifty gained over 1% to close firmly above the 24,200 mark. IT stocks led that up move, with that index clocking 8% gains this week alone. While the broader markets underperformed the blue chips, both the Nifty Bank and the mid-cap index entered nearly 0.8% in the green. Adani Ports is reportedly eyeing Britain's biggest ports business, Associated British Ports. Money Control has reported that Adani Ports is evaluating a bid for 64% stake. The deal could be valued at close to £10 billion. The deal could hand the Adani Group control of 21 ports across England, Scotland and Wales. Adani Enterprises has reported a net loss of over 1,100 crore rupees in the first quarter. This is in comparison to a net profit of 885 crore rupees that it had reported during the same quarter last year. The net loss for the quarter is due to a one-time loss of over 2,600 crore rupees, which it paid as a settlement amount to the US Office of Foreign Assets Control. Revenue grew 50%, while margins narrowed by over 400 basis points on an annual basis. Asian Paints has reported a strong set of numbers in the first quarter, beating estimates on all parameters. Net profit jumped nearly 40% on a yearly basis, comfortably ahead of the cnbc TV18 poll. Revenue grew 18%, also topping estimates. The paint major's decorative business posted healthy volume growth as well. From a low-cost airline to now a dominant force in the Indian skies, Indigo's 20-year journey is one of resilience and cost efficiency. Now the airline is betting big on global expansion. Promoter and MD Rahul Bhatia has highlighted that their ambition is not only to connect India to the world, but also to establish India as one of the most important global aviation hubs of the future. In a rare television interview with Shireen Bhan, Bhatia said India needs global airlines of scale, and Indigo is well positioned to reclaim the economic wealth handed over to foreign airlines. He also responded to critics raising alarms over Indigo's overwhelming market share. Bhatia said 1/3 of Indigo's network are unique markets that no one else flies to. That's not all. Bhatia also touched upon the episode of the mass flight cancellations in December last year. He said that a multitude of factors, including new rostering rules, broke the camel's back. He also highlighted that corrective action has been taken since then, and the airline's punctuality has never been better in the last 6 months.
1/3 of our production is in markets where nobody else flies. These are unique markets where we are doing everything we can to bring the nation together. And it's only the balance in markets that we compete in. We only have, I think, about 44%. So this thing about, Indigo being what it is, what is often lost in translation is the fact that we are connecting the hinterland of this country like no one else. And it's not because other airlines cannot fly those routes. They can, but they choose not to. And the reason we are able to do what we do is because of the cost structure. We are able to experiment, and the 33% or 34% of the flying we do into unique markets represents something like 250 city pairs. So while we keep getting badgered on our size and scale, like I said, what is not understood is what we are doing, which no one else is doing.
You know, as you look at expanding both domestically as well as internationally, what changes, if any, are you bringing in to kind of ensure that you leverage on the new momentum that you want to build on?
I think Indigo's journey over the last 20 years was all about building an extensive domestic network. We are not finished doing that. We will continue to do that. That will remain the core of the airline. But having built this network, the next logical step is really to take Indians to the world and bring the Indian diaspora that resides in other parts of the world to India. And that's something which, for reasons I probably prefer not to discuss, was handed over to airlines and geographies outside of this country. With that, there was a lot of export of economic wealth from this country to airlines that don't reside here and were carrying Indians. I think there's an immense responsibility on our part as Indigo and on the part of airlines like Air India to bring all of that back. So that's our sort of next step. And I think we are well positioned to do that just because of the domestic network. We're able to collect people into a hub and then fly them on bigger planes to other parts of the world. So that's really what we want to do as stage one. And there will come a time at some point in the future where we will, once see the airport hubs sort of mature, where we will carry customers from one geography to another through India. They don't necessarily have to be our customers, but I'm taking an example, somebody from the UK to Australia. I think once we build our network and once the airports are transit friendly. I've gone on record to say that December should never have happened. It's not something that our customers deserved. It's not something that our frontline employees deserved. But I think there was a confluence of several different things that came together, and then the cookie crumbled. There was implementation of FDTL. We went through a massive upgrade on our entire fleet. A couple of days before that, there was, I think, volcanic ash. There were several things that came together, and that sort of, broke the back of the camel. But talking about disruptions, the disruption in Indigo was not unique. It was not something that's happened for the first time anywhere in the world. You've had some carriers larger than Indigo that have been through issues like that. Southwest, Ryanair, JetBlue. I mean, there's a long list of these things. Is this something that we wanted? No, of course not. But it happened, and we took corrective action, and we were back up and running in, I think, 2 or 3 days.
How much of what we saw happen in December was a result of poor management decisions, a leadership issue, and hence you believe that the leadership changes that you've been able to bring in will help address some of those challenges?
I think the changes that we have seen over the last 3 or 4 months, some of them have to do in preparing this company for the future. Some of them have to do with holding some people accountable for what happened in December. It's a mix. It's not about one thing or the other. It's really taking stock of what happened that should not have happened, and also building resilience in the organization for the future.
Now, the DGCA, in its findings of what happened in December, talked about operational deficiencies. It talked about optimization, which perhaps had been pushed beyond its limits. It talked about the lack of FDTL preparedness. Now, if I were to ask you on each of those fronts, which has of course been publicly spoken about by the regulator, what is the corrective action that's been taken?
I mean, we have now been flying for 6 months since December, and our punctuality has never been better. And this is something where you earn your wings every single day. We fly, over 2,000 trips a day, and I think the machine runs fairly smoothly. And our only appeal to the government has been that when you look at FDTL regulations, look at it from 2 lenses. One, that we must do what is best in class on a global basis, right? Look at regulations around the world and figure out what's the right thing to do. But if we put in regulations in place which actually, in the garb of being safe, make the industry as a whole uncompetitive because you're actually taking down productivity of the cockpit, I think is something that we need to look at, because you cannot have on the one side an aspiration for the nation as a whole to get on to the stage of global aviation and yet have its airlines compete with the rest of the world with an uncompetitive cost structure.
So you're saying the current FDTL regulations make Indian aviation uncompetitive?
In terms of cockpit productivity, absolutely. We constantly, the industry always gets, again, I use a word and you'll hang on to it, hammered for airfares. And this again something that I think we have not done a good job in educating the world at large. If I gave you the last 3 years statistic, airfares in India, and when I talk about airfares, I'm talking about a portion of the fare that actually belongs to the airlines, has gone up. And this is, the cumulative inflation over the last 3 years has been 12%. With that backdrop, the portion of the fare that belongs to the airlines has gone up between 1 and 3%. UDF charges at airports have gone up to 95%. Landing charges at airports have gone up to 34%. And the reason I make this point is this is not being critical, but I think if we truly want India to become a major global aviation market, I think the whole ecosystem has a responsibility to make sure that we have a cost structure that will allow us to compete.
The Supreme Court has closed the criminal case against coal block allocation scam case. Nearly 2 years after his demise, a special judge has accepted closure reports filed by the CBI. The case pertains to the alleged irregular allocation of the Talabira 2 coal block in Odisha to Hindalco Industries during the UPA government's tenure. The Supreme Court has quashed the Centre's 2021 office memorandum that allows retrospective environmental clearances, terming it illegal. The Apex Court also restricted the Centre from issuing administrative orders granting blanket permission for retrospective environmental clearances. However, it clarified that provisions for such clearances should be introduced through a formal notification. On that note, it is time for us to head into a short break. But coming up, government and opposition clash in Parliament as Lok Sabha passes a new bill proposing stricter punishment for exam frauds. More on that when we return. Stay tuned. Welcome back. You're watching Business 360. A quick look at the global headlines of the day. Ukrainian President Zelensky met U.S. President Donald Trump in a closed-door meeting during his trip to Washington. Reports have said that the leaders discussed ways for Ukraine to produce its own weapons in its ongoing war against Russia. White House says that the talks were positive and productive without disclosing further details. The U.S. government moved a step closer to impose a 100% tariff on Russia's trading partners, including India and China. The U.S. Senate voted overwhelmingly to advance a new Russia sanctions bill in a rare bipartisan move. One of the authors of the bill accuses India and China specifically for fueling Putin's war machine.
It's carefully crafted to make sure we are not hitting our allies and that we are hitting China and India. Let's be really blunt. China and India are the main culprits here. They purchase the vast majority of oil and gas. They are fueling Russia's war machine, and they are doing us no favors anywhere else in the world.
The Lok Sabha has passed a new bill proposing stricter punishment for exam frauds. Government and opposition clashed in Parliament after Rahul Gandhi accused Home Minister Amit Shah of ordering the police action on student protests in Delhi. BJP has denied the charge and demands an apology.
Sir, the Home Minister authorized the shooting of our students, sir. He put pellets into the blood of our students. He ordered the students of India to be shot.
किस तर्क के साथ आप ये बयान दिया है, ये बहुत गलत बात बोला है राहुल गांधी जी, बहुत गलत बात बोला है। मैं इसका आपत्ति करता हूँ, कार्रवाई से निकालना ही चाहिए, लेकिन राहुल गांधी जी आप माफी मांगिए, ये ठीक बात नहीं है।
अगर नेता प्रतिपक्ष ने कोई गंभीर आरोप लगाया सरकार पे, तो ये सरकार की जिम्मेदारी बनती है कि किसके ऑर्डर पे पुलिस ने बच्चों पर, छात्रों पर, युवाओं पर इस तरह का व्यवहार किया है।
कहीं भी गोली चलाने का आदेश कोई मंत्री नहीं देता, वो मैजिस्ट्रेट देता है, एसडीएम देता है, डीएम देता है। दूसरी बात, ये बार बार स्पष्ट किया गया कि गोली चली ही नहीं, अश्रु गैस, टीयर गैस का इस्तेमाल हुआ, लेकिन जब गोली चली ही नहीं तो आदेश देने का सवाल ही नहीं पैदा होता।
The Delhi police asks Elon Musk's social media platform X to remove abusive social media posts against Prime Minister Modi made during the student protests. Seeks details of the accounts that posted this content, including full name, address, email, and contact details. The flood situation in Assam remains grim. The death toll in the state has risen to 75, and more than 3 lakh people remain affected across 7 districts, including over 600 villages. Over 32,000 people have taken shelter across 82 relief camps. The state government has increased ex gratia assistance for families of flood victims to 9 lakh rupees and relaxed compensation norms. At least 13 people have died following a powerful 7.1 magnitude earthquake in Japan yesterday. Japan's PM Sanai Takaichi said rescue teams are in a race against time. The quake triggered fires, caused buildings to collapse and damaged bridges. Aerial visuals from the affected area showed severe damage, including partial collapses at a shopping mall. And with that, it is a wrap on this edition of Business 360. More news and updates continue right here on CNBC TV 18.
Hello and welcome to Startup Street. I'm Shruti Mishra and with me is Ritu Singh. These are the top headlines from the startup space. Ferns and Petals has crossed 1,000 crore rupees in revenue for FY26, up 25% year-on-year, sets a target to go public by 2028. Company aims to scale revenue to around 1,400 crore rupees in FY27 as it expands its retail footprint, quick commerce business and international operations. AI-native sales automation startup RevSpot bags $4.8 million in a Series A funding round co-led by Inflexor Ventures and InfoEdge Ventures. The Bengaluru-based company will use the capital to strengthen its AI platform, expand into new high-ticket B2C sectors, and grow its presence in select international markets. South Korean gaming giant Krafton reported a record second quarter with revenue surging nearly 95% year-on-year to 1.29 trillion won, while operating profit rose 67% to 410.9 billion won. The company said strong growth in the PUBG franchisee and the success of Subnautica 2 helped drive the record performance. Venture capital firm Aniket Capital has launched its second early-stage equity fund with a target corpus of 175 crore rupees. The fund will back about 20 startups across deep tech, enterprise technology, consumer and financial services, focusing on companies from pre-seed to Series A. Apple briefly crosses the $5 trillion mark capitalization during Tuesday's trading, becoming only the second company after Nvidia to reach the milestone. The iPhone maker's rally has been driven by strong product demand and investor confidence ahead of its quarterly results. Well, those were the headlines we've been tracking for you this evening. On What's Brewing, Netcore Cloud has rebranded itself as Netcore.ai, betting that the future lies in agentic AI, where autonomous AI agents don't just assist marketers, but execute campaigns and share accountability for business outcomes. The company says it's the first marketing platform to combine AI agents with human growth engineers under an outcome-driven model. Joining me now is Rajesh Jain, the founder and managing director of Netcore.ai. Rajesh, welcome to Startup Street. Now, this is more than a name change. You're repositioning Netcore as an agentic AI company rather than a traditional MarTech platform. Why make this shift now, and what changes fundamentally for your customers?
Shruti, thanks for having me on the program. See, I think there have been two clear trends in the past, I would say 12 to 18 months. Agents have become reliable enough to execute rather than just suggest. And CMOs are under great pressure from CFOs to show not just revenue, but also adoption and profitability growth.
Yes.
What changes for the customer is really the fact that MarTech hitherto has been entirely priced on inputs, number of messages sent, number of active users. What we are saying is that there has been no accountability. And the shift that needs to happen is to bring in outcomes into the loop. And with our MarTech growth engineers, we will work to essentially deliver outcomes and take a percentage of our revenue linked to outcomes. So we are playing skin in the game.
Sure. But Rajesh, almost every software company today is talking about AI agents. What makes Netcore's 7 AI agents materially different from the AI co-pilots and automation tools already available in the market?
So a co-pilot basically tells the marketer what to do.
Okay.
Starts do the work. So marketers can now define goals, have guardrails, have permissions set. So the key thing in across the agents, and we've got 7 of these agents working together, is that they share one memory of the customer. So the context layer is really what makes the big difference, because Netcore already has a unified stack which covers marketing automation to search and the channels. So a decision made, say, on a WhatsApp or an email channel is available to all other agents and across all the platforms.
Okay.
Essentially, the agent is only as good as the context. So that really makes the big difference from the co-pilots that you're seeing around here.
Okay, and you've gone a step further by saying Netcore will share accountability for customer growth, not just provide software. That's a significant departure from the traditional SaaS model. How exactly does that work, Rajesh, and what risk does it create for your own business?
Yeah, so I think this is an industry first. Like I said, hitherto, everything has been priced on inputs, not outcomes. So what we are saying is we agree on the KPI that needs to be delivered. In many cases, it's specific actions like outcomes in terms of transactions done, etc. Agree on the baseline, agree on the measurement method, and then our agents work with our MarTech growth engineers Now, of course, there is a challenge here. Like you said, there is a risk that sometimes we may get the marketing right and still not get paid because there's been some change on, say, pricing or strategy from the customer. That's a business risk we are willing to take. We'll be selective, of course, with whom we sign. We want to be honest about measurement. So because outcomes really is what this industry needs to shift towards. That is what is been missing in MarTech all of these years. And we think AI, the agentic AI layer, actually enables us to not just take up challenges like this, but also deliver on the outcomes.
You know, Rajesh, AI promises hyper-personalization at scale, but it also raises concerns around privacy, governance, and consent. How are you ensuring that autonomous AI agents remain compliant while making real-time marketing decisions?
So the agent can only act on the data that the customer has permitted for purposes they have permitted. There are very strict guardrails. Every action, every decision is traceable and reversible. High-risk decisions need human approval. There is always a human in the loop. So essentially, an agent that cannot explain what it did has no place in the enterprise. So we have worked very hard to bring in this decision trace and the governance and the guardrails to ensure that there is consent, there is privacy, and of course, there is the deliverability of the outcomes.
Okay. Rajesh, you know, you've retained growth engineers alongside AI agents instead of replacing them. What have you learned about where humans still outperform AI, and where do you think AI is already better than marketers?
Yeah, I think the drudgery, what today, if you look at MarTech, a lot of the work is drudgery. You need to analyze what happened yesterday in the campaign. You need to create content. You need to do segmentation of customers. And you can only do this for so many segments. You can only create so much of content. With AI agents coming in, coordinated by a co-marketer, all of this can be now done at much greater scale. Of course, the end dream is one-to-one personalization. But I think even if MarTech moves from N is equal to many to N is equal to few to cohorts, because you don't have data on every customer. You've got data maybe on a small segment of customers. I think that will be a big leap. And what our MarTech growth engineers do is, because they have deep understanding of verticals, of the best practices across customers, I think they can be very effective in working with the marketing team at the customer end to ensure that the right campaigns are done and the right content is created at scale.
All right. You know, Rajesh, we've seen AI dramatically improve productivity across software development, customer service, and sales. Do you believe marketing is the next major function to be fundamentally rebuilt by AI? And what will the marketer's role look like, let's say, 5 years from now?
Yeah, I think one thing we've got to understand in marketing is that marketing is a function where there is a lot of waste. Today, and I call this ad waste, about 90% of marketing budget is spent on new customer acquisition. 70 out of the 90 is spent on reacquiring existing customers. And that is about $500 billion worldwide. This is the real opportunity for the golden age of retention marketing, of maximizing profitable growth. Because when you're spending money reacquiring the same customer again and again, that's basically wasted.
Yes.
So therefore, I think for marketing teams, what really happens is, going from just managing day-to-day operations, they can now be directors of outcomes, set goals, and work on outcomes with these agentic platforms.
All right. On that note, it's time for me to wrap up our conversation. Many thanks, Rajesh, for joining us on Startup Street, and we'll surely keep a track of the company. Thank you so much.
Thank you, Shruti.
Moving on, also on what's brewing. Twinkle, twinkle, little star, can we actually put a diamond in space? What began as a casual conversation between Skyroot Aerospace co-founder Pawan Kumar Chandana and Cosmos Diamonds founder Sanjana has now become a reality. A lab-grown diamond jewel has successfully flown aboard Vikram 1, becoming one of just 6 payloads on the mission. Now, beyond the headline, the collaboration also reflects the growing ambitions of India's private space and lab-grown diamond industries. Joining me now is Sanjana, the founder of Cosmos Diamonds. Sanjana, welcome to Startup Street. The collaboration with Skyroot began with a simple question, like I mentioned, can we put a diamond in space? How did that idea really evolve into an approved payload on Vikram 1? And what did it take to make the Cosmos Bloom diamond space ready? And if you could also share, what were some of the toughest engineering and design challenges that you had to solve?
Hi, first of all, thank you so much for having me here. So from the beginning, from the initial idea to actually seeing a diamond in the orbit is something that is that a feeling that I can't even begin to explain. So the whole journey has been over a year, and the kind of challenges we face during this are also quite unique because whether it comes to design or engineering, also there's no guideline for how do you design a jewelry for space, right? When you're designing a jewel for a human, there's always an objective, there's a budget, there's a feeling, there's an emotion, there's something that you play around. But designing for space is something obviously that has not been done before. So there are many parameters that were taken into consideration. We made over 11 iterations and over hundreds of sketches, starting from the thickness of the prong that has to hold the diamond to how do you make sure that this doesn't disappear in vacuum? How do you make sure that it actually stays put? So, we actually had to get the screws that are used in a rocket and had to replicate them in gold and attach it to the lotus as a stem so that it stays in place. And even the kind of paint that is used to do that blue color. So Skyroot actually gave us a list of chemicals and components that are allowed. So we had to figure out how do we mix a paint that actually that is allowed, and what kind of material should this be mounted on? Should we use 14 karat gold, 18 karat gold? What kind of diamond? So yeah, there are a lot of interesting challenges that have happened, and then of course in Skyroot, with the genius of Skyroot, everything happened really well, and we actually have it.
Yes. Absolutely, Sanjana. I believe you worked closely with Skyroot's engineers, tested multiple materials, and even incorporated custom aluminium components and rocket screws into the design. But Sanjana, sending a lab-grown diamond into space certainly grabs attention. But beyond the headline, what was the business objective? How does a mission like this strengthen the Cosmos Diamonds brand?
So I think when collaborations, very unusual collaborations like this happen, it is all about synergy. Because I think space technology is one of the most exciting technological innovations that human beings have achieved. And the way we look at diamonds, they're so aspirational. But then lab-grown diamonds on the whole is a phenomena that is sweeping the market. And we wanted to put lab-grown diamonds in a position where the whole world is watching. That was the deeper agenda that we had. Even at Cosmos, right, the deeper business objective that all of us believe, the whole core team believes, is that we are making from Bharat to the world. If you look at diamonds, 90% of diamonds of the world are actually cut, polished, and graded in India. Only the growing part is missing. Now with lab-grown diamonds, India actually has the ability to own the entire supply chain, and to put something that is our symbol over there has been a dream, and the entire purpose of why we do what we do at Cosmos.
Sanjana, lab-grown diamonds have moved from being a niche category to one of the fastest growing segments in the jewelry industry. If you could take me through your business growth numbers, the kind of demand you're seeing, and what does the road to profitability look like?
So first of all, we are a bootstrapped and profitable company from day zero.
Okay.
Talking about the industry, currently the market size is around 400 million, and it is supposed to reach 3 billion in the next 3 years. Talking about our growth too, we've been growing more than 100% year on year. And in fact, there's an interesting fact that for the first time, it is this year that in terms of exports of diamonds, lab-grown diamonds in volume has exceeded natural diamonds. And it clearly shows the amount of high growth that is happening in the industry. And I'm very happy to say that Cosmos is growing at a rate higher than that.
Okay. And today, Cosmos has stores in Bengaluru and Vijayawada. What does your expansion roadmap, Sanjana, look like? Are you betting more on physical retail, digital commerce, or an omni-channel strategy?
At Cosmos, we don't believe that the way to win this industry is about launching very fast everywhere, but rather it is about depth and character. So we are definitely an omni-channel brand where we believe that the discovery happens offline and the purchase often happens online, in the offline store. The next stores are planned for Hyderabad, Chennai, and Vizag. We strongly believe that before we open a store, we make sure that there are 100 customers who are already waiting on day one to visit our store. We're seeing insane potential from US. We're seeing a lot of interest from actually Tier 2 who's really fascinated by the concept of lab grown. So yeah.
All right. Technology, is transforming every part of the jewelry value chain, Sanjana, from diamond creation to design and customer experience. How are AI and digital tools changing the way you build and sell jewelry today?
So on that front, I think we're one of the very few jewelry companies that always had a technology team from day zero. So when you talk about AI, in everything, starting from how the sale experience is happening, to tracking inventory, to seeing which design is actually gaining interest, to even co-creating what design needs to be made, there is AI and digital tools made in everything. And it is literally part of modern day retail, and it is And we really believe that it will transform the way jewelry is being sold.
Okay, so after sending a diamond into space, what's next? Is there another bold idea you've already started working on, or was this the toughest act to follow?
So very honestly, because I've named the brand Cosmos, to see a Cosmos diamond in the actual cosmos, that feeling is something I'm not going to get over anytime soon, and definitely end there. So following the cosmic bloom, we're going to launch a collection next week to make sure that more people can actually enjoy it and own it and wear it. And like I said, the overall mission is always to do Bharat to the world. So something exciting is also going to happen soon.
All right, and we'll surely keep a track of that. But before I let you go, very quickly, both you and your husband, Rishikesh, have built startups that set out to disrupt traditional industries, Rapido in mobility and Cosmos in jewelry. How much do the two of you discuss entrepreneurship at home, and what's the biggest lesson you've learned from each other's journeys? If you could quickly answer that.
See, by now, entrepreneurship has become a way of life. And honestly, I think entrepreneur's life is a little difficult. There's a lot of highs and lows. Definitely, there is a lot of empathy and understanding and companionship at home, which makes us be better at what we do. And even the industries that we are in, there's so much contrast in the kind of challenges and the nature of business that we do, that whenever we talk, it almost feels like an absolutely fresh breath of from very different perspectives. So yeah, extremely thankful to get to do this with him.
Well, on that note, it's time for me to wrap up our conversation. Many thanks, Anjana, for joining us on Startup Street. And we wish you the very best. And we'll, of course, keep track of what's coming next.
Thank you. Thank you so much.
Well, with that, it's time for us to head into a short break. But coming up, the next billion investors may not come from Mumbai or Bengaluru. They are coming from Bharat. One stockbroking platform says nearly 80% of its retail orders now originate from Tier 2 and Tier 3 cities. We speak to Lemon's founder on the other side. Stay tuned.
Well, India's retail investing boom is showing no signs of slowing down. Stockbroking platform Lemon says its revenue has surged more than 800% year on year, with retail orders jumping over 9 times and active traders growing 5-fold. It also says nearly 80% of all of its retail orders are now coming from Tier 2 and Tier 3 cities as well. So let's get in Ashish Singhal, the co-founder of Lemon, for more on this and the trends he's seeing. Ashish, welcome to the show. Thanks very much for joining us here on Startup Street. 800% revenue jump in a year, 9 times increase in orders. Those are eye-catching numbers. What have been the biggest drivers of this growth? And importantly, can you sustain it?
So let me set the context first, right? So Lemon has been in this industry for almost 2 to 3 years now. First couple of years, we were also learning about the markets, what works, what doesn't work, what actually user wants. And what we faced in the industry was that a lot of big players have kind of stagnated. The kind of innovation that we expect from broking houses kind of stayed neutral. And that's where the growth that you see with Lemon in the last 1 year is a result of us learning what users actually want and building on top of it. And we definitely, hope to continue this trend year on year. At least for the next 2 years, we're going to continue to grow this way and, show that this industry is still up for grabs. There's still innovation that can happen in this industry and can really, build for the users for the long term.
Well, Ashish, very interestingly, you say 80% of your retail orders are now coming from Tier 2 and Tier 3 cities. But what are these investors actually buying? Are they long-term investors? They're building wealth or largely trading in F&O?
I think it's a bit of both. So what we realized when we were launching Lemon was today a lot of users have access to stockbroking. Some of the amazing companies in the industry have already reached out to the corners of India to give them a platform to invest. But a lot of these users don't know what to buy, what to sell, right? And that's where, Lemon brought in that differentiation, which helps not just a user executing their trades, but also help them analyzing their trades. What is good buy? What is a good sell? When they should double down on a stock and when they should sell. So our analyst rating on the app is quite, positive, and a lot of users take those trades on us. The split is kind of equal. I think the growth is equal in stock investment. We have grown almost 9x in orders, and even in F&O, we have grown 9x in orders. Even in F&O, we have innovated a lot on user learning from their trading sessions and doing better. We are one of the very few trading brokers out there who would stop you from trading, if we realize that you are doing something wrong, right? So I think these innovative tools have really helped us get the user trust and get the kind of growth that we have showcased in the last 1 year.
Got that. Ashish, since you say half your traders are, looking at F&O, for instance, that's an area where regulators have repeatedly flagged concerns about the kind of returns and the risks associated. So how are you balancing driving engagement on one hand while also ensuring that there's no over-trading done by the customers?
F&O has always been treated as, 93% of the F&O traders lose money as per the SEBI report. So what can be done for these users? And I think that's the approach that we have taken very differently. We believe that a long-time profitable users will always, remain kind of loyal to the platform and happy to pay brokerage, continue to trade, continue to do well, as long as platform are also looking out for his profit, right? So Lemon, instead of just providing a platform where user can trade, also added these layers which help them make better decisions, right? Sometimes those decisions could be not to trade in a day. Maybe that trading day is too volatile and we suggest our users not to trade. It does hurt the the Lemon brokerage that day, but getting that user trust for the long run and making sure that user is profitable would help us retain those users better. And obviously, it's better for the users as well. So in the long run, it's a win-and-win situation. So that's what we want to create. Maybe in the short term, it may go against any brokerage house that you are generating less revenue from a user. But in the long run, I believe that is the success story that we can build up with Lemon.
Got that. So far, you've expanded into equities, mutual funds, IPOs, F&O. But as you look ahead, where do you see the next leg of growth coming from?
I think we are too small to currently, say that even we are even 1% of this market. So there is enough growth pending in these segments as well. While we are also looking to launch commodities, US stocks, and many other products into the ecosystem that would give us further, maybe 2-3 years worth of growth in the future. But I think our current focus remains in getting a larger share of the stockbroking market itself.
All right, Ashish, we'll leave it at that. Thank you very much for joining us here today on Startup Street.
Thanks, Ritu. Thank you.
Hello and welcome. I am Ashmit Kumar. Now, the Supreme Court today heard petitions alleging excessive use of force by police against student protesters. The court said that the allegations must be investigated by an independent, high-powered committee. The top court observed that the probe must be thorough, independent and scientific. It also noted that the protest was initially completely peaceful and that the right to protest is a constitutionally guaranteed right. The court directed that no coercive action be taken against protesters. It first called for the release of protesters below the age of 18. That's, of course, an interim direction given by the top court as of this morning. The court later directed the release of arrested or detained students who are first-time offenders. It also said that digital data of protesters must be preserved and must not be released in the public domain. The Supreme Court will seek responses from the centre, the Delhi government and the states of